and you said, I got to change that position, or you never made those kind of mistakes?
Well, I never really got into the investment side of the business, so I don't have that. But I do remember when I was a young girl, I was paying attention to the markets, and I remember a big correction. I came home to my dad and I said, did you see what happened? You have to sell everything. And I'm so grateful he didn't listen to the younger me. But it's those sorts of lessons that I carry forward, which is even in today's market, it's important to stay invested, it's important to be diversified, and it's important to think about the long term. We've been on a very deliberate strategic growth agenda, and this is an environment where you really have to focus on balancing your risks.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays at 8 p.m. Eastern Time. Right here on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Today, State Street itself doesn't manage money. You do that at State Street Global Advisors.
Right.
And at State Street Global Advisors, do you do private equity as well as public equities?
We don't. We mostly focus on the liquid side of the market. But, you know, we've been very focused on democratizing investing. We put gold inside an ETF, which actually has turned out pretty well for investors this year. And just this year, we partnered with Apollo and Bridgewater to bring private credit and the all-weather strategy that Bridgewater has to everyday investors through the ETF mechanism. And so that's how we are thinking about that broader landscape.
So you've done an ETF with Apollo, an ETF with Bridgewater, but one of them did much better than the other so far in terms of raising money?
It's very early days, and so we're actually quite pleased with both of them. But the all-weather portfolio, the underlying strategy that Ray built really for his own family office, really thinks about two dimensions, sort of inflation and growth. And it's very apropos to the environment that we're in.
So today, your business is expanding, presumably. So are you planning to get into new areas that you're not in now, or plan to hire any more senior people that would help you manage the business?
So the businesses that we're in enjoy a lot of tailwinds. We've been on a very deliberate strategic growth agenda, and so places that we've been focusing and investing resources are in a lot of markets outside the U.S., wealth broadly around the world, and in fixed income as an asset class. In terms of talent, we're still hiring, and over the course of my 2 years, I have brought in a number of really talented professionals, such that today my immediate leadership team is more than half comprised of people new to the company or new to their roles.
Let's talk about the career of being an investment professional. Suppose somebody's watching and saying, I'd like to be like the president and CEO of State Street Global Advisors. Is this a career you recommend to men and women?
I think it's a wonderful career for men and women. You're really engaged with the capital markets, you know, all of the topics we've been talking about, working with really smart people. And at the same time, what we're doing is really helping millions of people around the world that have saved, that are really trying to save for their retirement, put their children through college, buy that house. And so that sort of sense of purpose, but also the opportunity to be really to learn a lot.
Somebody said to you, here's $100,000, I'd like to put it in the market. What would you do with $100,000 today?
I would put it in one of our model portfolios that is really well diversified across asset classes, geographies, and segments. Because I think this is an environment where you really have to focus on balancing your risks.
So today, what is your biggest worry about the investment management world in terms of getting investments that investors like? Are you worried about the economy, the tax situation, the tariffs? What is your biggest worry?
Well, I mean, all of those, we have to pay attention to because we're operating in the markets. But when I really think about the asset management business itself, there is continued pressure on fees. Investors are expecting more from their asset managers, and so we're investing heavily in technology and finding efficiencies across our platform, so we're in a position to continue to pass those cost savings on. I'd say the other thing to think about is just the use of technology and how investors on a go-forward basis are going to be accessing their investment.
So if the President of the United States called you and said, you're a very talented person, we need more women on the Federal Reserve Board, would you be willing to serve your country on the Federal Reserve Board?
In many ways, I feel like today I sort of have the best of both worlds. Being able to really grow a business, but at the same time benefit so many people. And so I never want to say never, but I really do love what I do today.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Technology is embedded in every aspect of our lives
and laying the foundation for the future.
From finance to defense, AI to entertainment,
and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Annabelle Drulers in Hong Kong.
I'm Sherrian in Tokyo. Watch Bloomberg Tech Asia.
Only on Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Beirut, and this is Bloomberg. Good morning. I'm Jumana Bersachi in Dubai, and here's what we're following this morning. President Trump says there's been a lot of progress in talks with Ukraine on a deal to end Russia's invasion. He hosted Volodymyr Zelensky at his Mar-a-Lago resort in Florida on Sunday, and there was agreement on security guarantees, but the future of the Donbass region is still a major sticking point.
We had a terrific meeting. We discussed a lot of things. As you know, I had an excellent phone call with President Putin that lasted for over 2 hours. We discussed a lot of points, and I do think we're getting a lot closer, maybe very close.
The U.S. president will meet the Israeli Prime Minister Benjamin Netanyahu in Palm Beach, Florida, later today. Tensions between the two leaders have been rising, with Trump previously warning Israel against taking actions that could undermine his peace efforts in the Middle East. They're expected to discuss the second phase of the Gaza peace plan, as well as Iran. Taiwan's Air Force has launched fighter jets after authorities detected 4 Chinese Coast Guard vessels approaching its waters. Beijing had said it would hold military drills around the island from Monday. Local media say the exercises will disrupt air and sea traffic, and Beijing says the drills are a stern warning against Taiwan independence after the U.S. announced a major weapons package for the island. SoftBank is said to be in advanced talks to acquire Digital Bridge Group, a private equity firm that invests in assets such as data centers. Bloomberg understands that a final agreement is yet to be reached, and details, including the timing, could still change. SoftBank is trying to capitalize on soaring demand for the computing capacity, which underpins artificial intelligence applications. Silver prices have soared to record highs this year, driven by Fed policy expectations and fears of a supply crunch, with China set to curb exports from January. That rally prompted a warning from Elon Musk, who weighed in on a social media post saying rising silver costs could disrupt the production of EVs and other tech that depend on the metal. And a look at how key markets are faring today. The handover from Asia mostly positive. The MSCI Asia Pacific up 0.3%. S&P futures trading a little bit on the red and the downside, down 0.1%, but still close to all-time record highs for the Wall Street index. We have silver, we're just speaking about it, plummeting today, down 5% in trading. So a bit of a turnaround from some of the price action we've had over the course of the last month and week. $75 is the handle today, a bit of a selling momentum picking up in the last hour or so. And then Brent, you can see up 1.1% this morning. $61 is the handle, 61.30 on anticipation of further fiscal easing out of China in 2026. This is Bloomberg.
We're a value investor. We are long and we're short. At some point, we think the economy is slowing down, and we think that the Fed will have to adjust to that. My biggest concern is instability. Things are happening really, really quick, and it's a little disconcerting.
David Einhorn doesn't follow the crowd. He's earned his reputation as a value investor by making bold calls, not by chasing trends or timing the market.
Most of the investing these days is no longer done by people who are buying something because they think it's worth more. They have opinions about price. Like, what is the price going to be tomorrow? And so the result is most trading that is going on right now has nothing to do with value.
His strategy is rooted in deep research, finding undervalued companies to invest in and identifying the weak ones to short.
It leaves us sort of as a dinosaur. We're one of the remaining few people left who are looking at things on a traditional basis.
Einhorn didn't set out to become one of Wall Street's most recognized hedge fund managers. After graduating summa cum laude from Cornell in 1991, his plan was to study economics.
I applied to the top economics graduate schools, and they did me a huge favor by telling me, like, don't do this. Like, you're not accepted.
When that plan didn't work out, he pivoted. With some grit and a whole lot of persistence, Einhorn carved out a new path.
I interviewed anybody who would take a meeting with me, probably 40 or 50 different entities, and I wound up taking a job in investment banking because I thought the people would be the most fun to work with.
That move would eventually lead him to launch Greenlight Capital in 1996, a long-short hedge fund with just under $1 million in startup capital. A decade later, in 2007, he'd made one of his most famous calls, shorting Lehman Brothers just before its collapse. Einhorn's an avid poker player, and he says there's more overlap between the card table and the market than you might think.
You're dealing with knowledge that you have, like what are your cards, and then you have like things that you can infer, like what is the other person's behavior, and then you have the uncertainty of future outcomes.
When it comes to value investing, Einhorn says the key isn't just being right, it's knowing when you're wrong and taking responsibility for it.
If we do a really, really good job, we're going to be right 65 or 70% of the time, which means we're going to be wrong 30, 35% of the time. So we have to constantly be saying, are we wrong? And just own that. There's no shame in being wrong about something.
So tell us what Greenlight Capital actually does. Is it a value investor or is it some other type of investor?
Yes, we're a value investor. We are long and we're short. and we also make big picture macro investments as well. But our goal is to buy things that we think are undervalued and are likely to do well as a result of being undervalued. And we sell short things sometimes that we think are overvalued.
So value investing is when you're trying to buy something that you think is worth $1, but it's really being priced at 50 cents. In recent years, that's been difficult because of the Magnificent Seven and other technology-related things inflating the stock market, and for a long time there was low interest rates. So today, has value investing been a profitable thing to do over the last 10 years or so, or has it been hard to do?
The market structure has changed, and there has been what I consider it to be a broken market, or the value investing industry, I think, is defeated, so to speak. It used to be that most money was invested by these long-only investors, these big mutual funds and stuff like that. And they had money coming in every day, and they were getting nice fees on all of that money, and they had large research teams. And they would sit around following all of the companies with teams of analysts, and they would say, this company we think is undervalued by 30%. And it might be a growth stock or a value stock, a Magnificent Seven or otherwise, but they would say, I think this is undervalued by 30%, and if I buy it and I hold it, I'll make the S&P plus 30. Now, as we've moved to passive, they've lost their customers, and the remaining customers are paying them lower fees, and they have reduced their research staffs, and they don't have new money coming in to make new investments in any case. The market is now dominated by passives, index funds, which buy what everyone else has already decided things that are worth, or algorithms, which are basically trying to figure out what is everybody else doing and how do I front run that, or retail, which is buying things because they think it's cool or they think it's going up. And so most of the investing these days is no longer done by people who are buying something because they think it's worth more. They have opinions about price. Like, what is the price going to be tomorrow? And so the result is most trading that is going on right now has nothing to do with value. So it leaves us sort of as a dinosaur. We're one of the remaining few people left who are looking at things on a traditional basis.
So you're not necessarily trying to predict where the market's going to go with a particular stock. You're saying this stock is so low in value that eventually somebody else will figure out that it's worth more, or the dividends alone will be enough to make it a worthwhile investment.
It's the latter. We think the dividends alone are going to make it worthwhile as an investment, or buybacks, which give us a bigger percentage of the company, are going to make it worthwhile investment. If other people figure it out and re-rate the shares, that's upside, but that's not our base expectation.
Okay, so the most famous value investor of them all is probably Warren Buffett. You would agree with that?
Of course, and the best.
So he made stock investments as you do, but he eventually started buying companies and holding onto them and fixing them up and improving them in some ways, though with modest staff. Do you do that as well? Do you buy companies, or you just buy stocks and then hope that they will go up or believe they will go up?
We buy securities, and our ideal holding time is not forever. Our holding period often does run into years, but we don't have a view of buying things to hold them forever.
Your organization is one that has researchers who are helping you research whether something is worth buying or worth shorting, right?
Yes.
And you typically buy equities only, or do you do debt?
We will do debt, but we buy debt when it's distressed or through bankruptcies. We tend to be cyclical participants in the debt market. There used to be this thing called a credit cycle, where lots of companies would have bonds that you might think paid off, and you could earn equity-type returns with much less risk. And when that happens on an unlevered basis, we participate. But it's been a long time since we've had a genuine credit cycle.
So let's suppose I come to you and I say I would like to make an investment with you. I'd like to put money in in your funds or something. What do you think is an appropriate return for somebody investing in a value investing organization?
Well, we started in 1996, and our compounded return after fees is in the 13s. And after taxes, it's about 1% less than that.
As we talk, the tariff situation is still in flux a bit. The president imposing tariffs, getting rid of them for a while, maybe coming back. You have a view on whether tariffs are a good thing for the U.S. economy?
I think they're a regressive tax. They affect consumers as opposed to people based on how much income that they have. And so I think they are raise prices. If you bring in a tariff, maybe the supplier has to pay part of it, maybe the retailer has to pay part of it, but the consumer also has to pay part of it. So I think tariffs are a tax on lower income disproportionately, and I think that they have an inflationary impact, and I think they slow down the economy.
Are you worried about the U.S. economy generally, leaving the tariff issue aside? Do you think the U.S. economy is in reasonable shape, or do you think your worries about a recession?
We were in a slowdown even before Liberation Day, and that likely is continuing. Whether that slowdown amounts to what turns out to be a recession or not is something that we'll have to look back on. But the trajectory of the economy is clearly slower.
And do you worry about the fact that the U.S. has a gigantic budget deficit and a gigantic amount of overall debt, 36 trillion or so?
I've been enormously worried about this for a long time. In 2008, I came to the view that the U.S. policy and monetary and fiscal policy was just too aggressive, and we began buying gold. And we even created a gold-denominated class. So if you invest in our fund, you can invest in the dollar class or the gold-denominated class. I think that our monetary and fiscal policies haven't made sense for a very, very long time, and I think that ultimately that is something that's going to come out of the currency.
And do you worry about the value of the U.S. dollar? The dollar, some people say, might actually go down in value and be devalued, as we did with the Plaza Accords in 1985, or do you think the dollar is going to stay pretty much at the value it has?
Well, I think it's going to continue to depreciate versus gold. The other currencies also have their own issues with their own fiscal and monetary situations, but I think versus gold, I think the dollar will continue to depreciate. It has done so consistently.
How do you think the Fed has done in trying to deal with inflation? Do you think the Fed should have increased interest rates sooner and should decrease interest rates more rapidly now?
I don't know about increasing them sooner. I know when the inflation was happening after COVID, it was pretty obvious that there was a lot of inflation. We actually took a large position in addition to our gold in what are called inflation swaps, which are basically a derivative on the actual realized inflation that we thought everybody was underestimating. It's been one of the more successful investments we've made over the last few years. I think the Fed was historically back then was too slow in dealing with the inflation. And I see the policies that are being created right now as fundamentally inflationary, and so I think we're going to continue to have inflation.
But you would expect a few rate cuts this year. The Fed has implied that it might do some more rate cuts, but it hasn't actually said it will. Do you think the Fed will rate cut maybe 2 more times or so?
Our expectation is that there'll be more rate cuts than is priced into the forward curve at the moment this year. At some point, we think the economy is slowing down, and we think that the Fed will have to adjust to that.
Over the last 25 years or so, ever since China's been a member of the WTO, we have been in a really close economic relationship with China in the sense that we buy a lot of things from them and they buy a lot of treasury bills from us. There has been talk of a decoupling of our economy from China's. Do you think that's a wise thing to do, or do you think it's likely to happen?
It appears that the relationship is very frayed. That's just kind of the uncertainty that's there. I think that as a general matter, American policy of separating from other countries. We have this America First policy, which sometimes feels like America Solo policy. I don't think it's great for us. I think having allies is good for us. I think working with other countries is how we expand the wealth of the planet. And having trade tends to raise wealth in both directions. And so I think it's a problem that seems to be, fraying at this point.
As you look at the investment environment, what would you say is the biggest concern you have? Look at the global situation, the U.S. situation. Your biggest concern about the investment environment today is what?
Well, sitting here today, my biggest concern is instability. And, we're in a very volatile time. And there's a lot of decision making that's happening. Like, I'd like to tell everybody, if you like the news, wait 2 hours. And if you don't like the news, wait 2 hours. It'll change. Things are happening really, really quick, and it's a little disconcerting. I used that opportunity to really study Warren Buffett. So I read 2 or 3 biographies, I read all of his letters. I had really sort of built up a bit of a knowledge about him and his history and his process.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
So the greatest value investor we mentioned is Warren Buffett. Have you ever met him?
I have.
And does he give you any
I was
words?
actually the first one to buy the lunch with Warren Buffett. He sells a lunch once a year.
What did it cost?
It cost about $250,000.
All right, so for $250,000, what do you get other than a hamburger or something? You got some pretty good words of advice?
I did. So I used that opportunity to really study Warren Buffett. So I read 2 or 3 biographies. I read all of his letters. I actually went out to his annual meeting and I watched that whole production go on. And so I had really sort of built up a bit of a knowledge about him and his history and his process. So I was ready to ask a lot of questions that seemed pertinent to me.
So let's talk about how you started it and talk about your background. Where were you born?
I was born in New York, but immediately moved to New Jersey, like from the hospital.
Okay.
I lived there till I was 7. My father worked for my grandfather in a paint business. And in 1974 or so, there was a big consolidation with the energy prices and the rest, and the family sold the paint business. And my dad started his own little M&A boutique. Okay. And Mom said, well, if you're just working yourself, why don't we move back to Milwaukee, where her family was from? And so we did. So in 1976, we moved to Milwaukee, and that's really where I grew up, in the suburbs.
All right, so you went to college where?
I went to Cornell. I majored in government.
I majored in that too, but I don't know how useful it was at the time.
I would agree with you. I don't think it was that useful, but it was very interesting to study. And my folks always said, just study whatever is interesting to you, and that's what I picked.
And what year did you graduate?
In 1991.
Okay, so you just said, I'm going to go in the investment world, or I'm going to go into government. What did you decide to do?
While I was at Cornell, I was in something called the Cornell Washington program, and I worked at the SEC in the Office of Economic Analysis, and I worked with these professors who are essentially on leave doing economic research about markets and stuff like this. And I assisted them in some of their basic, diligence research to help them write their papers. And then I came to write my own thesis as part of my honors program at Cornell. And it was kind of like a political economy type of thesis. And I decided I really wanted to do economics. So I applied to the top economics graduate schools. And they did me a huge favor by telling me, don't do this. You're not accepted. So I then did on-campus recruiting. I interviewed anybody who would take a meeting with me, probably 40 or 50 different entities. And I wound up taking a job in investment banking because I thought the people would be the most fun to work with.
So you went to investment banking. Where did you go specifically?
It was Donaldson, Lufkin, Jenrette.
That's a great firm. So what did you do there?
Well, I made photocopies. I supervised word processing. I helped books become assembled. I was an analyst. I was a grunt. I did whatever it was that they told me to do, and it was a tough experience.
Those programs are typically 2-year programs, maybe 3 in some cases. So after 2 or 3 years, did you stay or did you go somewhere else?
Yeah, after 2 years I finished. I miraculously made it through the 2-year program. It was very, very hard for me. But I got a call from a headhunter towards the end of the program saying, would you like to work for a hedge fund? And I took the interview, and I liked the people, and so I took the job.
Which hedge fund was that?
It was called Siegler, Collar & Company. I was an analyst. So they would give me an idea and tell me to go figure it out, and then I would come to them with whatever I found and suggest we either buy it or don't buy it or whatnot, and then we would iterate on that process. They would tell me, well, what about these questions? And then I would go dig some more and try to get answers to things to help them manage their portfolio.
How many years did you do that?
I did that for 2 years.
And then you said, I'm ready to start my own firm?
Yeah, the guy on the who was maybe my age but a year further out of college than me knocked on my door one day and said, why don't we go out to lunch? And he said, why don't we start a hedge fund? And it sounded like a great idea to me, and 3 weeks later we were out on the street trying to figure out how to launch what turned out to be Greenlight Capital.
Well, typically, for a hedge fund, you need to get 2 things off the ground. One is you have to get people. You had one partner, but you have to also get capital to run the firm and capital to invest. So where did you get that kind of capital.
Right. His responsibility was meeting with investors. We met with a large number of people, and nearly none of them invested. So we started in May of 1996 with a little bit under $1 million of outside money under management. Plus, I put in a couple $100,000 of my own, and he put in a couple $100,000 of his. And so we started with about $1.3 million or $1.4 million total. And the smartest thing he ever said was, instead of waiting for the 10 million, which is what our initial marketing goal was, why don't we get going? And so we got started.
So you must have done reasonably well because more capital came in, is that right?
We did. We got off to just a really fabulous start. 1996 was a terrific time for what we were trying to do, and we made good decisions, and it just worked out great. We made like 37% the first 8 months, and then the next year we made something in the 50s, and we were just off to get going.
So you built out your research staff, I assume, to help you with some of the research. And were you the principal investment professional? You
Yes.
made all the investment calls?
Yes, I've been the portfolio manager the whole time.
And you have people under you now give you ideas, but you're still, no decisions made unless you make the decision, right?
Well, sometimes I defer to them a little bit because they've done all of this work. Even if I'm not fully convinced, sometimes we'll do stuff that other people think.
So today, do you actually seek money now, or now you're not in the money-seeking business, kind of comes in over the transom where you have as much as you want?
Yeah, we had a period where we were closed, which was really from 2000 or 2001 to 2019. So we were closed for the better part of 20 years. But we did have a rough period, and a lot of our investors did redeem. And sometime around 2021, we decided, let's see if we can repopulate the investor base. And so we've been in the process of doing that.
A rough period meant some of your deals didn't work out as well, or your returns went below your average?
It was just a really tough environment for what we were doing, and we hadn't figured out this revised market structure. I made one particularly bad investment in 2015, which turned out to be a fraud, and we lost a whole bunch of money. But 2018, it was just whatever we were doing. We didn't make money on anything, and we lost little bits up and down the entire portfolio. We have to constantly be saying, are we wrong? And just own that. There's no shame in being wrong about something.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Every weekday from 3 to 5 Eastern.
Only on Bloomberg. Context changes everything.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
You were well known for being, among your outside activities, being a poker player. So were you a young poker player as a kid, or when did you take up poker?
You know, growing up, we played all the games. My family was a game-playing family. We played games after dinner routinely. We played games on the weekends. We just played all of the games. So games has just always been a part of my life. And then I took off from all of this altogether. A few years after that, I went to a charity poker tournament, and I just had a great time. And I ran into a buddy, and he said, "You want to learn more about poker?" And I said, "Sure." And he gave me a couple books, and he invited me to his home game, and we just took up poker. About a year or two later, we decided, as a bucket list thing, let's go play in the World Series of Poker in Las Vegas. And so we just kind of went out and did that. I thought it would be like a one-time thing. And I had the luckiest run of card playing, that I'll ever experience in my life. And I finished 18th out of like 8,000 players. And from there on, I was just kind of hooked.
So I am not an experienced poker player, but if I were, would that help me be a better investor? In your view, does being a great poker player help you as an investor?
I actually think it works the other way. I think the investing helps me with the poker more than the poker helps with the investing. Poker is much more volatile than I would run my investment portfolio. So I think if you start as a poker player, you probably have too big of a risk appetite to be doing the kind of investing that we do. But some of the skills overlap. I mean, you're dealing with knowledge that you have, like what are your cards, and then you have like things that you can infer, like what is the other person's behavior, and then you have the uncertainty of future outcomes.
As you look at the investment business, is it a business that you would recommend young people go into?
My advice for young people, broadly speaking, is figure out where your strength is and pick a career that plays to your strong suit. So don't go into something that you're not naturally good at. Go into something where you're the most naturally good at, because whatever you're going to do is going to be competitive, and there's going to be other people who are going to try to do whatever it is better than you. So you may as well lead with whatever your strength is.
And you enjoy the business as much as when you first got into it, I assume?
Oh, I love this business. And otherwise, I wouldn't be here.
Who is the kind of person you like to hire? Is it somebody like you who's did really well in school, is a good head for numbers?
First of all, we like to hire people who are already experienced. So we don't really hire very many very young people. We're not hiring people out of undergraduate or out of banking programs like I was hired when I got into hedge funds. We're mostly hiring people who've at least done the job as analyst, if not portfolio manager, somewhere else. And then I'm looking for a philosophical alignment about how to go about investing, raw intelligence, critical thinking, and most importantly, somebody that I want to work with every day.
So for people that are watching and want to know what they should do with their money, let's suppose somebody said to you, I have $100,000, that's my money that I can afford to lose. What would you tell the average person to do with their money?
I think you should have a mix, and I think owning some stocks is good. I think having some cash or cash equivalents is good. I think owning some gold is good. I would mix it between those.
What is the best investment advice you've ever received?
The best advice I've ever received in managing the portfolio is, as soon as you know that you're wrong, change your mind.
And the most common mistake that you see investors making when they invest money is what?
The opposite of that. They stick to something even though they know that they're wrong. The minute it occurs to us that we've made a mistake, it's time to move on.
Does that happen very often, or now you do so much research, you're pretty comfortable with that?
No, we make lots of mistakes, and we're wrong a lot. If we do a really, really good job, we're going to be right 65 or 70% of the time, which means we're going to be wrong 30, 35% of the time. So we have to constantly be saying, are we wrong? And just own that. There's no shame in being wrong about something.
Now, are your parents alive?
Yes.
And do they call you and say, we always knew you were going to be a famous hedge fund investor, or they don't say that?
No, I think the only people more surprised than me about my success are my parents.
Oh, really? What did they think you were going to be? A government analyst?
I don't know. My attitude in life has always been, you're doing this now, do it well. If you do it well, you'll figure out what you want to do next.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets. Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Vernon in Florence, Italy, and this is Bloomberg.
Good morning. I'm Jumana Bersachi in Dubai, and here's what we're following this morning. President Trump says there's been a lot of progress in talks with Ukraine on a deal to end Russia's invasion. He hosted Volodymyr Zelensky at his Mar-a-Lago resort in Florida on Sunday, and there was agreement on security guarantees, but the future of the Donbass region is still a major sticking point.
We discussed all the aspects of the peace framework, which includes, and we have great achievements, 20-point peace plan, 90% agreed, and U.S.-Ukraine security guarantees, 100% agreed. U.S.-Europe-Ukraine security guarantees, almost agreed. Military dimension, 100% agreed. Prosperity plan being finalized.
Iran says it has launched 3 satellites into orbit from Russia, a move likely to add to tensions over Tehran's space and missile programs. State media says these satellites are intended for environmental and agricultural monitoring. The launch comes amid heightened scrutiny of Iran's nuclear and ballistic missile activities and ahead of high-level talks between the U.S. and Israel. And copper has barreled towards a record $13,000 a ton on the London Metal Exchange in a stunning end-of-year rally. The metal, that's crucial for renewable energy and power grids, surged more than 6% following a 2-day public holiday in the UK. Copper gained more than 15% in December as investors bet that a rush to get imports to the US ahead of possible tariffs would force buyers elsewhere to pay more. And a check on markets. We've got the European indices going to open up in about half an hour's time. And this is where we're trading. Futures up 0.4% versus the S&P futures, which are down about 0.1%. Silver tumbling today, down 4% after a very good run. And Brent stable at 61. This is Bloomberg.
London is a global financial center, has been for 300 years. I care most that we keep customer service front and center. It is the best job I've had in my life and the hardest, most difficult job I've had in my life.
When C.S. Venkatakrishnan was starting out, the corner office wasn't exactly on his radar. His sights were set on academia.
I wanted to be a professor in a business school. I graduated during the first Bush recession, 1991, and finding a job was hard. So an academic job.
The young man known simply as Venkat grew up in India before moving to America for school.
I was very fortunate, but whatever self-esteem I had, I lost within 2 days of coming to MIT.
He went on to earn both a master's and a PhD at MIT, diving deep into applied math, statistics, and probability. Those skills helped him land a job on Wall Street.
All my friends are in finance. Apparently they use math in finance. I'd taken a few classes at MIT. So I applied for a job on Wall Street. I got one finally at JP Morgan.
Venkat quickly rose through the ranks of JP Morgan, taking on senior roles in asset management, investment banking, and risk. Eventually, he became Chief Investment Officer for Global Fixed Income at the bank. Then in 2016, he made another major move, this time across the Atlantic.
I got this opportunity to be Chief Risk Officer at Barclays. And I said to myself, I've been 22 years in an organization, a great organization, which gave me a lot of opportunity, which taught me a lot. And I thought I needed to try something different, and if I didn't do it, I would never do it.
And he never looked back. Today, Venkat is CEO of Barclays, Britain's second largest bank. Barclays has a long history, dating all the way back to 1690, when John Freem and Thomas Gould opened up shop as Goldsmith bankers on London's Lombard Street. Now it's a global operation, with a presence in 38 countries and approximately 91,000 employees. It's also the last major European lender still competing on Wall Street. Since taking the helm, Venkat steered the company through the COVID-19 pandemic and the rising interest rates that followed. And today, Venkat says his journey all started with one life-changing opportunity.
I came as a student from India. I came to MIT. I've had a career in finance in institutions in the US and in the UK. I valued that opportunity, and I would want to give it to anybody who came.
Okay, so if you're a customer, let's suppose you're an average person living in London, and you have a chance to go to many different banks, HSBC, Barclays, Lloyds, others. Why should somebody want to use Barclays as their main bank?
You should use us as your main bank because we're pretty good at banking. We try to spend a lot of money on technology, on customer service to make the journey easy. And I would say, David, there's a philosophy to banking. I view it for people that you've got two important goals in life, typically. You've got your personal well-being, which is spiritual, physical health, You've got your financial well-being, which supports your personal well-being. And it's a really important role for those of us in the financial sector, for those of us in banks, to be privileged enough to help service your and grow your financial well-being. And hopefully that attitude suffuses what we do in Barclays.
Now, since the Great Recession and post-COVID as well, the American banks, a lot of them, have gotten much, much stronger, much bigger. And they are much more dominant in the global financial scene than I think they were pre-global recession. Is that a problem for the British-based banks?
It's not a problem. What it does is that it makes certain parts of our businesses more competitive. You know, London is a global financial center, has been for 300 years. We look to represent London in the globe as an investment bank. And then, even though banking has become transnational, in the last 5 to 7 years post-COVID, around COVID, banking has also become much more national. And so retail banking is much more national than it used to be even 10 or 15 years ago.
Who is your biggest competitor in the retail banking, commercial banking business in Europe?
In the UK, which is where we are primarily, it's Lloyds and NatWest.
Okay, and why are you better than those two?
They're both equally good banks. They're very good banks. I think if you come with Barclays, one of the advantages you get besides the retail is the fact, and we've had many companies have done it, and individuals, that you can go from a very small account to a very large account. We can manage your business. We can ultimately take you public. We can do derivatives for you. We can do foreign exchange for you. We're a full-service bank around the world.
Now, do you have a big private wealth division as well to manage people's money?
Yes, we do.
And to have an account there, how much money do you need to have? If somebody wants to have their money managed by Barclays, you need to have £1 million or £5 million?
It's typically £3 to £5 million.
£3 to £5 million.
Yeah.
Okay. And if I come to you and say, I met you, I interviewed you, I think you're a great CEO, I want to be using your bank for my private wealth, and I'll give you £5 million, what kind of rate of return can you get for me? Can you guarantee for me?
Well, with your risk preference, if we start and we put it in, sterling deposits, we can certainly give you 5%.
5%?
Yeah.
But suppose I say I have a high risk tolerance and I'm willing to take a lot of risk.
Then we will put you in Carlyle hedge funds or private equity funds.
So you get a 50% rate of return. Okay.
Absolutely.
That's good. Okay. Let me ask you today, what is the biggest problem facing the UK economy?
Growth. It has suffered after Brexit and the disruption of trade relations with Europe. I mean, they are still there, but it has more friction in it. It is a country that has been growing at approximately 0 to 1%. And for all the advantages it has, it can grow much more. And it needs the investment to grow. It needs the investment in human capital, in infrastructure, and in companies to engender that growth. And that is, I think, the single biggest problem.
So today, would you say, or is it not appropriate for business leaders in England to say that Brexit was a mistake?
I think Brexit has, in the long run, damaged the UK economy, yeah.
But nobody will say, let's have a vote to go back into the EU because nobody wants to admit they made a mistake, or why won't you have another vote?
Having had Brexit, so to take back a little of what I said, having had Brexit, the UK has a freedom in its economic policy and its trade relationships that it would not have had under Brexit. In the current environment, that could be an advantage if it takes advantage of it.
Okay. So right now, what do people think in England of the U.S. tariff policy?
They're worried about it. They're happy that, at least until the pause came, that they were at 10%, which was a lower number. And I think they're happy that they can negotiate that number differently from Europe, of which once they were part.
So today, would you say that the UK is feeling more aligned with the countries on the continent of Europe, or still more aligned with its great partner, the United States?
I think they see the long-run future for the UK as much better off with the alignment with the US. It's a special relationship. When I think about Barclays, we've been around for 330 years, and our U.S. relationship is very strong. Ben Franklin had an account with us.
For, I'd say, about a century or so, the reserve currency of the world was the British pound. And then the United States more or less replaced that, I'd say, after World War II, probably. But now the dollar is under attack a bit. We've lost 3% of our value from the peak. Do you think the dollar will remain the only reserve currency in the world? And are you as comfortable with the dollar as it used to be?
Absolutely. Actually, if you wanted to go further back, you could say it's almost after World War I, when the US had lent money to Europe and the UK for ammunition and so on, and then they had to get paid back in dollars, and that's when the strength of the dollar really began. So it's 100 years, 80 years, 100 years of dollar strength, so much so that important commodities, gold, oil, are denominated in dollars. Dollars are part of the payment system. When countries talk to each other, they represent their GDP and various figures in dollars. I think undoing that will take a long, long time. And, 3% in foreign exchange terms is not that much.
Okay, so you think the dollar will stay as the reserve currency of the
Absolutely.
time? So the main business of banks historically has been to lend money to people that need money. And that's still, I assume, your main business is lending money. So in recent years, the private equity firms and special organizations have been set up that are now called private credit firms. They lend money without the federal regulatory oversight that you often have. So do you feel it's unfair for private equity firms to be able to lend money without government regulatory oversight? Or do you think it's just a fair fight and you can win this fight?
First of all, let me say that I have unending respect for private equity firms and for their managers.
Particularly the founders. Right.
And the founders more than anybody else.
Right, of course.
Look, I think it's a fair fight. Credit has to be has to be available in the economy, and if people are willing to provide credit, so be it. Banks have historically provided credit, but banks have also for many years been, while originating credit, we've been selling the credit to other people and holders of credit. Private equity firms sometimes are buyers of that credit, sometimes they originate it themselves. If it ever rises to the point where it touches or creates in itself a systemic risk, then it's really important to regulate it. I don't think today it's at that point.
Okay. So what is the biggest problem that you face as CEO? Is it dealing with regulatory oversight of things in the United States, dealing with problems in England, dealing with other issues? What are your biggest problems?
So the biggest issue with a bank is that it is a very large part of the global economic system and of the economic systems in the countries in which it operates. So yes, you've got to obey all the rules and you've got to run yourself well because we are a critical part of national infrastructure. Safety and soundness is really important, and I spend a lot of time on that because that is basic. On top of that, you've got to adjust the way you run your business. You've got to construct it so that it's robust across different environments, and you've got to then run it to adjust to changes in those environments. And that keeps you on your feet.
As you look out on the global economic challenges the world is now facing, what are you most worried about in terms of the economic challenges?
So I'm actually taking a long view on this one. I think we've had 30 years. If you go for World War II, from 1945 to the mid-80s, you had one order in the world, a Cold War-induced order. China was out of it. And you had the East and the West. Then the Soviet Empire broke up. China enters the world system. The world becomes more integrated from the late 80s to, let's say, 2020. And now what you're seeing is a very different form of the world, which could become more separated. Multilateral institutions and relationships become bilateral. How that happens and what the role is for individuals, countries, governments, and companies in that is what I worry about. And it's not a day-to-day or month-to-month, but it's probably a few years. I thought I needed to try something different, and if I didn't do it, I would never do it. It is the best job I've had in my life and the hardest, most difficult job I've had in my life.
In case you missed it, on Bloomberg Open Interest.
Politics will drive the economy. Now the conversation is AI is driving the economy.
AI story and really the economy and inflation story will probably be front and center.
We saw the promise of ChatGPT. 35 million people are paying for it.
We have the ChatGPT versus the Google platform. Maybe there's pressure on the rest of the secondary and tertiary players in the market.
Don't miss Open Interest live every weekday.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Barclays is a bank that's started when? When is Barclays started as a bank in England?
1690.
1690.
330 years old.
Okay. And so it basically is a large retail bank in England,
yes,
more or less. But you have a big presence in the United States because, among other things, you bought Lehman, the investment banking part of Lehman. And I forget, you paid about $2 billion for it?
Approximately.
And it's worth a lot more now, right?
Yeah, I mean, our investment banking business makes us about £12 billion annually in top-line revenue.
So in investment banking, though, you're competing against J.P. Morgan, your old employer, Goldman Sachs, Morgan Stanley, among others. Is it easy for Barclays to compete against those other organizations?
It's a very difficult market, but Barclays has some unique skills. I think when we bought Lehman, we didn't just buy a business and we didn't just buy bankers and products and people. We bought a culture and mindset of investment banking, which was first rate. So while we're not as big in areas as some of these banks are, we think we're very good at what we do, and clients like working with us.
Let me ask you, where were you born?
I was born in Mysore, which is a small town in the deep south of India.
Okay, and what did your parents do?
So my father worked for the Indian government in the finance ministry. My mother was a homemaker, though I think she was smarter and better educated than he was.
And did you have siblings?
I have one sister.
Okay, and you must have been reasonably good in school because you went all the way from India to MIT, which is not that easy to do, I assume, in those days.
I was very fortunate, but whatever self-esteem I had, I lost within 2 days of coming to MIT.
Because you got there and you realized these people were really, really, really smart.
Yes.
So did you think they were as good as you thought they were going to be, or much better than you thought they were going to be?
Much, much better. And for a while, I thought I was much worse than I actually was.
Okay, so what did you major in?
So I was an applied math major, basically. I was an undergraduate, and I dabbled in computer science and economics and management science, operations research. And then I did a PhD in operations research, which is basically applied math, statistics, probability.
Okay, so you stayed at MIT, you got a PhD. All right, so after you get your PhD in applied math?
Yeah.
Okay. Did you say, I want to go be a professor in applied math, or do you say, no, I want to go do something important like go on Wall Street?
So I actually wanted to be a professor in operations research. I wanted to be a professor in a business school. I graduated during the first Bush recession, 1991. And finding a job was hard, so an academic job. So I ended up with a small consulting firm in Silicon Valley, where I learned a lot, but it became defunct fairly soon. And then 2 years or 3 years into it, I said, all my friends are in finance. Apparently, they use math in finance. I'd taken a few classes at MIT. So I applied for a job on Wall Street. I got one finally at J.P. Morgan, yeah.
Okay, so you went to J.P. Morgan. How long were you at J.P. Morgan?
22 years, 14 years in asset management, and the rest in the investment bank and risk.
Okay, did you ever meet Jamie Dimon?
I have had the pleasure, yeah.
And you'd think he was actually a good banker or not that great?
I think he's the finest banker of our generation.
Really?
Yes.
Okay. So at one point, after you're there for 22 years, you get an offer to go to Barclays Bank.
Yes. I had never thought of leaving J.P. Morgan. I got this opportunity to be Chief Risk Officer at Barclays. And I said to myself, I've been 22 years in an organization, a great organization, which gave me a lot of opportunity, which taught me a lot. And I thought I needed to try something different, and if I didn't do it, I would never do it.
All right, so you go over to Barclays in London, and what was your initial job?
I was the Chief Risk Officer of the bank.
All right, but eventually you became the CEO.
Yes, I did.
And how long have you been the CEO?
3.5 years now.
And is it more challenging than you thought, or not such a tough job?
It is the best job I've had in my life, and the hardest, most difficult job I've had in my life.
Okay, and you have children?
I have 3 daughters, yes.
And any of them want to go into finance?
Thankfully, no.
Okay, so today, how do you think fintech is going to change the world of banking in the next 10 or 15 years?
Well, I think what we've seen already is just going to be more of the same. You know, as you said, banks lend money, they store money, they move money, right? Now, that's important as part of your overall financial well-being. So the basic actions of, can I look at my statement, can I move money, can I can I do payments? Can I organize my financial life? All that is going to be done digitally. And the fintechs, frankly, have been beating the banks at it, and even lending small amounts of money. I think as people get wealthier and they want advice and they want to know whether it's an individual or a company, then you need the human being. And it's harder to see fintechs displace that.
Today, in Barclays, what is the biggest single challenge you worry about?
I care most that we keep customer service front and center. Because I think it's very easy when you work in a large organization to become abstracted from what the ultimate goal is, which is to serve your customers. You can spend your time on tech projects, you can spend your time on markets, you can spend your time thinking about the things that are proximate to you, but not proximate to the customer. That's what I always worry about. So we're living in this divide. But we continue to believe that ultimately climate change is something that is real.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Watch Horizon's Middle East and Africa every trading day at midnight Eastern Time. Only on Bloomberg.
Didn't really think I had a problem.
I would isolate, self-medicate.
Like 48.5 million Americans, they didn't choose addiction. Go to shatterproof.org/find treatment. Watch the film No More Secrets and find out how you can get help. That's shatterproof.org/find treatment.
So for people who are watching who want to know what they might do with their money, let's suppose people don't know about private wealth management and they're not really that financially sophisticated. What do you think the average person, middle-class person, should do with his or her money?
So I think if you're an average person, depending on your age, you should always keep in cash or something safe as much money as you need for a couple of months of your expenses, 2, 3, 4 months. Above that, you should have some amount in what we call fixed income markets, the bond markets. And the rest you should put in equities. And in all of this, the equities you do in an S&P 500 fund, and the bonds you can do in something like the Bloomberg aggregate, which used to be called the Lehman aggregate and the Barclays aggregate, and then cash in a bank.
So why should some young professional graduating from MIT or any college, Oxford, Cambridge, Harvard, any school you want to mention, why should they want to go into commercial banking? Why not go into something more exciting or sexy like private equity?
If you come into mainstream banking today, we're going through a huge technology revolution. We've got to do better in the way in which we interact with clients. I think if you like economics, and if you like the macroeconomy, and if you like helping businesses, small businesses, medium-sized businesses, large businesses succeed, then a bank is a great place to work because you learn about the inner workings of the financial system. Not that you don't in private equity, right, but a bank is a good place.
As you look back on your career, if you had to do anything differently, what would you do differently? Would you still stay at JP Morgan? Would you have gone to Harvard, not MIT?
Harvard is tempting, but only that. I'm very glad I went to MIT. I learned humility more than anything else. I think I would have learned more when I was younger about the technology of banking. I came late to it. And I would have learned more when I was younger. I grew up on the institutional side. And the institutional side can be abstract. You're dealing with interest rates and currencies and derivatives and so on. I would have learned more about the retail side to give me an appreciation that at the end of the day, it's about individuals, investors, retirees, company employees, whatever. I came later to that.
what is an area of great growth in the future that you think is going to be one that people like you should get into?
I certainly think life sciences and biotech. I think it feels very much that we're, even though we've seen so much in advances in medical technology, that there will be much more to come. I think parts of technology still in software and in hardware. And I think, by the way, sustainability and sustainability-linked technologies, they will be important in the long run.
So let me ask you about climate change. Many banks have adopted policies that were kind of to promote the idea that we should do something about climate change. Now the United States government seems to be not recognizing climate change. Has it changed your policies at all in the way you look at climate change, or you're not really that involved in that issue?
So look, we are involved in that issue. We're the largest investment bank outside of the US. So we've always had a presence in the US, including a presence in the energy business and the traditional energy business. There was a time early last year when we got banned from muni underwriting by the state of Texas, and the same week for being too green. And we got banned by Cambridge University in the UK, who was a 200-year-old client, because we were not green enough. So we're living in this divide. But we continue to believe that ultimately climate change is something that is real. We think that there will continue to be a growth in sustainable and renewable energy, and we want to be part of financing that. But we believe there's a transition. You can't get out of oil overnight.
Hey, another policy that is under some attack in the United States is something called DEI. Do you have DEI policies, and now have you had to change them, or because you're a British bank, you don't feel compelled to change your DEI policies?
So just a couple of weeks ago, we made adjustments to our policy in the United States and for our operations here. What we removed were specific gender and diversity related targets which we had for employees. So meaning X% of women in senior management positions and so on in the US. We've kept them outside the US, although we're looking at them. But, you know, Barclays has operated around the world for many, many years. We operate, and you've got to conform to local laws wherever you are. The laws in the US are changing. So we've got to comply with that, and that's what we're doing. But I think our eternal values remain the same, which is of inclusivity, of opportunity, of talent, and getting the best people from wherever you can get them. I came as a student from India. I came to MIT. I've had a career in finance in institutions in the US and in the UK. I valued that opportunity, and I would want to give it to anybody who came.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Some people travel to see the world. I travel to question the forces that shape entire nations.
Now, is it possible?
My name is Professor Hannah Fry. I want to meet the people with unexpected stories to tell and dig up the peculiar and wonderful treasures that reveal what a country is made of.
Yes.
Bringing you up to the minute news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Good morning. I'm Jumana Bersachi in Dubai, and here is what we're following this morning. President Trump says there's been a lot of progress in talks with Ukraine on a deal to end Russia's invasion. He hosted Volodymyr Zelensky at his Mar-a-Lago resort in Florida on Sunday. There was agreement on security guarantees, but the future of the Donbass region is still a major sticking point.
We had a terrific meeting. We discussed a lot of things. As you know, I had an excellent phone call with President Putin that lasted for over 2 hours. We discussed a lot of points, and I do think we're getting a lot closer, maybe very close.
We discussed all the aspects of the peace framework, which includes, and we have great achievements, 20-point peace plan, 90% agreed, and U.S.-Ukraine security guarantees, 100% agreed. U.S.-Europe-Ukraine security guarantees, almost agreed. Military dimension, 100% agreed. Prosperity plan being finalized.
Taiwan's Air Force has launched fighter jets after authorities detected 4 Chinese Coast Guard vessels approaching its waters. Beijing had said it would hold military drills around the island from Monday. Local media say the exercises will disrupt air and sea traffic. Beijing says the drills are a stern warning against Taiwan independence after the U.S. announced a major weapons package for the island. SoftBank is said to be in advanced talks to acquire Digital Bridge Group, a private equity firm that invests in assets such as data centers. Bloomberg understands that a final agreement is yet to be reached, and details, including the timing, could still change. SoftBank is trying to capitalize on soaring demand for the computing capacity, which underpins artificial intelligence applications. Major storms on both U.S. coasts are disrupting travel during the busy post-holiday period. Airports in New York, Detroit, Philadelphia, and Boston have been hit with heavy snowfall, with more than 1,600 flights canceled across the country. In California, heavy rain, mudslides, and flooding have led to road closures, while the Great Lakes region is facing hazardous travel conditions due to accumulating ice. And a look at how markets are faring. We are now open. The Stock 600 is barely up, about 9 basis points as it has just opened for trade. S&P futures down 0.2%. Silver plunging this morning, down 4% after a record rally, breaking through $80 per ton earlier on in the session. And then Brent, we have trading more positive as well, up 1.1%. 61.30 is where we're at, on anticipation of further fiscal stimulus out of China next year, but still on track for its 5th monthly loss. That was your recap, and this is Bloomberg.
I think fixed income makes a great investment choice. But our job as fixed income asset managers is to engage in that risk mitigation. And if I were the Fed, I'd start thinking about going ahead and lowering rates. I don't necessarily think success is about sharp elbows. It's really about creating a great team, to be thoughtful with regard to leadership.
While most sixth graders are simply trying to get through school, Ann Walsh, a self-proclaimed military brat, was already fluent in the language of business thanks to her father.
When I was in the 6th grade, my dad was also an investor, so we used to talk about business quite a bit around the dinner table, and I actually knew and understood bond math in the 6th grade. So I think it was predestined.
Walsh earned her accounting degree from Auburn University at the age of 19, and she soon found an opportunity to put her skills to use.
My first job out of college was at the Retirement Systems of Alabama. One of my first assignments was to monitor the private placement covenants. And it was one of those moments where I kind of went, I don't know what I'm doing, but this looks like I could benefit from having a law degree.
Walsh pursued an MBA at Auburn, then enrolled in law school at the University of Miami. She studied at night and worked full-time by day. Walsh took on roles in fixed income and insurance. In 2001, as CIO of Reinsurance Group of America, she crossed paths with the late Scott Minerd. At that time, she was a client of Guggenheim. A conversation with him eventually changed the course of her career.
One day I said to Scott, I'd like to switch gears. Would it be possible for me to come work with you and for you? He said, yes, Ann, but the Chief Investment Officer title's already taken.
In December of 2022, Minard passed away, leaving the CIO seat vacant. Walsh eventually stepped into that role. Today, she serves as the Chief Investment Officer of Guggenheim Partners Investment Management, the global investment management division of Guggenheim Partners. Walsh now oversees nearly $350 billion in assets. Walsh says the firm's investing philosophy is centered on minimizing losses, not chasing returns, especially when it comes to managing risk.
We are caretakers of our clients' money. At the end of the day, whether it's an institution, a pension plan, insurance client, they have policyholders, there's an individual whose money we're protecting and taking care of.
So let's go right to the heart of what the investment world is thinking about these days. The President of the United States, as we've talked recently, has been interested in having lower interest rates. Based on the data that you've seen, do you think it's a good idea now for the Federal Reserve to lower interest rates?
Well, I think there's two elements here. The Fed doesn't want to lower rates and appear to be kowtowing, if you will, to President Trump's language. On the other hand, I think there's actually room for them to lower rates. If you look at the Fed's Beige Book, which the Fed reacted to last year when they started lowering rates, I think there's room for them to take action now. And if I were the Fed, I'd start thinking about going ahead and lowering rates. Real rates are very high right now relative to history. And of course, we have a pretty significant term premium built into the term structure of interest rates right now.
So let's talk about the Fed's goal, which is 2%. Is that too low a rate to really get to at this point? And does it have to be at 2% or in sight of 2% before the Fed should lower?
They have a credibility issue right now. The Fed has to get to 2% because that was the target that they set. Although they've already started to project that they're willing now to target a range of inflation, which I think is the approach they should have taken all along. But they're going to get to 2%, and I think the trajectory is still in favor of the Fed's 2% target.
Are you worried that the annual deficit, which is now approaching $2 trillion a year, and the total indebtedness, which is over $36 trillion, might be too much to sustain this bill passing the Congress? Or do you think the debt is really not as big a problem as people make it out to be?
So I tend to be in the camp of when you incur debt, you end up having to pay it back. With the rise of modern monetary theory, which has become in vogue in the last several years, particularly in Washington, which is the belief that if you print money, if you have the reserve currency, you don't actually have to ever pay that debt back. And so mounting levels of debt and deficit spending are fine. I don't buy that. I think there's a point at which the U.S. government has to be able to sustain itself. Because the cost of interest is going up for the Treasury, all of this just continues to accumulate. I think it's very difficult for our friends in Washington to get to the point where they're going to be able to return to levels of spending from pre-COVID. But in order to actually get that trajectory to settle down in terms of the future levels of debt, they'd have to return to pre-COVID levels of spending. I don't see that kind of willpower in Washington, so I think spending will continue. I think that we're going to continue to see real significant issues amongst bond buyers, and I think that as a result, the term premium has definitely gone up because there's a sense of more risk in the U.S. as a result of all this spending. I'm of the camp, we need some fiscal hawks.
Are you worried about our reserve currency status, given the fact we have so much debt? And do you worry that in the end, we will not be able to be the only reserve currency if we continue borrowing at this rate?
My view on the reserve currency status is that there's not really an issue right now. I don't see another currency coming in to replace the dollar. 70% plus of all transactions are conducted in dollars. And I think that gives us a unique benefit for the U.S. government. And I think the government has to be thoughtful with regard to being responsible to U.S. Taxpayers, responsible to our position globally.
Guggenheim Investment Management manages equities and debt, but more debt than I think equities. Are you worried that private credit, which has grown very dramatically in recent decades or so, is something that should be regulated by the federal government?
What we've seen in the U.S. is a very significant shift in the capital markets over the last, we'll call it, decade plus. and that is a move from a more public market to more private. And you yourself would know certainly the movement towards private equity-owned companies. I don't think that's a bad trend. I've been personally involved, and Guggenheim has been, for decades in private credit. What it's done is expand. And I think private credit providers can be much more nimble and can be more responsive, particularly to these private equity-owned sponsors. But additionally, what we're seeing is a huge growth in the need for capital. And traditional providers of that capital, whether it's banks or the public markets, have been shrinking their participation with private capital stepping in. Now, the question about regulation. I know regulators, particularly bank regulators, had been concerned, and I think remain somewhat concerned with regard to how to address this because of the lack of transparency. Lack of transparency doesn't necessarily mean that those credit markets are bad. It just means that they're not necessarily quite so visible.
For the average investor who may not understand the fixed income world, if interest rates go up, that means that bond prices go down, because the theory is if interest rates go up, the previous bonds that were sold at a lower interest rate, therefore they're worth less. So today, though, for the average person who wants to invest in fixed income, should he or she say, well, interest rates may be coming down, bond prices might go up, I should wait a while, or should somebody say it doesn't make a difference whether you pick it now as the time to invest in fixed income or wait till later?
The fixed income markets are a very large and broad market. I think critically, you should be an active investor. And that means that avoid the passive vehicles in fixed income. Why do I say that? Well, that's because in fixed income, you have very little opportunity for upside, except as rates come down, relative to, say, equities, where you have this opportunity for prices to go up as well as go down. So what's the key aspect to fixed income management is risk mitigation. You want to avoid any kind of risk of loss, whether that's from rates or whether that's from default risk or downgrade risk. And so as a result, being an active investor is critical. That's the first part. The second part is that we do believe that rates will ultimately come down. We do believe that the Fed will ultimately continue its trajectory of lowering rates at the front end of the term structure for rates. So we think that's a positive. So as rates come down, prices will go up. And that will be across the board in all the different sectors, absent a recession, of course, which is not in our projection at this time.
Historically in this country, we have recessions roughly every 7 years or so. Do you foresee a recession coming in the next year or 2 or 3, or are you not that worried about it?
We've had a bifurcated economy. So those with access to capital, those at the higher end of the income earning spectrum, they haven't suffered. And so overall, what we've seen is a non-recessionary environment and a resilience to the U.S. economy. We anticipate that we're slowing down in the U.S., that what we're seeing from the Beige Book and other indications are that the market, where we would have seen the economy kind of on the boil in the past, that boil's coming off. And so as a result, things are slowing down. But we don't believe to recessionary levels at the aggregate. And so I think that's our expectation is we will slow down to below trend growth, but not fall into recession. Having said that, the tail risks are higher than they have been in the past, and there is a lot more volatility and uncertainty with that expectation. Our recessionary expectation is probably about 30–35% right now. One day I said to Scott, I'd like to switch gears. Would it be possible for me to come work with you and for you? He said, yes, Ann, but the Chief Investment Officer title's already taken.
Bringing you up-to-the-minute aerospace news whenever and wherever it happens. I'm Guy Johnson at the Dubai Air Show, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
So for those who may not be that familiar with it, fixed income or private credit, it basically you're putting up money with the expectation you're going to get your money back and a rate of return during that interim period of time before you liquefy your investment, right?
Right.
Okay. So let's suppose I say I have no risk tolerance. I don't want to lose principal. I just get the lowest interest rate I can. I want to get my money back. I should buy a treasury bill. Is that the safest thing theoretically?
So you've just hit on something that's really important, and that is the fundamentals of the way Guggenheim thinks about fixed income and, frankly, investing in general. We are one of the few, if not the, home of behavioral finance. So Dr. Danny Kahneman, who's really the father of behavioral finance, and he wrote a book, Thinking Fast and Slow, really brought to light about how investors perceive risk. And so to your question, what does an investor do when that's the way they think about risk? Well, I think fixed income makes a great investment choice. But our job as fixed income asset managers is to engage in that risk mitigation. All the tactics that are necessary in order to ensure that we are minimizing risk for our investors.
Let's suppose I'm a risk mitigator. I don't want to take any risk. Right. I want to get my money back. I want to buy a treasury bill. What kind of return am I going to get on a treasury bill?
Well, right now, you're getting over 4%.
4%,
so
okay.
That's not bad for a very short-term, no-risk investment.
Well, let's suppose I say I have a great confidence in the U.S. government. I'm willing to buy a 30-year treasury bill. I'll get my principal back in 30 years. What kind of interest rate would I get for that?
Well, right now, you're getting 5%.
Let's suppose I say I want to buy a treasury bill, but Guggenheim, I assume, like most money managers, charges a fee. Why don't I just go down to the U.S. Treasury Department, and when they have an auction, I just show up and say, I want to buy a treasury bill. Why do I need an investment manager to get me a treasury bill?
Well, that's because we're not going to invest just in treasury bills. We're going to invest in all those other aspects of the fixed income market that add value for our investors.
Okay, let's talk about how you became an expert in this area. So where did you grow up?
My dad was Air Force, so I kind of grew up a lot of different places and a bit of a military brat. But I spent a lot of time in Washington, D.C. in the suburbs.
And when you were a little girl, did you say, I want to be a fixed income money manager?
Well, it's funny you should ask that question. When I was in the 6th grade, my dad was also an investor. He was an accountant by training. And so we used to talk about business quite a bit around the dinner table. And I actually knew and understood bond math in the 6th grade. So I think it was predestined.
Okay. So where did you go to college?
I went to Auburn. I was an accounting major.
Yeah. Okay. Then you got an MBA as well?
Yes.
After that, you went to get a law degree. Now, usually lawyers get a law degree, and then they say, I really want business. Then they go to get an MBA. It's rare that somebody says, I'm in business, I know business, I have an MBA, and then they want to be a lawyer. So how did you come to that pattern, which is unusual?
Purely by happenstance. So my first job out of college was at the Retirement Systems of Alabama. One of my first assignments was to, I'm going to put this in air quotes, monitor the private placement covenants. And so at that time, because there wasn't a computerized system, the idea of computers were to walk me into a room full of closing binders and a rolling library of these, open the big book on a desk and say, now here's the covenants, go monitor them. And it was one of those moments where I kind of went, I don't know what I'm doing, but this looks like I could benefit from having a law degree. And so ultimately, that's what drove me to the decision to go to law school.
But you were working, you had a job, and then your family say, you're making a living now, you're going to give that up to go to law school, and who's going to support you when you're doing that?
I didn't give it up. I actually went and got my MBA and my law degree while I worked. So I did those at night.
So after you get your law degree, what did you do next?
So I went to and remained still in investing. So I've been in the investments world 41 years with no breaks, so continual. And I went to work at what was that time called American Bankers Insurance Group, and I became their head of investments when I was 21, actually, and managed their portfolio.
And when were you recruited to come to Guggenheim?
So Scott Minard, who was the chief investment officer, and I met in about 2001. I became a client through my predecessor employer, Reinsurance Group of America, and I was the chief investment officer there. And we had a reinsurance treaty with a client of Guggenheim's. And so Guggenheim was appointed the asset manager. That's how I met Scott. And I was able to be a client for about 5 years when one day I said to Scott, I'd like to switch gears. Would it be possible for me to come work with you and for you? And he said to me, I remember this, he said, yes, Ann, but the chief investment officer title's already taken. So of course, that's been a long-standing joke between he and I at the time. And, but no, we worked together until his sad passing 2.5 years ago.
Guggenheim was started when?
So Guggenheim was originally, I think, the family home office, but in its current form was basically founded in 2000.
And so the asset management function is the biggest part of Guggenheim today?
Yes.
So Guggenheim today is a privately owned firm. It's not publicly traded. Does it have any plans to do anything different? Or as far as you know, it's basically going to stay as a privately owned company?
Absolutely.
Your client base, is it institutions or individuals or both?
Both. Both. We have retail mutual funds, we have high net worth separately managed accounts, we have institutional clients. We like to meet our clients where they are and being able to provide our strategies to them. We are caretakers of our clients' money. At the end of the day, there's an individual whose money we're protecting and taking care of.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, yet ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars.
Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
I haven't interviewed that many chief investment officers of gigantic investment firms like yours who are women. Now, when you got into this business, were there very many women who were rising up to become chief investment officers of multi-hundred-billion-dollar investment organizations?
I can't say that there were. We were quite rare. In fact, up until very recently, when you looked at the number of portfolio managers that were women, only a few years ago it was about 10%. Now at Guggenheim, we have about 30% of our workforce is female. And that actually is at the higher level. So we have a long way to go to get to the point where women will be able to advance into chief investment officer roles.
So if somebody is graduating from college today, male or female, and he or she says, I like the fixed income world, is that a good career for somebody? Would you recommend to somebody they get into the fixed income or the private credit world as an investment manager? Or would you say go into something like private equity?
I think this is a very, very solid investment career or career for any young person. A couple of reasons. Very importantly, we are caretakers of our clients' money. At the end of the day, at the end of every investor, whether it's an institution, a pension plan, insurance client, they have policyholders, there's an individual whose money we're protecting and taking care of. We are caretaking their savings, whether they're saving money for retirement, whether they're saving money for their kids' college, whatever. And so that's very important. It's very purposeful. Our particular management style is one that's very team-based and collaborative. And in that way, it makes a wonderful career for young people, and particularly young women, who want a collaborative workforce opportunity, and they also want a purposeful career.
Now, in the investment world today, there's been a push to get people to come back to the office, to actually be in the office physically. Do you require all of your employees to be in the office, or you can do it on the screen? It doesn't make much difference in your business.
So at the end of the day, this is a people business. Our mission is to serve our clients. The best way we can do that is to be together. It's also important because generationally, I mean, I've been in this business 41 years. I suppose I could work from home pretty easily. I know what I'm doing. But I wouldn't be transferring my knowledge to young people that way. It's not as convenient. It has to happen day in and day out as our younger people are observing the behavior of our more senior team members. And that interaction is very important, and it has to be done in person.
Now, in recent years, parents who want their children to get jobs in the investment world obsess over having their children be a STEM major. Suppose somebody applies for a job at your firm and says, look, I'm a philosophy major, I'm an English major, I'm a history major. Does that person have any chance of getting hired?
Oh, absolutely. I really look for characteristics relative to hiring to a resume. Critical thinking, intellectual curiosity, grit. This is an industry where you're going to work hard and you're going to work a lot of hours. And that's okay, but that's the person and that's the set of characteristics that I'm really much more interested in.
If I had $100,000 and I came to you and said, what should I do with it? What would you do with $100,000? You recommend it to somebody else?
Right now, because of all the volatility in the economy and in the world, I would say a diversified portfolio with $100,000 is the way to protect against risk and to provide the kind of return. So I would have a little bit of everything in there. Fixed income, again, with a knowledgeable manager. Equities, because I think the equity markets will continue to be solid, if not without some volatility, of course. I throw in maybe a little bit of Bitcoin, interestingly enough, maybe a small amount just for speculative holdings, and just create a very diversified portfolio against the risk.
So what would you say are the most valuable lessons you've learned as an executive on a Wall Street firm?
I think you have to be humble, because investing through cycles means that you're going to make some mistakes and you're going to learn some very important lessons. And to be thoughtful and not to have knee-jerk reactions to or overreact to too much volatility, news headlines, really separate the signal from the noise, and to be thoughtful, because these cycles will come and they will go. But to remain thoughtful and a long-term investor, those are the ways I like to think about risk and managing through all the different timelines that we are going to continue to invest in.
To succeed in Wall Street, most people would think on the outside you need to be tough, you need to kind of go after your competitors, you need to really be a difficult personality. What does it really take to succeed in Wall Street?
I don't necessarily think success is about sharp elbows. It's really about creating a great team, to be thoughtful with regard to leadership, to have a long-term view, to work really hard. This is a business where it's important to be dedicated, and I think that's the elements to success. All the other ones, which are table stakes, intellectual curiosity, critical thinking skills, understanding the markets, having great analytical skills, that's all table stakes. But it's how you do what you do that makes the difference. And I believe that, as much as anything else, is creating a great team, and ultimately great results will come from that.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Good morning. I'm Joanna Bersacci in Dubai, and here's what we're following this morning. President Trump says there's been a lot of progress in talks with Ukraine on a deal to end Russia's invasion. He hosted Volodymyr Zelensky at his Mar-a-Lago resort in Florida on Sunday. There was agreement on security guarantees, but the future of the Donbass region is still a major sticking point.
We had a terrific meeting. We discussed a lot of things. As you know, I had an excellent phone call with President Putin that lasted for over 2 hours. We discussed a lot of points, and I do think we're getting a lot closer, maybe very close.
The U.S. president will meet the Israeli prime minister in Palm Beach, Florida, later today. Tensions between them have been rising, with Trump previously warning Israel not to undermine his peace efforts. They're expected to discuss the second phase of the Gaza peace plan, as well as Iran. And China has pledged to expand government spending and improve how it deploys capital in a bid to boost growth in 2026. The government will focus on better targeted fiscal policy, spending more on advanced manufacturing and tech innovation. It highlights the fine line Beijing is walking between buffering the economy against external headwinds and preventing a domestic debt crisis. And in markets today, we are open for trade for European indices, but trading slightly underwater. Same for the S&P futures. Silver pulling back from all-time record highs, down 4.4% today, and Brent also trading at around 61.3, up 1.1% on that talk of China fiscal easing. Also of note today, defense stocks taking a bit of a tumble. This has been a major outperformer for European markets for most of this year. Today, the likes of Leonardo and others down anything between 2 and 3%, perhaps some profit taking into the end of the year. That was your recap. This is Bloomberg.
I think that AI, probably for the next decade or two, if not longer, will be the most important technology. I think the biggest mistake is always emotion. Stocks are very easy to transact, and therefore, human emotion comes into play in a way that it doesn't in any other form of investing.
The GameStop short squeeze of 2021 is remembered by many investors as a wild phenomenon. But if you're D1 Capital Partners founder and chief investment officer Dan Sondheim, you would call it the worst 2 weeks of your career.
I was holed up in my office at home. It was like a patient in, it was quite intense.
D1 had taken a short position in GameStop, betting the stock price would fall. Everyone knows what happened next. Retail investors, people who don't invest professionally, bought the stock in droves, encouraging peers to do the same. The stock soared in value, and Sondheim's D1 was one of the professional shops that took a short-term beating.
I hadn't ever failed before in that kind of a way.
Before GameStop, Sondheim's investing career was a straight upward trajectory. After a few short years in investment banking, the Wharton graduate entered the hedge fund world at Viking Global Investors, where he would stay for 15 years.
I started out as an analyst covering banks, and over time I picked up every other sector and became co-CIO and then CIO.
And then in 2018, Sondheim struck out on his own with D1.
He was inspired by the phrase day one, which Jeff Bezos refers to a lot, and how he thinks about Amazon.
On day one, Sondheim opened the doors with $5 billion of raised capital. Today, D1 has $23 billion of assets under management. As for the GameStop saga, the years have provided Sondheim with some perspective.
Dealing with that kind of adversity and coming back from it is what I'm most proud of, because that was the most challenging part of my career.
Many people in the investor world are worried about the impact of tariffs and what it will do to the markets. Is that a concern you share, or do you think the tariffs are not as big a problem as some people are saying?
I think it really depends on how significant the tariff rates end up being. I think the market is implicitly assuming right now that tariff rates won't go through anywhere near the rates that are being talked about, that it's more of a negotiating stance than it is a real outcome. If they were to actually play out and the actual tariff rates were what Trump is suggesting currently, it'd be a very big problem.
What about inflation? That's been a big problem for the last couple of years after COVID. Are you worried about inflation anymore, or do you think that's largely under control?
Largely under control. I don't believe tariffs will be inflationary on an ongoing basis. It's a one-time step up in prices, probably offset by some demand destruction.
What about a recession? We haven't had a recession for quite some time. Historically, we have one every 7 years in the United States, and we haven't had one really for a while.
Yeah, we're always worried. I mean, I think that the chance of recession at any given time is dependent upon where you are in the cycle, what's happening from a fiscal perspective, what's happening with monetary policy.
So if you're going to look at a stock to buy, a company to buy, you tend to look at it for a month or 2 or 3 before you complete your research?
It usually takes us, if we've never looked at the company before, most companies we do have looked at in the past, but if it's a new company, it'll probably take us 3 to 4 weeks.
And when you're doing that type of thing, do you actually talk to the CEO sometime, or how do you deal with not getting inside information?
Yeah, we try to talk to the CEOs of every company we invest in, and we have compliance, our general counsel, and most public companies are already pretty aware of what they can say and what they can't say, so it's not a big issue.
So you are one of the few, but not the only large firm of your type that not only buys stocks of this type, but also shorts them. Mm-hmm. Shorting is a more complicated business in many ways, unless you're really hedged. Why are you comfortable doing shorts?
I started out in the business. I got my first job because I wrote up a short report. I like shorting stocks. I find it intellectually challenging. And from a business perspective, there are a lot of people who are talented at buying stocks. There are fewer people who are talented at shorting stocks, or perhaps fewer people who have the desire to short stocks because it is more difficult and more stressful and less profitable over time.
So you were involved in a very famous short that didn't work out quite so well, called GameStop. Is that right?
Correct.
It seemed as if somebody was manipulating something or another so that a company that maybe should have been shorted all of a sudden became a heroic gainer. How do you deal with something like that?
Painful. That was the toughest few weeks of my career, and I'm hoping that that period of time will be the toughest going forward. Unfortunately, we had never seen shorts go up 300, 400% in 2 weeks. It wasn't in, even a 5 standard deviation move based on history. No one had ever seen that. So from a risk management perspective, we just weren't prepared for that. And we ended up taking off the positions at the worst possible time, knowing it was the worst possible time. But if it had gone on for another couple weeks, it was that painful and that damaging that we had to do it.
So in the hedge fund world, when you take a position, let's suppose you take a long or short position, and it moves against you almost in the beginning, do you say, I made a mistake, I'm getting out of here? You say, I know more than the market knows, I'll wait a month, I'll wait 2 months, I'll wait a year. How long do you wait before you say the market knows more than you know?
It really just comes down to the research. If sometimes stocks move and they move for a reason which is driven by fundamental changes in the business, in which case we have to reevaluate our thesis and perhaps change our position. If the stock is, but oftentimes stocks move irrespective of what's happening in the business or the fundamentals. And in that case, that's more of an opportunity to double down on an investment.
And today, when you are making investment decisions, is it a team effort? You have a consensus in your organization? Suppose somebody says, I just disagree with this, and the other people don't agree with that person. Can one person hold up something other than you, or you're the only person who can hold up an investment from being made?
I mean, we don't necessarily have layers of people approving or not approving of investments. We have a collaborative culture where we all sit down and talk about it. And it's okay if some people are, usually it's not about hard disagree or hard agree. Usually it's gradations of this is an amazing investment or it's okay. And ultimately it's my job to listen to all the different opinions and come out with a conclusion.
So in the business you're in, when you say an investment is okay or good, you were looking to get a rate of return, let's say annualized of 20% a year when you're all said and done, or higher than 20% a year, or 15% a year? What are you looking for when you say, I'm going to go ahead with this investment?
It depends on the risk profile of the company, but in a large cap, high quality company, 20% over 3 years projected IRR would be sufficient. If you're taking more risk because the company's products are earlier or has more leverage, you're going to be demanding IRRs that are closer to 30%.
So you've been a big investor, as I understand it, in SpaceX.
Yeah. So
SpaceX is a private company. Many times hedge fund people buy publicly traded stocks or they short them. They don't do privates as much because it's a different game, really. But you do publics and privates, and SpaceX is a company you're invested in, right?
Correct.
And it turns out to be a pretty successful company based on private market valuations, I guess.
Yeah.
Were you in there early?
We first invested probably 6 years ago.
So the valuation now is probably, I don't know, a couple $100 billion.
350. Yeah.
350 billion is the last round they raised. Okay, and it was up. Before that was like 175 or something like that. So you were in well below that. So
yeah,
pretty good
approximately
position.
30 or 40 billion dollars are probably where our entry point on a weighted average basis.
So in something like that, do you get concerned when the person who's the CEO of it or the founder of it is in the government and not running the company? Or I know they have a very good number two, but is that a worry or not so big deal?
It wasn't a concern for me. Look, I think that Elon's obviously, a generational talent, and I wish he spent all his time at SpaceX.
Right.
But he also has built up an amazing team that is quite capable of running the business day to day. And where he, I think, where he excels is stepping in and solving problems, not necessarily being there day to day to manage everything.
So I think you've been a big proponent of artificial intelligence as something that's really going to change the world. Do you invest in small companies that are in artificial intelligence, or you go to the well-known names in artificial intelligence? What's the best way to invest in artificial intelligence and make money?
The best way it's hard to say the best way. I would say the way that is most aligned with our business model is we've invested in OpenAI and Anthropic, which are two of the leading large language models. But I do think over time, there will be investment opportunities in many, many more companies driven by AI.
But you don't go look for the next young Anthropic or something like that. That's not your game, which is venture capital.
We don't go really early stage and try to compete with venture capital firms to invest in companies in the first year or two of their life cycle. We tend to invest when they get more mature.
Are there things beyond the internet and artificial intelligence do you think are the next technological waves that are going to merit your investing in them? So quantum computing or something like that?
Yeah, I think that AI probably for the next decade or two, if not longer, will be the most important technology. But just like the internet, you'll see other things that evolve because of AI, like robotics, biotech innovation. I think you'll see a lot of things driven by AI that are technological revolutions in and of themselves. Look, we never rest on reputation. I like to go out and meet clients, tell the story. Once clients get to know us, and the better they know us, the better the relationship is.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
In case you missed it, on the pulse.
Distinguish between companies that are here because they're running international operations, the companies that are indigenous and working with the citizens of the UK, and make sure you get the regulation strategies right. With the rule of law and the great city that London and the great country that UK is, there's a plenty of upside.
What do you tell the Prime Minister?
I tell them to make sure the regulation's fair, be the best place for a non-UK based company to operate, and you'll get companies coming here.
Don't miss the pulse, live every weekday.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
talk about how you started this firm and how it's grown to be quite successful. So let's go with your background. Where were you born?
I was born outside of Philadelphia.
Okay, and what did your parents do? Were they in the investment world?
My father's a doctor, he's an internist. My mom is an occupational therapist by training. But my dad spent most of his time outside work investing. So I grew up around stocks.
And you always knew you wanted to be in business, so that's why you went to Wharton, I assume?
Correct.
And how did you find Wharton? The people were smarter than you thought or not as smart as you thought?
I was intimidated when I went because I came from a public school where I think we had 450 people who graduated and 2 went to Ivy League schools, including me. So, you know, my going in assumption would be that everybody there would be better prepared and smarter than me. I think that, you know, at the end of the day, the people were impressive. But, you know, I felt that the education I got was sufficient. And, you know, when I left, I didn't feel like, you know, I was in a worse position than anyone else.
Some people that go to Wharton get a joint degree, they get an undergrad degree, and they get an MBA almost at the same time. You got an undergraduate degree, and then you went into the business world?
I went right into the business world.
And where did you go?
I went to Bear Stearns. I started out in investment banking, and then about 2 months into it, I moved into a group that did private equity within Bear Stearns.
Hey, and you did that for how many years?
3 years.
And then you left for a firm called Viking?
Correct.
Now, Viking was a so-called tiger cub, and it was a firm that was set up by Julian Robertson, one of his proteges, and you were there for how long?
15 years.
15 years. It's a long time to be at a
long time
firm.
in a hedge fund, yeah.
Okay, and you rose up from the very bottom to the chief investment officer?
I started out as an analyst covering banks, and over time I picked up every other sector and became co-CIO and then CIO.
Hey, when you're the CIO of a firm like that, you're responsible for everything. So did you do stocks, bonds, macro, or were you mostly a stock person?
We Viking and D1 are primarily focused on fundamental research in equities.
So where did you get the name D1 Capital Partners?
It was inspired by the phrase day one.
The U.S. markets. We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily. Every business day at 2 p.m. Eastern, only on Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
So young students often say, I want to get a job at a place like D1 Capital Partners or a place like that. I need to major in a STEM subject in order to get there, because if I'm not majoring in science, technology, engineering, math, I'm never going to get hired, so I can't major in English or history. Do you only take people who majored in STEM subjects, or do you take people who major in other things, or does it make a difference?
Doesn't make a difference. I would tell you that increasingly I have found that there are tons of people who are very good analytically, people who are good communicators, especially written. It's harder to find. So I would say that we are indifferent to what people major in, but we do care that somebody is both analytical and quantitatively competent, but also is a good communicator, because in our business, you have to make the case for an investment, whether it's verbally or written. And if you can't do that, you're going to have a hard time.
So in your long history as an investor, what's the best investment advice you ever received?
I think the best investment advice probably came from indirectly from Warren Buffett. And, it was when he talked about his evolution as an investor, where he started out buying cigar butts at 50 cents on the dollar, and then eventually coming to the realization that the best way to create value is to buy great businesses at fair prices and then let them do the work for you by compounding value. That was probably the best advice, because when you start out investing, you start out with a very quantitative approach, and you're looking for things that are just like trading well below fair value. I think the idea of identifying and then buying great businesses that may be trading at closer to what people perceive as a fair value, but over time will compound value, was a change in mindset that was important.
So what do you think the most common mistake that investors make is? That's the average investor, not a famous hedge fund person. What's the average person's biggest mistake, would you say?
I think the biggest mistake is always emotion. When you own a home, if your home goes down in price, you don't wake up that morning and get scared and fire sale it. You don't do that with any asset you own. But stocks are very easy to transact, and therefore human emotion comes into play in a way that it doesn't in any other form of investing. So I think people make mistakes both in terms of greed and fear, and it's mostly driven by different emotions.
So for somebody who's a young investor who's starting out in his or her career, just as you were 20 years ago, what advice would you give them about how they might start their own firm or their own career?
I think starting your own firm in this business is very difficult and usually a mistake because you only get one shot to start your own firm. And if you fail, it's hard to do it again. So I would suggest start out by reading as much as you possibly can of whatever, if you're interested in fundamental investing, as I said, I think Buffett's fantastic. If you're interested in other forms of investing, I think reading is the best thing to do. And then go to the best firm you can and learn working for people that have done this for a long time. This is the kind of job that you're always learning. I learn every day. And so for anyone to think that they can start their own firm without any experience, I think is the wrong risk reward.
When GameStop was going on, did you find your friends looking at you differently, or do they call you all the time and say, how are you doing, or is it a different kind of way you were treated or not?
I mean, it happened in a period of 2 or 3 weeks, and no one was looking at me because I was holed up in my office at home. I was getting calls, more kind of people trying to inquire what's going on, how bad is it, but generally people kind of kept the distance because it was, it was like a patient in, it was quite intense, and that period of time though was about 2 weeks. And then we closed out the positions, and that was also very, very painful. We had to deal with it afterwards. Then we had another setback in 2022, and I kind of think of both of those as being, a period of time where, there were just a lot of challenges for our business in particular, and we had to make a lot of changes. So coming back from that was difficult. It required us being very introspective about what we did wrong, what we had to do to fix it, and then, pushing ahead and putting one foot in front of the other.
So one final question. So as you look back on your career, very impressive career, what are you most proud of having achieved so far? And if you could live your 25 years, let's say, over again, what would you do differently?
Yeah, I think, look, I am most proud of, for a long part of my career, there was very little adversity. I joined Viking, and it was, we had 15 years of just, obviously there were periods of time when things weren't as good, but there was no real adversity. After starting D1, about 3 or 4 years after starting D1, we had several periods of pretty intense adversity in the investment part of the business. And you brought up GameStop as being, one event, then 2022. And for me, dealing with that kind of adversity and coming back from it is what I'm most proud of, because that was the most challenging part of my career. I hadn't ever failed before in that kind of a way. And so learning from that, getting better, and coming back from that is what I'm most proud of, and probably was the most difficult thing I've had to do.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. I'm Joanna Versace in Dubai. Here is what we're following this morning. President Trump says there's been a lot of progress in talks with Ukraine on a deal to end Russia's invasion. He hosted Volodymyr Zelensky at his Mar-a-Lago resort in Florida on Sunday. There was agreement on security guarantees, but the future of the Donbass region is still a major sticking point.
We had a terrific meeting. We discussed a lot of things. As you know, I had an excellent phone call with President Putin that lasted for over 2 hours. We discussed a lot of points, and I do think we're getting a lot closer, maybe very close.
We discussed all the aspects of the peace framework, which includes, and we have great achievements, 20-point peace plan, 90% agreed, and U.S.-Ukraine security guarantees, 100% agreed. U.S.-Europe-Ukraine security guarantees, almost agreed. Military dimension, 100% agreed. Prosperity plan being finalized.
Taiwan's Air Force has launched fighter jets after 4 Chinese Coast Guard vessels were detected approaching its waters. The Chinese military is conducting exercises around the island, which Taiwan has described as irrational and provocative. Beijing says it's a stern warning against Taiwan independence and is necessary to protect China's sovereignty. Copper has barreled towards a record $13,000 a ton on the London Metal Exchange in a stunning end-of-year rally. The metal surged more than 6% when trading resumed after a 2-day public holiday in the UK. Copper made big gains in December as investors bet that a rush to get imports to the US ahead of possible tariffs would force buyers elsewhere to pay more. Major storms on both U.S. coasts are disrupting travel during the busy post-holiday period. Airports in New York, Detroit, Philadelphia, and Boston have been hit with heavy snowfall, with more than 1,600 flights canceled across the country. In California, heavy rain, mudslides, and flooding have led to road closures, while the Great Lakes region is facing hazardous travel conditions due to accumulating ice. And a check on markets. We are open for trade in Europe, but dipping a little bit. The Stock 600 down 0.1%, S&P futures down 0.3, but still coming off very close to all-time record highs for the S&P. Silver plunging today, down 5.6%, pulling back from record highs there too, and a massive run-up into today. And Brent 61.50 is where we're at, 1.6% firmer on the session. Let's take a deeper dive into defense stocks as well, because what was one of the outperforming sectors in Europe today is seeing a bit of profit taking going through. Leonardo down almost 4%. Other names in the space as well down anything from 2 to 3% as well. That is your recap. This is Bloomberg.
I think all investing is value investing, and if it isn't, it's either gambling or speculating. An investor should recognize that the biggest threat to their generating a return over time is their own behavior. I have the patience to be out of favor for a decade, but I love the idea that my thoughts and ideas are right, and I have the patience to let them unfold.
In a classic American story, Chris Davis followed his father and grandfather before him into the family business. It just so happens that family business is a $20 billion investment firm, Davis Advisors.
Both my grandfather and father loved what they did, so that has a huge influence on a kid.
Chris's grandfather, Shelby Davis, began investing in insurance stocks in the 1940s. He turned an initial investment of $100,000 into more than $800 million by the time he left the business in the 1990s.
He talked to people about this concept of owner earnings, that, don't just look at the reported earnings, look through at what the business, if you owned the whole business, the value creation.
As the third generation Davis to run the firm, Chris still uses his grandfather's value investment approach.
That's sort of the core of what we do, making an assessment about what the value of the business is, generated by the earnings of the business, rather than by a prediction about changing psychology or being lucky.
Chris is militant about his discipline of investing, in which a company's fundamentals are paramount.
In a sense, we always say we're value investors because the valuation discipline is so central to us, but we want to own businesses that we can own for a decade or longer.
In addition to his father and grandfather, Chris had another value investor as a mentor, the late Charlie Munger.
Outside of my family, Charlie mattered more to me than any mentor that I could think of. He had made a huge difference, both as somebody that taught me a lot about investing and business, but also taught me a lot about life and wisdom.
He even has a bust of Munger in his office.
Charlie Munger once said deferring gratification gives him so much gratification that he's not sure he's actually deferring it.
And that patience is still a hallmark of Chris's investing style.
I don't mind that patience to let the value of the business appear over time. I don't need it all at once. I don't need the big payoff.
Tell me what a value investor really is.
Well, I think value investing is a redundancy. I think all investing is value investing, and if it isn't, it's either gambling or speculating. And if it's gambling, that means you're putting up money for something that has a negative return expectation, but you feel lucky. All the rest does is about investing. You're putting up money with the expectation of getting more in the future, and that expectation is based on an assessment of the cash flows and the probability of that assessment being validated. So that's sort of the core of what we do is in a sense, making an assessment about what the value of the business is generated by the earnings of the business rather than by a prediction about changing psychology or being lucky.
But most investors would not describe themselves probably as value investors, so you're saying most investors are really buying some future anticipated earnings that they hope will be there but may not be there today.
Yeah, or often people make a distinction between growth investors and value investors. And I would say that does is a strange distinction because a company that grows profitably is more valuable than one that doesn't grow. So growth is a component of value. What I would distinguish from is momentum investing, and maybe that's been a big characteristic of the market in the last 10 years. The idea that because something is going up, it's likely to continue going up, so I'm buying it without regard to the underlying value of the business, but with an idea that somehow this pattern will continue.
So today we have the Magnificent Seven, so-called. Do you regard stock purchases of those stocks as value investing or momentum investing?
Well, a little bit like when FANG was popular or BRICS, and people come up with an acronym. They think the Magnificent Seven. But each one of those businesses has totally different business models, different prospects. They just happen to all be in favor at the moment. And I think the way to think about it is that when you get the valuations getting higher and higher and higher, you think about what would have to happen for you to earn a 10% return if you bought the whole business. And when you start breaking each one of those businesses down, what you find is there's some of them where they would have to grow, 20% a year for a decade. They'd have to maintain margins above 50%. And when you look at how many companies have done that in history, I think it's 0.1% of companies in the S&P 500 have kept margins above 50% for more than a decade.
But if what you say is true, most people who are buying stocks are not really value investors, right?
Well, I think that there's a whole category of people that get excited because stocks have already gone up, and then they want to jump in. So in a sense, they're what I would call momentum investors, but they aren't really value investors. Stocks have this peculiarity that they're the only asset where somehow the more the price goes up, the more people want to buy them.
So if a stock is, let's say, like NVIDIA, very highly valued stock company, or even Apple, which used to be very highly valued, still valuable, but not quite at the same multiple it once was, you would say those are not value investments, though Warren Buffett did buy Apple.
Yeah. What I would say is that in order for NVIDIA to be worth what it is, you have to extrapolate the durability of their competitive advantage way into the future. And if you think about the early days of the internet, we all knew who the winners were, right? It was Cisco, it was AOL, it was Yahoo. Those were the three titans of the internet. And in the early days of a transformative technology, people are very anxious to identify the winners. But remember, Google wasn't public yet. Amazon had, gone up to 80 and collapsed down to about 6. Meta, then Facebook, I don't think had come public public yet. So there was a huge amount of speculation about who the winners of the internet were going to be before it was ready. Now, there's speculation today that NVIDIA has won the AI game, that the future of AI will be driven by NVIDIA in the same way the PC was driven by Intel, let's say. So it's possible that that could happen, but it needs to happen to justify the current valuation. You need growth for a decade to come. You need to sustain high margins. And in a company like NVIDIA, where we admire them very much, and obviously I have some sour grapes because I missed it, but I think that I think you have a lot of their customers who are going into their business, trying to design their own chips. You have a fabricator, TSMC, Taiwan Semi, that in a sense the only company on earth that can make their chips. So Porter's forces would say that there's a lot of pressure on that going forward.
Your view on the economy now with tariffs as something that the president wants to impose, as inflation is still not completely under control, are you worried about a recession in the near term?
Well, I'm certain we're going to have a recession. I'm just not sure when. And that's a big part of our mindset is if we're buying a business that we're going to own for a decade, we know we're going to own it through some sort of shock in the system. What we sort of say is we can't predict, we can prepare. We have to be prepared both for the sunny days where we'll make a lot of progress, but also to withstand the storms. And trying to predict the timing of those and reposition your portfolio, we think is a dangerous game.
So you're on the board of Berkshire Hathaway. Do you give any tips to Warren Buffett about value investing, or you mostly learn from him?
What's so amazing about Warren, and really Warren and Charlie, is in addition to being, maybe the greatest practitioners of all time of this art of value investing, they also both were dedicated teachers and talented teachers.
Now, in your office, you have a bust of Charlie Munger, so you must obviously admire him. Did you have a special relationship with him?
Yeah, I mean, outside of my family, Charlie mattered more to me than any mentor that I could think of. He was, I met him when I was young enough. He had made a huge difference, both as somebody that taught me a lot about investing and business, but also taught me a lot about life and wisdom.
Warren Buffett used to say, I'd like to buy something for 50 cents that is really worth $1. And Charlie Munger said, well, if you buy something for 50 cents, you want to make sure that it's going to be a company that could be worth many, many dollars in the future. So you should buy at a discount things that are really going to improve and get much more valuable, as opposed to just buying something cheap. It might stay cheap. Is that in essence what they talk about?
Well, it's something that really connects to sort of the way we invest here, which is this idea that, you want to buy something that is an attractive value, but if that underlying business has durability, high quality, resilient growth, it's so much more valuable because of just the nature of compounding over time. So if you think of buying that $1 for 50 cents, well, imagine if that $1 is growing 15% a year, then it may be worth paying 75 cents for that $1 because it has the ability to grow. So in a sense, we always say we're value investors because the valuation discipline is so central to us, but we want to own businesses that we can own for a decade or longer, in which case you want them to have these qualities of durable, resilient growth.
Take us inside and tell us what you can, without violating confidences, what it's like to be in a board meeting of Berkshire Hathaway. You've got, for a long time, you had Charlie Munger, you have Warren Buffett still there as the chair, and you've got other people now on the board. Do people ever say, Warren, you're wrong on this? Or Charlie, you don't really know what you're talking about? Does that ever happen?
Well, what I'd say is, I probably attended Berkshire Hathaway annual meetings since 1989, let's say. And I read every annual report and 10K. And the difference on the inside versus the outside is really very limited. In other words, this is a company that's valued transparency, candor. I mentioned Warren and Charlie, their ability to teach. And so I would say there were no surprises being on the inside versus the outside because of that culture. I would say the one difference of nuance is it's just amazing how much Warren and before Warren and Charlie together think about the durability of the business, how much they think about risk, how much they are determined that they are trying to build something to last, and the sense of responsibility they feel to their shareholders, the people that have their life savings in. And that was one of the big lessons from Charlie in terms of our business, was to really reinforce this culture of stewardship. Both my grandfather and father loved what they did, so that has a huge influence on a kid.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Didn't really think I had a problem.
I would isolate, self-medicate.
Like 48.5 million Americans, they didn't choose addiction. Go to shatterproof.org/findtreatment. Watch the film No More Secrets and find out how you can get help. That's shatterproof.org/findtreatment.
So let's talk about how you became a value investor. Your grandfather was a very famous investor. His name was?
It was Shelby Davis.
Shelby Davis. And he started with nothing and worked his way up? How did that happen?
Well, he had originally wanted to be in public policy and to be a diplomat, and he had a PhD in international relations that he earned in 1929, and he worked for Hoover and worked for Governor Dewey when he was running against Truman. Well, when Dewey lost, he made my grandfather the deputy superintendent of insurance for the state of New York. So you can imagine what a come down that what must have been. But you know, he went up to Albany, and what he realized is, of course, the soldiers were coming home, the baby boom was underway, the suburbs were being built, and life insurance was the first thing you bought when you got married and you created a family. So life insurance was like biotech. I mean, it was this hot growth sector. And my grandfather, as a regulator, looked at it and said, oh no, these are gold mines. So he resigned at the end of his term, and he borrowed $100,000 from his wife's family, and he started investing exclusively in financial stocks in general, insurance in particular.
So was he investing his own money? He took that $100,000, invested himself, made $800 million for himself and his family, but did he take outside investors at some point?
No, and that was really where my father came into it. So my father got into the business in 1958, and he decided that he should build an investment counseling operation, in a sense using my grandfather's discipline and approach, but to take in outside money. And that was when we started the client business in really 1966.
66, called Davis Advisors.
Yeah.
And now you manage $20-some billion?
20-some billion, and we started the mutual funds in '68, and with separate accounts and so on. And my father, while my grandfather stayed exclusively focused on financial stocks, my father took that same mindset and then applied it more broadly.
If I put $10,000 into your firm at the very beginning, 1966, what would I have today?
Well, today you'd have about $4.3 million. Now, if you'd put
that would be a rate of return of what?
Well, if you put the same amount in the S&P 500, it would be about 2.8. Okay. So that difference is only about 100 basis points. But the power of compounding over time, it's just amazing that the difference that makes. So if the market's returned, 8 or 9, and we've returned 10, that difference is compounded over time, is life-changing.
All right, so did you grow up in a family where your father and your grandfather said you have to be a professional investor, you couldn't do anything else?
No, sort of the opposite, I think. Both my grandfather and father loved what they did, so that has a huge influence on a kid. If your dad is happy getting off the train at night, I would go meet the train out in Tuxedo, and all the commuters are getting off, and they're looking gray and worn with their briefcases, and my dad would sort of spring off the train, and he loved what he did. So we grew up, when I'd go away to school, if my dad drove me, we would often visit companies on the way. So we grew up knowing, one, that they loved what they did. Two, that it was interesting because stocks weren't pieces of paper wiggling around, you know, in the news charts and so on. They were ownership interests in businesses. So we would visit businesses and their people, and it was just always sort of an interesting world.
After you got your master's, did you come and join the family business then?
Definitely not. You know, there is always a risk that a family business becomes employer of last resort for people with the same last name. Right. And so there was sort of a strong understanding that there was no seat waiting in a family business. You had to go out and find your own way. Now, interestingly, when I first got out of a university, I went to seminary, and I had thoughts of becoming an Episcopal priest. So I actually moved to Paris and worked for the American Cathedral.
So when did you full-time come to work in this firm?
Well, around 1990 or so, 89, 90.
And you became the chairman when?
And I became the chairman in 1998.
Okay, so now are you spending time running the firm, investing, looking for clients? What are your responsibilities?
Well, you know, if I had a business card, it would say analyst on it. That's still my full-time job. It's a part of the job I love. I love visiting companies. I love, you know, this idea of business people price. You know, it's a constant puzzle. Every day it's interesting. So I still spend a lot of time visiting companies. I love that part of the job. I like going out and traveling. So I'd say that's the lion's share.
So your grandfather was an investor, your father was an investor, you're an investor. Do you have a child who ultimately will succeed you?
I don't. I love my kids. They are the thing I'm most proud of in life. And but each one of them has chosen a different path. One in real estate, one is a litigating, working for the Attorney General, and one has started her own business and is an entrepreneur and is moving in that direction. I don't mind that patience to let the value of the business appear over time. I don't need it all at once. I don't need the big payoff.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays at 8 p.m. Eastern Time. Right here on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I
so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
So let me ask you, what do you do outside the office? You know, are you a big art collector? Are you a big philanthropist? What do you do with your outside activities? And generally, if you're a value investor, you wouldn't probably be a big spender. That would be my impression, because value investors don't spend a lot of money on their personal habits. Warren Buffett doesn't seem to spend a lot of money on his personal habits, living in the same house he's lived in for 50 years or so. So are you a big spender on the outside of the money you make here, or do you basically live a very simple life?
Well, compared to my grandfather would say I'm a big spender because he once asked me to paint his oven rather than replace it. And my father's very frugal. I would say that, but none of us have ever felt deprived. Charlie Munger once said, deferring gratification gives him so much gratification that he's not sure he's actually deferring it. But both my father and grandfather were, at the end of the day, philanthropists. My father would talk about learn, earn, return. You know, you spend a third of your life learning, a third earning, and then you move into this return phase. And both of them essentially gave away their entire fortune. They did not believers in inheritance.
Did you ever raise your hand and say, don't give it all away?
Yeah, my grandfather said, I don't want to deprive you of the dignity of earning a living. I said, you just deprive me a little bit. But I will say, you know, I have sort of the same mindset, and each one has, my grandfather's passion was public policy, my father's was education, and for me, I creating parks is something I love. I think about that as, you know, a very sort of democratic, with a small d, sort of mindset that, you know, you create a park, and unlike building a building, the operating costs are very low. It becomes more valuable, and it's self-programming. People go there, and I think that connection.
Where do you do that?
So my biggest project is in the Hudson Valley Park in the Hudson Highlands, and I've worked with groups like Scenic Hudson.
So if somebody's watching this and says, I'm watching a famous value investor and I want to get some tips about what I should do, should you go try to look for stocks yourself? Should you give money to a money manager? Should you give it to a long-only money manager, a hedge fund money manager? And what kind of rate of return should the average person watching a show like this try to get for his or her money? Is it 6% a year to be happy with, 7%, 5%, 8%? What do you think a value investing person should feel they should get as a rate of return on a consistent basis so they can go away, take a trip around the world, and not have to worry about their money?
An investor should recognize that the biggest threat to their generating a return over time is their own behavior. And so if somebody has the mindset of when stocks go up, I get excited and want to get in, when they go down, I want to get out, that behavior penalty will swamp any other choices they make in terms of whether they picked great stocks, whether they hired a great manager, whether they invested in a great fund. So what I would say is, if you are prone to these very normal behavioral biases, having a great financial advisor who can provide that sort of courage, that fortitude, and that patience, like the two lions at the public library, patience and fortitude, you know, an advisor who can modify your behavior is one of the most important investments you make. Now, if you're wired where you don't have that investor behavior problem, then that simple systematic investing, you know, putting something away every month, every quarter, every year, those will matter so much more than whether you selected the hot manager or the right sector. You can get in at the wrong time, but if you stay in, you can earn your way out of that. What really matters is the behavior.
Why should somebody, a young professional, want to get into the value investing business? Is there a big future in that business? Is it more exciting than the other ones I've just mentioned? Why should some young professional want to be a value investor?
Well, they might be a masochist, but in a way, I think there's something, I would say the temperament of the young person is what's going to matter. In other words, do they have that patience? Are they thoughtful? This idea of being able to move in a very deliberate fashion, for me, it is incredibly suited to a research mindset. The other areas you mentioned, you know, tech investing, it's exciting, it's dynamic, it's fast changing, and that suits a very different temperament. You think about the idea that being right more than you're wrong. Well, for a value investor, we think along those terms, but technically what really matters is not how often you're right and how often you're wrong. It's how much you make when you're right. So I don't mind that patience, that sort of sort of traditional mindset that says I'm willing to let the value of the business appear over time. I don't need it all at once. I don't need the big payoff.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Beirut, and this is Bloomberg. Good morning. I'm Jumana Bersachi in Dubai, and here's what we're following this morning. President Trump says there's been a lot of progress in talks with Ukraine on a deal to end Russia's invasion. He hosted Volodymyr Zelensky at his Mar-a-Lago resort in Florida on Sunday. Zelensky says he asked Trump to consider providing his country with security guarantees that would last 30 to 50 years.
We discussed all the aspects of the peace framework, which includes, and we have great achievements, 20-point peace plan, 90% agreed, and U.S.-Ukraine security guarantees, 100% agreed. U.S.-Europe-Ukraine security guarantees, almost agreed. Military dimension, 100% agreed. Prosperity plan being finalized.
Former EU official Thierry Breton says the bloc must resist U.S. attempts to influence its legislation aimed at regulating social media platforms. Breton was speaking on French television after he was sanctioned with a travel ban last week by the Trump administration. He was the EU commissioner in charge of enforcing the Digital Services Act, which regulates content moderation on social media platforms. Digital Bridge shares have surged in pre-market trading on news that SoftBank is in advanced talks to acquire the private equity firm that invests in assets such as data centers. Bloomberg understands that a final agreement is yet to be reached, and details, including the timing, could still change. And a check on markets. And what we're seeing is sideways trading as liquidity is thin in this post-holiday phase. Stock 600 trading flat on the session. S&P futures down 0.2%. Silver plunging today, down 6%. And then Brent up, actually surging 1.7%, even though it is down on the month, 61.70. And this is Bloomberg.
Throughout our 31-year history, we've been very focused on shorting individual stocks that we believe will underperform the market and add value through that underperformance. That ability to have a fresh perspective, take in the new information, even when things aren't going the way that you'd expect or to hope, AI is going to impact virtually every industry we can think of.
Lee Ainsley's path to the hedge fund world was anything but conventional. With no early ties to finance, he set his sights on business and applied to Stanford.
Luckily, they said, Lee, we don't share your interest in our attending Stanford Business School. So I owe a great debt of gratitude to the Director of Admissions of Stanford.
That rejection led Ainsley to the University of North Carolina, where he crossed paths with legendary investor Julian Robertson, founder of Tiger Management and one of the pioneers of the hedge fund industry. Ainsley was among the first Tiger Cubs, joining the firm as a technology analyst. It wasn't long before he decided to forge his own path.
It was a Friday. He said I was crazy. It was a subtle way to put it. Had some other adjectives involved, and I came back Monday morning and told him my mind had not changed.
In 1993, at just 28 years old, Ainsley founded Maverick Capital with backing from the Wiley family and a belief in deep fundamental research.
We're simply trying to understand the dynamics behind different stocks, identify those that we think are long-term winners and long-term losers.
Today, Maverick manages more than $10 billion across both public and private investments. And while the hedge fund world has evolved significantly over the years, Ainsley's disciplined approach has remained constant.
That ability to have a fresh perspective, even when things aren't going the way that you'd expect or to hope, really a critical part of the business.
Ainsley has embraced innovation, including AI, but still sees steady leadership and deep moats as the key to enduring success.
I've always felt good management teams deliver good surprises and bad management teams deliver bad surprises.
From Tiger Cub to Maverick founder, Ainsley has built a firm and a legacy grounded in research, discipline, and having a long-term view.
First of all, I'm a very competitive person, and I see the scoreboard every hour, and it's one of the few jobs where you know exactly how you and your team is doing. Secondly, it's one of the few jobs where I get to learn every day.
So when people think of hedge funds, they often think of very complicated algorithms and people trading every hour on the hour, every minute on the minute. You have built a hedge fund that's very successful, but it tends to hold on to stocks for very, very long periods of time, which is different than some of your peers. So can you explain your investment philosophy?
Well, the term hedge funds has obviously come to represent a wide range of different strategies, many ways to skin a cat. And you're correct, many use a lot of exotic instruments, many are very trading oriented. By contrast, we've always thought of ourselves as investors. We're simply trying to understand the dynamics behind different stocks, identify those that we think are long-term winners and long-term losers, and then hopefully recognize discrepancies between our views and the views of the market, and to take advantage of those. And so to do that requires a great deal of intensive fundamental research, which doesn't really lend itself to a lot of turnover, a lot of trading, but we really want to get to know our companies quite well. And to your point, we typically are pretty long-term holders.
When you buy a stock, you typically hold it for 3 years or so, something like that?
Well, the average ends up being a little over 1 year. If you look at one of our largest positions today, we've owned it for 8 years. And indeed, we first bought it in 2000 and have owned it for the majority of the time since 2000. So our core holdings end up typically being multi-year holdings, but there are a lot of shorter-term investments as well. Sometimes because you recognize you made a mistake, sometimes because others see some of the qualities that you're excited about in the stock in the first place, and so that difference in what you view as the value, what the market views as the value, has shrunk to the point you think there are more attractive opportunities elsewhere.
But you also short stocks as well, which is more complicated than buying long, I think. But tell me why you short stocks. Does that make it more difficult to talk to CEOs when you're shorting their companies?
So in our core hedge funds, we try to maintain a balance of long and short investments. For our hedge fund, shorting is a really important part of that strategy. It can be more challenging for a few reasons. You're absolutely correct. Management teams are a little less excited to talk to you if they think you're shorting their stock. Unlimited losses versus the long side, the worst I can do is to lose 100%. On the short side, you can lose a multiple of your investment. You're never writing your winners. On the long side, I'm right. That position becomes larger. On the short side is when I'm wrong, that the position becomes larger. So, and I can go on. So there are a lot of challenges shorting stocks, and I think that's one of the aspects of Maverick that has distinguished us from many of our peers, is throughout our 31-year history, we've been very focused on shorting individual stocks that we believe will underperform the market and add value through that underperformance. And as a result of maintaining that balance, we really have not had a lot of correlation to the markets over time.
Now, as we talk, the big, beautiful bill has passed Congress and the President signed it. Does that affect you one way or the other? Do you really care about things in the big, beautiful bill, or really you're not a macro kind of investor, so inflation rate, interest rates, the value of the dollar is not a big deal to you? Is that fair or not?
It's certainly fair for the large majority of the time, again, by being hedged and thinking about our factor biases, et cetera. Hopefully, we're not really influenced in a significant way by those macro variables. Having said that, there are periods of time where those macro variables are extraordinarily important to the stock market and to individual stocks. The financial crisis, inflation and rapid rise in rates in 22, discussion of tariffs. I think it'd be really hard to invest and just have your head in the sand and not understand the ramifications of that.
Do you mostly invest in the United States, or do you actually invest a lot outside as well?
We've been international investors from day one. Indeed, if you look at this year, emerging markets has been the biggest driver of our returns.
So as you look at the U.S. economy today, we're not in a recession, unemployment's low, inflation's coming down. Do you have a big worry about the U.S. economy?
Certainly worry. I wouldn't say I think it's likely. There are two individuals, Ben Silver and David Tikhonczynski, who have been in charge of running the public funds for over 4 years now. They are a little less concerned than I am about the impact of tariffs. I still have in the back of my mind that we could see the double whammy of both a slowdown in growth with some inflationary impacts as well, but we'll have to see how that plays out.
So when you're looking at a company that you want to buy and the staff comes in and recommends it and so forth, what are the key things you're looking for? A good CEO, a kind of moat around it so there's not a lot of competition, let's say, that can overcome the company. What are the things you most look for in a company you're going to buy long on?
So at our 30th annual meeting a couple years ago, and at the annual meeting, we showed some of our very original presentation we put together back in 1994. While we've worked really hard year in and year out to improve our abilities, what we're looking for in different investments, our investment strategy has been very consistent throughout. Yes, moats. We're trying to think about different secular trends that should persist, competitive dynamics among different companies, the quality of management teams, and I think this is one area we probably put much more emphasis on than many. I've always felt good management teams deliver good surprises and bad management teams deliver bad surprises. And that's endured. Looking for those characteristics has served us well for a long time.
So the hardest thing in the investment world, I often think, is admitting a mistake. At what point do you say, we made a mistake and we're getting out? How long do you give it before you say, this isn't working?
I really think that's one of the most critical differentiators between great investors and just mediocre investors. Because on one hand, you have to have confidence and conviction in all the work you've done, the decision you've made, that if you have a little stumble here and there, if you immediately are selling out, you're never really going to fully realize the depth of potential long-term success. And yet on the other hand, if you're stubborn and you refuse to admit I'm wrong, if you continue to think the market's wrong and I'm always right, then you'll get caught in some very, very difficult positions over time. So that ability to have a fresh perspective, take in the new information, even when things aren't going the way that you'd expect or to hope, and to really understand from this price point today, is this still going to be one of the most compelling investments or not? Much easier said than done, but really a critical part of the business.
So the hedge fund world, since you first joined it with the Julian Robertson and since you started Maverick, how has it really changed?
When I first was at Tiger, having a 2-martini lunch was a pretty common experience for the older crowd. 10Qs showed up in the mail. So it was a much less competitive, slower period for the investing world. Starting a hedge fund today, I would argue, is much easier because back in '93 when we started, there were a lot of things we basically had to build from scratch. So people just did not have these systems. And the fact I had a background in technology and engineering was very helpful. Today, the drop of the hat, a prime broker can, boom, put on your desktop sophisticated risk management systems, all the trading systems you need, et cetera, et cetera, et cetera. Having said all that, I would argue being successful today is much more challenging because the world is far more competitive.
So artificial intelligence has come along and everybody's excited about it, though people 5 years ago barely knew what it was. Is there something you think might succeed artificial intelligence as the next best thing that people are going to be excited about in the investment world or something else in the technology world in the next 5 years or so?
The day the iPhone was introduced, Nokia and Apple both had market caps of $80 billion. 5 years later, Apple was $400 billion, Nokia was $20 billion. So 20-fold difference. That's just one small example of the impact innovation can have. AI is going to impact virtually every industry we can think of. So when I think of the next steps, they actually, in my mind, will be AI driven. I think robotics will be a very real, very pervasive part of our lives. Something with that self-driving cars or something doing your laundry. A lot of this is going to require energy in abundance that is virtually free, but I think the rate of change is accelerating and that it's almost hard to imagine where we're going to be in 10 or 20 years. It was a Friday. He said I was crazy, had some other adjectives involved, and asked me to consider it over the weekend, and I came back Monday morning and told him my mind had not changed.
technology is embedded in every aspect of our lives
and laying the foundation for the future. From finance to defense, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Annabelle Drulers in Hong Kong.
I'm Sherian in Tokyo. Watch Bloomberg Tech Asia.
Only on Bloomberg Television.
The multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Let's talk about your own background and then how you came to start Maverick. So, where were you born?
Born in Alexandria, Virginia, outside of D.C.
What did your parents do?
My father was a teacher and eventually was the head of 2 different schools. And my mother was an accountant.
So you went to college in Virginia?
I did.
At the University of Virginia?
Correct.
And then what did you do after you graduated?
I was an engineering student, undergrad, and I went on to be a consultant on the technology side right after college.
And then you decided to go to business school?
I did.
And you applied to Stanford Business School?
I did.
And what did they say?
Luckily, they said, Lee, we don't share your interest in our attending Stanford Business School. And I say luckily because as a result, I went to the University of North Carolina for business school. There I was asked to work with the board on a couple different things. And there was a board member named Julian Robertson who ran the Tiger Fund. At that point in time, Tiger had not really hired business school students. I had developed an interest in stocks when I was in 8th grade, and it was still my hobby at that point in time. So Julian and I spent a lot of time talking about stocks. And for me, it was like talking about basketball with Michael Jordan. I just thought this was so amazing. But it never really crossed my mind it could be a job opportunity. As a matter of fact, I'd accepted a job to go work at Goldman Sachs, and about 2 weeks after that, I got a phone call from Julian asking if I would consider working there, which I ended up doing. And to me, that was one of the great breaks in my life, so I owe a great debt of gratitude to the Director of Admissions of Stanford.
So you went to work for Julian Robertson, who was one of the leading hedge fund people at the time when there weren't that many hedge funds. So what did you specialize in there?
Well, the first few months I was a generalist and spent a lot of time on consumer and retail, but after a few months they asked me to lead the technology investing efforts. And so for the rest of my career there I was focused on tech.
And did you have mentors there to help you?
There's a guy named Steve Mandel, who's still a very good friend. He joined Tiger just a couple months before I did, but I was coming right out of business school, and he had already been Goldman for 8 years, and he took me under his wing, and it was really, I got that promotion to take over the technology sector rather quickly, which is really on the advice of Steve to join. So Steve's another person I know a great deal too.
So after 3 years there, and you're doing well, presumably. Julian likes you. Steve Mandel is mentoring you. You go to Julian and say, you know what? I'm going to start my own hedge fund. What prompted you to leave after those 3 years?
It was a Friday. He said I was crazy. It was a subtle way to put it. Had some other adjectives involved, and asked me to consider it over the weekend. And I came back Monday morning and told him my mind had not changed. And that was a really tough conversation because Julian had been incredibly generous, kind, gave me this great opportunity. But I really, and in hindsight, I was a little naive and probably a little arrogant, and I had probably a little more confidence than I should have in my ability to succeed. But thanks to a family called the Wiley family, Sam and Charles Wiley, they were willing to back me and gave me an opportunity to start something on my own.
So at Maverick today, are you responsible for every investment decision? Do you have to approve every single investment decision that's made?
So I gave up day-to-day responsibility on the public side about 13 years ago, and for the last 4+ years, Ben Silver and David Tikhonczynski have had those responsibilities, and they've done an amazing job. On the private side, early stage investments have been led by David Singer for the last 20 years, and Maverick Ventures is our second important business. And then the third business today is Maverick Silicon, which is a fund that will focus on late stage, or is focusing on late stage private companies, trying to address the insatiable demand for compute and AI infrastructure, and that's led by Andrew Homan. So those are the individuals making all the day-to-day investment decisions.
So today, your job is to oversee your professionals, but once a week, do you review the portfolio and say, this is good, this is not good, or how do you oversee this?
We have in-depth discussions. We officially meet every 2 weeks on the public side, and I'm not shy to weigh in and give advice when I think there's something that we may want to think about twice. But again, I have great confidence and respect for those individuals and don't really want to be over their shoulder nitpicking day in and day out.
Parents are often concerned these days that their child won't get a job at a place like Maverick or Google or Goldman if they don't major in a STEM subject, science, technology, engineering, or math. Do you have a view that it makes a difference what you major in before you hire somebody?
I think 5 years ago, or 3 years ago, I would have said STEM is something you really need to give serious consideration to. I think AI is changing that. And a lot of the disciplines that are very helpful from a STEM background, AI is probably already doing quite effectively. As, again, a son of an educator and been involved in a lot of different schools, I've been very proactive in working with these schools, making sure they're not fighting AI. Don't make AI illegal. You're not allowed to use it. On the contrary, teach them how to use it. Embrace AI. Because the folks coming out of college now and over the next several years, if AI is not a tool that they're very comfortable with, and they're not able to add value in other ways, they're going to have a tough career. So I think the world's changing quickly in this regard as we speak.
I think we'll be at the point at some point in the future where AI itself will make the investment decisions for hedge funds like yours, where you won't need as many people, you just rely on some kind of AI, or you don't think we're going to get there anytime soon?
So again, hedge funds means a lot of things. So I think it depends on the strategy a bit. And one of the reasons we've always been very equity focused, whether it's private or public, is obviously that's the very end of the value stack of the enterprise value. So little changes in enterprise value can be big changes in equity. And B, companies run by people. And so understanding people, their motivations, their integrity, the quality of their decisions, et cetera, is such a valuable skill. And I would argue that is going to be the last frontier where humans will still do a demonstrably better job. Back to your question, I hope that's true for 10, 20, 30 years, but I don't think it'll be true forever. I'm a very competitive person, and it's one of the few jobs where you know exactly how you and your team is doing. I get to learn every day.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Every weekday from 3 to 5 Eastern.
Only on Bloomberg. Context changes everything.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
What are you looking for in young talent that comes out of business schools or has been already at another hedge fund?
I'd say a few things, and some of these are probably a bit obvious, but sense of dedication, competitiveness. Obviously, you need to be rather bright. Emotional consistency, we call it. So the highs aren't that high and the lows aren't that low. For us, a team orientation and interpersonal skills are really important. And so Maverick has a much stronger team culture than I think many hedge funds. And we succeed or we don't succeed as a team, and we're not really as focused as on an individual's contributions. In the investment business, if you're right, meaning I've picked a long that outperforms the market or a short that underperforms the market, 55% of the time, you're now one of the best in history. That's as good as you can do, which by definition means you're wrong 45% of the time, even if you're really good.
So suppose somebody comes to you and says, I like working at Maverick, it's very nice, but I want to start my own hedge fund, not unlike what you did. Do you throw them out the door right away, or you tell them not to do this, or it's not that easy to do, or what happens?
Well, we have always encouraged folks to be very open with us, whether they're thinking about starting their own fund or going to a competitor or whatever it may be, just because, A, the earlier they tell us, the more we can prepare for potential departure. But more importantly, it really gives us the opportunity to give them some hopefully valuable feedback. I've had discussions where people have laid out an opportunity and I stand up and hug them and congratulate them. I'm excited for them. I've had discussions where I've said, oh gosh, you don't really understand what you're getting yourself into here. Let me walk through. If someone does want to potentially start a fund, I certainly understand that. I went through that myself. And we'll try to be supportive. I root for my quote unquote competitors. And certainly someone that's leaving Maverick, I'm going to do everything I can to help them be successful.
So if somebody asks you, what is the most common mistake that investors, average investors make, what would you say that is?
The world has become, and I think this is really true on the professional investment side, in the world of pod model, multi-strats, most of those investors have very, very short time horizons, and they're very worried about my performance today and this week, which makes it really difficult to take a step back and think about where is the world going to be in 5 or 10 years, and how is this stock going to fit into that? And then secondly, you mentioned this a bit earlier, just underestimating how important management teams are. You can have a great stock with great fundamentals, great competitive advantages, a deep moat, et cetera, et cetera, et cetera. But you put in a poor CEO who makes bad decisions regarding capital allocations, regarding how he promotes, manages others, et cetera, et cetera, et cetera, that you may have a very bad investment in your hands, even though the fundamentals were in your favor.
What is the best investment advice anybody ever gave to you?
I'd say two things. A, it's hard to be repetitive, but the importance of management. That was something that Julian really harped on. But secondly, just the importance of integrity. So when you're building relationships with the people I work with brokers on Wall Street, certainly with management teams, perhaps most importantly with our investors, if you're not constantly conducting yourself, and that's not true for me, but every member of our firm, with the utmost integrity and thinking about the ethics of every decision you're making, that doesn't really work in the investment business. Your career will be a short one.
So if somebody said to you, I got $1 million, I'm 30 years old, I don't really have to have current yield, I'm happy to take some capital appreciation risk, what would you recommend somebody do with $1 million or with $100,000?
I think on the longer term basis, you certainly want equity exposure. I personally think, a little bit like we were talking about earlier with hedge funds, likewise, active management on the long only side, there are a number of active managers that can do quite well and I think outperform the market over time. Majority do not. Therefore, if I'm investing a smaller amount of money, I'm probably looking at an index fund. And I think a lot of it has to do with your risk tolerance, your age, your future needs of that capital, to what degree it's in a more conservative fixed income strategy versus equities.
What's the future of Maverick? Do you intend to run it as you are now for the next 10 years, 20 years? You're going to expand it?
Well, I'm certainly hoping my role for at least 10 years. We'll see if I make it 20. I'm very fortunate that we have, and we covered some of this earlier, but 3 different business units, each of which are led by very capable individuals, and so they'll be in place for a very long time. I love what I do. I'm very engaged. I stink at golf, so I don't really know what else I would do, so I plan on being in the seat for quite a while. This will sound corny, but collecting fond memories with family and friends is probably what I focus on more than anything else.
What is the excitement that gets you out of the bed every morning to be a hedge fund investor?
I'd say 3 things. First of all, I'm a very competitive person, and I see the scoreboard every hour, and it's one of the few jobs where you know exactly how you and your team is doing. I get to learn every day about companies, industries, macro influences. I'm very fortunate to work with these really talented, nice people that I find stimulating and fun to be with.
In case you missed it, on Bloomberg Open Interest.
Politics will drive the economy. Now the conversation is AI is driving the economy.
AI story and really the economy and inflation story will probably be front and center.
We saw the promise of like ChatGPT. 35 million people are paying for it.
We have the ChatGPT versus the Google platform. Maybe there's pressure on the rest of the secondary and tertiary players in the market.
Don't miss Open Interest live every weekday.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets. Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Burden in Florence, Italy, and this is Bloomberg.
Good morning. I'm Joanna Versace in Dubai, and here's what we're following this morning. President Trump says there's been a lot of progress in talks with Ukraine on a deal to end Russia's invasion. He hosted Volodymyr Zelensky at his Mar-a-Lago resort in Florida on Sunday. Zelensky says he asked Trump to consider providing his country with security guarantees that would last 30 to 50 years.
We discussed all the aspects of the peace framework, which includes, and we have great achievements, 20-point peace plan, 90% agreed, and U.S. Ukraine security guarantees 100% agreed. U.S. Europe Ukraine security guarantees almost agreed. Military dimension 100% agreed. Prosperity plan being finalized.
The U.S. president will meet the Israeli prime minister in Palm Beach, Florida, later today. Tensions between them have been rising, with Trump previously warning Israel not to undermine his peace efforts. They're expected to discuss the second phase of the Gaza peace plan, as well as Iran. Digital bridge shares have surged in pre-market trading on news that SoftBank is in advanced talks to acquire the private equity firm that invests in assets such as data centers. Bloomberg understands that a final agreement is yet to be reached, and details, including the timing, could still change. China has pledged to expand government spending and improve how it deploys capital in a bid to boost growth in 2026. The government will focus on better targeted fiscal policies, spending more on advanced manufacturing and tech innovation. It highlights the fine line Beijing is walking between buffering the economy against external headwinds and preventing a domestic debt crisis. Major storms on both U.S. coasts are disrupting travel during the busy post-holiday period. Airports in New York, Detroit, Philadelphia, and Boston have been hit with heavy snowfall, with more than 1,600 flights canceled across the country. In California, heavy rain, mudslides, and flooding have led to road closures, while the Great Lakes region is facing hazardous travel conditions due to accumulating ice. And a check on how some of these key indices are trading in these post-holiday thin liquidity over here. But Stock 600, you can see, down 10 basis points, so marginally in the red. NASDAQ also leaning towards a weaker open today, down 0.4%. Silver at one point hitting $84 per ounce in the session, now plunging down 4.5%, still up 30% in the last month. And then Brent up 2% today in trading on that positive news out of China. Let's switch over and take a look at defense stocks, one of the key outperforming sectors this year in Europe. Not a pretty day today. Leonardo down 4.2%. Other names in the space as well down anything from 2 to 3% as well. So some profit taking probably taking place before the end of the year. And that was your recap. This is Bloomberg.
We're a dedicated active management firm and don't believe that you can't beat benchmarks or that you can't outperform the passive funds. You've got to understand and anticipate your clients' needs and how they're changing. Have a plan and be disciplined. Don't cut your flowers and water your weeds.
When Robert Sharps was growing up in Western Maryland, his interest in business began early.
My dad got his Series 7 and became a stockbroker, which is how I got interested in the investment business.
Sharps joined T. Rowe Price in 1997 as an equity research analyst. Over the years, he built a reputation as a successful large-cap growth portfolio manager, growing a $2 billion strategy to more than $35 billion.
Even though my primary role was as a large cap growth portfolio manager, I was involved in different aspects of the business. Ultimately, Bill Stromberg asked me to transition my book and become part of the leadership team. And at that point, I'd managed large cap growth for 15 years and was ready for a new challenge.
That challenge came in January of 2022 when Sharps became CEO, stepping into the role during a volatile period for global markets, with the S&P 500 dropping more than 10% into correction territory. Under his leadership, T. Rowe Price remains committed to active management, even as index funds and ETFs dominate investor flows.
We're a dedicated active management firm and don't believe that you can't beat benchmarks. In many instances, we are able to deliver excess performance, so better return even after fees.
Sharps is also focused on the future, expanding into private markets, scaling active ETFs, and integrating AI into research and operations.
AI will influence security selection, portfolio construction, financial planning.
From a small town in Western Maryland to the top of a $1.6 trillion global investment firm, Robert Sharp's story is one of steady ascent through patience, discipline, and the belief that thoughtful, active decision-making still matters.
Being disciplined and having a very long time horizon is really important. I see a lot of people that are unwilling to make investments and take risks when the return potential is the highest, and in fact, in some instances, go the other way.
So just tell me exactly what a mutual fund is. Your company has started as a mutual fund company, but what actually is a mutual fund?
A mutual fund is an investment company that pools resources from investors, and it's really designed to allow investors to achieve diversification, give access to a broader range of investments in a more convenient way, lower expenses, and obtain professional management.
Mutual funds were often known for picking stocks and thinking that the stocks would be better than the average performance. But then came along the index fund. So explain to us, are mutual funds where you have stock pickers, are they still very popular? And does it still attract a lot of capital compared to index funds?
Index funds have gained a tremendous amount of market share over the course of the last 15 to 20 years. Today, over 60% of managed U.S. equity assets are managed passively or managed in an index fund. We're a dedicated active management firm and don't believe that you can't beat benchmarks or that you can't outperform the passive funds. We've done a number of studies that have looked at the performance of our funds net of fees over rolling 1, 3, 5, and 10-year periods of time. And what we find is that in many instances, we are able to deliver excess performance, so better return even after fees.
Let's talk about another phenomenon that came along after index funds, which is ETFs. So index reflects, let's say, an S&P 500 index. You basically get what the S&P 500 index is if you go on that kind of fund. What is an ETF?
An ETF is also a mutual fund, but unlike a traditional open-ended fund, it's traded like a security, like a stock on an exchange. It has certain advantages relative to a traditional fund, and as a result, it's become increasingly popular, particularly in taxable accounts. So in addition to being able to have intraday liquidity, which to me isn't necessarily all that important for most investors that have a long time horizon, there's a tax benefit to owning an ETF relative to owning an open-ended mutual fund. As a result, particularly outside of retirement accounts, ETFs have grown very, very rapidly over the course of the last 10 or 15 years.
What is the wave of the future? Is it going to be an artificial intelligence fund or something? What is the next technological innovation that's going to change the mutual fund industry or make it different than it is today?
So while ETFs and separately managed accounts have really gained favor in taxable accounts, in retirement plans and 401k plans, mutual funds continue to be the investment of choice. And largely because they're tax deferred, the tax benefits of ETFs don't matter. And there was legislation in 2006 called the Pension Protection Act that allowed a retirement date fund to become a default investment for an employer to default their employees into a target date fund, which really is a very elegant kind of set it and forget it solution that allows somebody simply to say, my objective is to retire in 2060. I'm going to put my assets in the T. Rowe Price Retirement Date 2060 Fund. What it does is allow you to accumulate assets, and then as you approach retirement age, it has a glide path that increases the allocation to lower volatility sectors such as bonds.
Okay, let's talk about 401ks or IRAs. Historically, they had to invest in publicly traded vehicles. Now there's talk in Washington about changing the rules so that IRAs and 401ks can put a certain amount of money into private funds. Do you think that's going to happen? You think it's a good idea, or do you think it's a bad idea?
Well, it's already happened to some extent, and I think it's likely to happen to a greater degree over time. We, as a matter of fact, have invested in over 250 private placements in our mutual funds over the course of the last 15 plus years. So you can have private investments in mutual funds. Historically, you haven't had them in things like retirement date funds. There are challenges to incorporating illiquid private assets into defined contribution plans. One, as you say, you need a daily net asset value, so you have to calculate or estimate the value of the fund, including the value of the private assets that aren't marked to market real time. Two, you have to provide liquidity, daily liquidity for these funds. If plan participants want to make a change, if they leave, if they want to make an incremental investment. And by definition, illiquid private investments are illiquid, so you've got to overcome that challenge. Third, a lot of plan sponsors are very sensitive to fiduciary risk. There's been a fair bit of litigation in the defined contribution environment over fees or performance. And then finally, it's an extraordinarily fee-sensitive market. And as you know, the fees in private market alternatives are much higher than the fees in even active public equities, let alone passive equities. So ultimately, you'll need to solve for all of those factors, and the improved or enhanced investment return from incorporating private market alternatives will have to be substantial enough that it overcomes the higher fees.
Your predecessor bought a private debt fund a few years ago, as I recall, and I guess was that to provide your clients with the diversification, private credit being a theoretically higher rate of return than regular fixed income?
Yes. So we, at the end of 21, so right before I became CEO, we acquired a New York-based alternative credit firm called OHA. And they do a range of things: structured credit, including CLOs, stressed and distressed offerings, as well as multi-sector strategies and private credit. So private credit, basically like most private investments, you trade off liquidity for return, and you can get, again, depending on the deal, a point or two premium for a senior secured private loan or a private unitranche loan relative to a syndicated loan.
So after the acquisition was made, have you thought about other acquisitions, or is your growth going to be mostly internal?
Yeah, so we've had a great experience with OHA, and we've learned a tremendous amount. We would like to have a more substantial presence in private market alternatives. And there are really three ways to do that. You can make an acquisition like we did with OHA. You can develop it internally. We've done a number of private placements that have historically been in our mutual funds. We're leveraging that capability to create a late-stage venture fund. So that's an area of private market alternatives that we'll do organically on the T. Rowe Price platform.
Do you think today an asset manager like you can continue to thrive if you don't have a large presence in private markets?
So increasingly, the private market alternatives firms and traditional investment management firms like T. Rowe Price are competing for the same investment dollar. As a result of that, you've started to see convergence, and I think that that's a trend that's likely to continue. So for firms like T. Rowe Price, I think you're going to have to figure out ultimately, how can you get access to private market alternative building blocks to incorporate into the investment solutions that you're creating, you're curating on behalf of all of your client types.
As you look at the economy, are you worried, or you feel the economy is in reasonable shape and the big beautiful bill will help it get in better shape?
So I have to say I've been surprised at how resilient the economy's been in the face of still relatively tight monetary policy. For a couple of years now, I think we've been anticipating looser monetary policy and more rate cuts, and they've been slow to come because inflation has been stickier or more persistent. It still seems to me as though there's a lot of uncertainty or lack of clarity with regard to how the tariffs will ultimately play out, what impact they'll have on consumption, whether or not they'll be inflationary. But the economy's been resilient, so I don't see any imminent signs of a recession.
How is artificial intelligence going to change your business, or not at all?
No, absolutely it will. I think, I think it will change most everything. There's a lot of things that we do that are either content refinement or content generation, right? On the business side, if we're competing for a new mandate, we respond to an RFP, right? We're using AI tools to compress the time and the cost of producing that proposal in response to the RFP. We're also using AI to review and refine investment management agreements and review and refine vendor contracts. So in a lot of ways, we're using it to make the business much more efficient, either faster, more accurate, or less costly. I think it's also informing better decision making. I'm a big believer in taking on new challenges and lifelong learning, and it wasn't something that that I'd really anticipated or that I'd been positioning to do.
The multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Let's talk for a moment about T. Rowe Price himself.
Yep.
There was a man named Mr. T. Rowe Price. Who was he?
Thomas Rowe Price Jr. He was a Marylander born in Glendon, Maryland. I think he worked for a number of brokerage firms and ultimately founded T. Rowe Price in 1937. He founded the company on a handful of principles. One is putting clients first. Two is acting with integrity, and three is emphasis on fundamental research. And I think all of those things are things that we still hold dear today. And Thomas Rowe Price was an early pioneer. As a matter of fact, our growth stock fund, which is one of our flagship funds, which was launched in 1950, to my knowledge, was the first mutual fund that was launched dedicated to the growth style of investing.
Let's talk about T. Rowe Price today. What are the assets under management? How big is the firm?
$1.6 trillion.
The company's headquartered in Baltimore. Do you have your only office here, or you have office elsewhere?
So we have 8,000 associates. About 5,000 of those are either here at our headquarters downtown in Harbor Point, or in our corporate campus in Owings Mills, which is in Baltimore County. So we have a team of people there that are focused on supporting the business and have a unique set of capabilities. Then we've got a number of offices throughout Asia and Europe.
Okay, let's talk about your own background. So where were you born?
Yeah, I'm a Marylander, but I'm not from Baltimore. I was born in Cumberland, Maryland, in Allegheny County, which is the second westernmost county in Maryland.
And what were your parents? What did they do?
So my mother was a school teacher, a public school teacher, and my father's family was in the automotive business. They had a Chevrolet dealership. When my paternal grandfather passed away, my dad took over that business, but he wasn't all that interested in it and ultimately sold it. He got his Series 7 and became a stockbroker, which is how I got interested in the investment business.
Hey, so when you were growing up, were you an athlete? Were you a great scholar?
I did play tennis and was reasonably good. I played one singles my senior year. But outside of that, I'd say I wasn't a particularly distinguished athlete. And academics, I was smart enough to get by without a tremendous amount of effort. So I did, I wouldn't particularly distinguished as a student in high school either. Although I graduated near the top of my class in college, so maybe grew up a little bit. I don't know, maybe I had all my fun in high school.
So you went to college in Maryland at Towson?
At Towson University, yeah. It was Towson State at the time.
And what did you major in?
Accounting. Look, accounting is the language of business. I mean, I think it was a great foundation ultimately to get into investment research and eventually portfolio management, right? And creating financial statements isn't all that interesting, but if you know how they're made, you can do a pretty good job of using and analyzing them.
Right. So when you graduated from college, what did you do?
I went to work for KPMG in Washington, D.C. for 2 years. I worked in a consulting practice there. And then I went to University of Pennsylvania to Wharton to get my MBA.
After that, did you say, I want to be an accountant still, or I want to do something else?
When I left KPMG, I went with the idea that I wanted to get into an investment-related field. I wasn't certain exactly what that was, but I really wanted to use the MBA education and experience as a segue into the investment world.
When did you get your position at T. Rowe Price?
Yeah, interestingly, I interviewed for a summer internship position and got put on the wait list and ended up interning at Wellington Management Company in the summer of '96. I had a great experience there, but also stayed in touch with the folks at T. Rowe Price, and as I did the full-time recruiting process, ultimately chose to come to T. Rowe Price. So,
okay, what year was that?
97.
97. So what was your job at T. Rowe?
Was an equity research analyst, and I followed the financial services sector.
Okay, and so how many years did you do that before you kind of rose up a bit?
3 or 4, and then I was given diversified portfolio management responsibility. I spent the vast majority of my career as a U.S. large cap growth portfolio manager. We launched a strategy with $2 billion of seed money in 2001 that by the time I handed it over to my successor was over $35 billion.
So did that success make you a candidate to be the CEO?
Yeah, so I started in the business following financial services, and that included doing research on our publicly traded competitors, our counterparties, our clients. So I had a pretty good perspective into the business. And then the process of not only investing and building a track record, but also building a commercial franchise, going and doing finals presentations and then meeting with clients and doing performance and portfolio positioning updates, I think gave me pretty good perspective on the commercial side of the business. I also sat on a group called our Equity Steering Committee, which is really kind of the cabinet, if you will, for the division head. And it gave me a sense for how we develop talent, how we set policy, those sorts of things. So even though my primary role was as a large cap growth portfolio manager, I was involved in different aspects of the business. Ultimately, Bill Stromberg asked me to transition my book and become part of the leadership team. And at that point, I'd managed large cap growth for 15 years and was ready for a new challenge.
He tapped you on the shoulder and said, you know, you're good at management possibly, and maybe you could rise up and be the CEO. Did that surprise you? Or did you say, you know, I was waiting for you to ask me that for a long time?
No, it was a very hard decision. You know, it's a really different job, a really different set of responsibilities. It was one that we spent a lot of time talking about. It was one that, you know, I talked to some people that I respect a lot. You know, I spent some time talking to my father. Larry Culp's been a mentor to me. Spent some time talking to Larry Culp, and, you know, really tried to get a sense for what the difference between being an individual contributor and being a leader. I didn't really have much experience as a people leader at that point. So, you know, I thought really hard about, do I want to take this new challenge on? I'm a big believer in taking on new challenges and lifelong learning, and ultimately decided that it was something that I wanted to do. But it wasn't something that that I'd really anticipated or that I'd been positioning to do.
When you became the CEO, what did you spend most of your time doing? Dealing with clients, employees, investments? How do you divide your time?
I spend a lot of time engaging with clients. I think in order to develop strategy, you've got to understand and anticipate your clients' needs and how they're changing. I find a big part of this role is the ability to get things done through others. And in order to do that, you have to be credible, right? You have to build trust. Being disciplined and having a very long time horizon is really important. Don't cut your flowers and water your weeds.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
In case you missed it, on The Pulse.
distinguish between companies that are here because they're running international operations, the companies that are indigenous and working with the citizens of the UK, and make sure you get the regulation strategies right. With the rule of law and a great city that London and a great country that UK is, there's plenty of upside.
What do you tell the Prime Minister?
I tell them to make sure the regulation's fair, be the best place for a non-UK based company to operate, and you'll get companies coming here.
Don't miss The Pulse, live every weekday. Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Now, I assume because T. Rowe Price is a big employer in Baltimore, and you're the CEO, you're probably pretty well known in Baltimore, if not elsewhere. So if you go to a cocktail party in Baltimore, do people come up to you and say, hey, I don't know what to do with my money, got any investment tips? What do you tell people?
Yeah, I think giving financial advice without really having context of people's risk tolerance, time horizon, resources is probably not a wise thing to do. So I'll either deflect or use some generalizations, tell people to max out their 401k, ultimately to have a very, very long time horizon, those sorts of things, as opposed to offering perspective on my view of the market or any individual securities or funds.
So who manages your money?
I do.
You do?
I do.
So you every day you're looking at that to make sure, and I assume most of it's in T. Rowe Price?
It is. My largest holdings are equity in our company, so T. Rowe Price shares. The fund that I used to manage, T. Rowe Price Large Cap Growth Fund, and then I own a number of our other mutual funds, and I've also invested in a number of OHA's funds.
Now, let's suppose I'm a student at Wharton now, and I'm looking for a job. Why should I want a job at a company like yours or an investment company?
Our industry is really dynamic, right? Evaluating investment opportunities, I think, is intellectually challenging. Getting it right is very rewarding. If you're good at it, it can be lucrative. I think we have a great culture as a firm. When I think about T. Rowe Price's culture, we have a very long-term orientation. We think hard about delivering a great value proposition for our clients and putting our clients first. We really value intellectual honesty, collaboration. So it's a great place to come and learn. What I find is people that are attracted to active investment management want to be around other great investors. And I think our platform offers that. If I showed up in your office tomorrow and said, look, I moved to Baltimore, I have a little cash, I'm 50 years old, I don't really need the money, I have $1 million, what should I do with $1 million? Yeah, again, I think to some extent it probably depends on your risk tolerance, but there are a number of T. Rowe Price funds that I would wholeheartedly recommend. Global Focused Growth, Capital Appreciation, our U.S. structured research strategy that's managed by our research analysts. All of them have very strong long-term track records, and I think for somebody with a long time horizon would make for very, very good investments. What's the best investment advice you've ever received? It's hard to pinpoint one thing. Being disciplined and having a very long time horizon is really important. I see a lot of people that are unwilling to make investments and take risks when the return potential is the highest, and in fact, in some instances, go the other way. So I'd say have a plan and be disciplined. It took me a little while to learn that just because something was down quite a bit doesn't make it attractive, and just because something's up quite a lot doesn't mean that it's expensive or that you've missed it. We had a former portfolio manager that used to say, don't cut your flowers and water your weeds, and we've certainly been through a period of time where it's paid off to let your winners run. And I'd say through my career as a large cap growth portfolio manager, that was a pretty important element of my process. In your observation, what is the biggest mistake the average investor tends to make? Yeah, I think de-risking during a period of time where risks are very high. So it just destroys your long-term returns. So do you enjoy this job? I enjoy solving hard problems. I have a great leadership team that I work with, and I really enjoy working with and developing them and working with and developing their teams. Now, look, I have a passion for this company. I've been here this month for 28 years. I love the business and the industry, but I mean, there are obviously times that it's hard. I think when you're a CEO, ultimately you need to make very difficult decisions about resource allocation. Sometimes you need to deliver hard messages when the results aren't there. And I think anybody in the seat doesn't enjoy that part of it, but I think they understand that it's an important part of the responsibility.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning. I'm Joanna Bersetchi in Dubai. Here's what we're following this morning. President Trump says there's been a lot of progress in talks with Ukraine on a deal to end Russia's invasion. He hosted Volodymyr Zelensky at his Mar-a-Lago resort in Florida on Sunday. Zelensky says he asked Trump to consider providing his country with security guarantees that would last 30 to 50 years.
We had a terrific meeting. We discussed a lot of things. As you know, I had an excellent phone call with President Putin that lasted for over 2 hours. We discussed a lot of points, and I do think we're getting a lot closer, maybe very close.
Taiwan's Air Force has launched fighter jets after 4 Chinese Coast Guard vessels were detected approaching its waters. The Chinese military is conducting exercises around the island, which Taiwan has described as irrational and provocative. Beijing says it's a stern warning against Taiwan independence and is necessary to protect China's sovereignty. Digital bridge shares have surged in pre-market trading on news that SoftBank is in advanced talks to acquire the private equity firm that invests in assets such as data centers. Bloomberg understands that a final agreement is yet to be reached and details, including the timing, could still change. And let's get a check on how markets are faring. It is a thinner than usual liquidity day, but we are seeing some stabilization of the Stoxx 600 in Europe, marginally in the green. Not the case for the Nasdaq, though, down 0.4%. But for the year, of course, the index is up more than 20%. Silver plunging today in trade, bucking the most recent trend of keeping to move higher and higher, but today down 5.3%. And Brent almost up 2% today in trading, 61.70. A quick look at defense stocks, also underperforming today, tumbling after a very strong year. Some profit taking going through. This is Bloomberg.
Zero commissions was an industry-changing innovation. Mobile finance and fintech in general, I think, was aided by the rise of Robinhood. I think that every company will become an AI company, but I think the humans will ultimately be calling the shots.
As a young adult, Vlad Tenev dreamed of becoming a mathematician. Entrepreneurship, let alone disrupting the fintech industry, wasn't part of the plan.
I wanted to be a mathematician. I wanted to make exciting discoveries and figure things out. I had no idea what algorithmic trading was, but I knew that I was a little bit stagnant and that this sounded like a really fun opportunity.
Leaving graduate school at UCLA set him on a different path. In 2013, he co-founded Robinhood with a mission to democratize access to financial markets. For decades, when people traded stocks, they had to pay fixed commissions. Tenev changed that, pioneering zero-commission trading, a move that forced every major brokerage to follow suit.
Certainly, the industry moved to zero commissions as a result of Robinhood's impact.
Then in 2021, the GameStop short squeeze exploded. Retail investors, everyday people, not professionals, bought the stock in droves, encouraging peers to do the same. The frenzy got so intense that Robinhood shocked the market. It restricted trading on certain stocks. That decision eventually landed Tenev in front of Congress.
This was a technical and operational decision that we made in this current unprecedented environment. Can be substantial. So to protect the firm and protect our customers, we temporarily disabled buying in these securities.
Even after the chaos, Robinhood endured and expanded into crypto banking, derivatives, and now tokenization, which Tenev calls the biggest capital market innovation in decades.
My motivation is creating new things. If you create new things that are more useful, that's really what gets me excited.
Today, Robinhood is valued at more than $90 billion, and Tenev remains committed to pushing the frontier of finance, whether through blockchain, AI, or the next big platform shift. From the son of Bulgarian immigrants to the architect of a new financial model, Vlad Tenev is helping to shape how the next generation will own, invest, and build wealth.
You know, when I started the company, I was worth nothing, but things haven't changed very much for me, as it might be a little bit surprising, because I was never really doing it for the money.
When people traded stocks historically, they were fixed commissions, and then fixed commissions went away. But did you pioneer the idea of having no commissions, or did somebody else do that and you did it better than other people?
I think that a lot of people talked about zero commissions being the future. And there were some startups that didn't really work out that tried zero commissions on a more promotional basis. So your first 10 trades per month were free, that sort of thing. But certainly the industry moved to zero commissions as a result of Robinhood's impact.
So for people who are not that familiar with the business, they might say, if they're watching, well, how do you make money if you're not charging for the service you're providing? So how do people who offer no commission brokerage trading, how do you make money?
Right now, Robinhood's a highly diversified business, right? We have 9 revenue streams that generate 100 million plus in annual revenue or more. When we started, obviously it wasn't as diversified. It was just equities trading. And our idea at the time was, you have all of these great companies in Silicon Valley around where we are today. Instagram, Uber, Meta, formerly Facebook at that time. And the playbook was, why don't we just get customers, have a retentive relationship where customers don't just use your product once, but they use it on a recurring basis, and you create this environment that's very, very sticky. And if you get to tens of millions or hundreds of millions of customers, then you've got such a valuable enterprise that monetizing it will be easy. So we didn't even think about it very much to begin with, because we just said, we have a technology advantage. We're going to lower the cost to operating this service to like near social media internet costs. And then if we build a big franchise, revenue will be easy to come by.
What was the original business you were going to do? Was it to be no-fee stock trading, or was that later?
So we got in business together at first, right out of grad school, because we saw an opportunity to trade. So no customers, just proprietary trading. And that was a business that was structured as a hedge fund. It didn't ultimately succeed. It was sort of like a fairly quick failure. But then we pivoted that into algorithmic trading technology. So we saw that algorithmic trading was basically going to eat the institutional space. We built software for that. And that actually led us to discover the Robinhood opportunity, because we said to ourselves, okay, we've got these customers using our completely automated systems to trade billions of dollars of volume a day. And the number of people that are needed to maintain this service is just a handful of software engineers. So what's preventing this technology from going to retail and giving the benefit of commission-free trading through this efficiency? So when we kind of put that together, we got very excited about the retail opportunity, and that's what ultimately led to Robinhood's creation.
So when you started, where did you get your capital?
At first it was angel investors, so we had to really just knock on a lot of doors. But you could invest in Robinhood as basically a retail investor, and we took all comers because we had to just work very, very hard to get our initial $1 million. So we had angel investors that would put in 50K, 100K checks. We would pitch them just like we would pitch the Sequoias and the Andreessens, and some of those people ended up doing quite well. Yeah, still holding on.
And today your market value is north of $90 billion.
That's right, yeah.
It's pretty impressive. So the person who invested on day one has made, I don't know, 9,000% or something like that, or more.
We've gone through a period where the stock price was kind of a negative distraction. Right. We would get questions about why it's so low, what we're doing to increase it, all that kind of stuff. And it can become a distraction from running the business, really. You have to contend with it. And so it's really nice for that to be gone so that we could focus on actually building real value and, working very, very hard to not have it be a distraction in the opposite direction where, people think that we've won, we get complacent, we stop caring as much. I think that's always, it's a self-reinforcing and self-correcting cycle.
You have started another company recently, is that right, Harmonic?
Yeah, so I'm chairman and co-founder of an AI mathematics lab. So this is getting back to my original passion to kind of understand how the world works and the laws of the universe. And that one actually just raised Series B financing led by Kleiner Perkins. So it's they've been cranking over there, building mathematical superintelligence.
So it used to be the case if you had a company like yours, a publicly traded company, 90 billion market cap, your shareholders would say, don't do anything else, don't get involved in any other business, just focus on this. But today, in the era of Elon Musk and everything, people can do multiple companies at once. So your shareholders in Robinhood don't care about your being involved in Harmonic or some other companies?
I would say my situation's a little bit different. I'm not operating there, so I'm executive chairman. And while it's certainly more than a typical passive investment, I care much more than I would for that. There's a CEO who's running it and managing the team. So I do think it's a little bit different.
And so today, how many different businesses do you operate? You're in the stock trading business, but you're in the tokenization business, you're in many other businesses. How many different lines of business do you have?
Yeah, at the highest level, we have a couple of large businesses. So the brokerage business is where we have our FINRA registered broker dealers. We have a introducing broker dealer, a clearing broker dealer. That's basically our brokerage business. Inside that, we also have a derivatives business where we operate a futures commissions merchant. And that's where our prediction markets and futures outrights properties live. We also have a cryptocurrency business, one of the largest in the world, and that's standalone and regulated differently. We have a business we call Money, which operates Robinhood Banking and the Robinhood credit card. And we have a few other acquisitions that we folded in. We acquired a registered investment advisory platform called Trade PMR recently. We acquired an exchange, Bitstamp, which has an institutional business as well. And there's a couple of other smaller things inside this. But yeah, it's a financial super app, business, institutional, U.S., global.
Let's talk about tokenization. For those who aren't experts in it, what actually is tokenization? Can you explain what that is and why that's a good business?
So tokenization is a new technology,
And basically the idea is you take any real world asset. It could be a public stock, it could be a private company stock, it could even be a piece of art or real estate, you know, a house. And you take that asset and you put it on the blockchain and you associate tokens with it. And then those tokens, leveraging blockchain technology, can be traded 24/7 in a global liquid market. So we've demonstrated it in two forms. Number one, tokenization of public NMS equities. So we launched a product in Europe called stock tokens that basically allows a customer to get exposure to US equities. You can buy, you know, a Tesla or an NVIDIA token 24/5, soon to be 24/7, and the experience and the process is as simple as trading a stock, even more simple. But then the real power is taking assets that are not easily liquid and tradable 24/7 and putting them on the blockchain, making them trade easier as well. That's where private companies and in the future real estate and things like art come in.
So since you started the company, AI has become a much bigger deal than it was at the time you started the company. And many of the AI companies sort of have very high market values and so forth. What is your view of the importance of AI to your business and to other businesses you might want to start?
I think that AI obviously is going to change everything. It's a huge platform shift, perhaps bigger than the shift to mobile and cloud. And every company, in the same way that every company became a technology company, I think that every company will become an AI company, but that'll happen at an even more accelerated rate. Most of the time, you're not doing it just because you want to make money. You also love trading, and you're extremely passionate about it. I think there will always be a human element to it. I don't think there's going to be a future where AI just does all of your thinking, all of your financial planning, all of the strategizing for you. It'll be a helpful assistant to a trader and also to your broader financial life, but I think the humans will ultimately be calling the shots.
So the United States economy is in reasonably good shape. We haven't had a recession for more than 7 years. Normally you have a recession every 7 years or so. We haven't had one. Do you worry about a recession affecting your business, or do you think we're in pretty good shape economically?
We've been through some cycles. You know, 2022, while maybe there's debate whether it was technically a recession, we got hit hard as a recently IPO'd undiversified growth stock that was, you know, heavily dependent on retail trading. And I think since then, we've made investments to make the business more resilient to all market environments. We have Robinhood Gold, our subscription offering. We offer high interest, which allows customers and us to benefit from increased rates. We've done really, really well on the active trader side, growing market share. And active traders actually do tend to be more resilient because they're sophisticated enough to employ multi-leg option strategies and things that could do well even in sideways or down markets. So business has gotten more diversified. Obviously, near term, we have to be prepared for ups and downs like any company. But I think that we focus on our market share, we focus on customers, we continue to diversify the business. The same strategy we've been employing will continue to work. I don't think it'll require a change of strategy for us to continue to be successful. My motivation is creating new things. If you create new things that are more useful, that's really what gets me excited.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Let's talk about your background for a moment. Your parents are both from Bulgaria?
Yes.
And you were born in Bulgaria?
I was born there as well.
So how did they happen to pick Washington, D.C. area to come to?
First, my dad actually went to Delaware. So he was given an opportunity to study for a master's at the University of Delaware in Newark. And it was not clear whether we would
stay in the country. You know, he knew he had this program, but afterwards was very uncertain. So he came by himself. My mom joined him a year later, and then I came 6 months after that. So I lived in Delaware for 6 months.
And you spoke only Bulgarian then?
That's right. So they put me in school right away. I mean, there was no babysitters back then. They needed school, so I got dropped into school.
But you're in school with everybody speaking English, and you're speaking Bulgarian. Was it difficult?
It was very difficult. Yeah, it was very difficult in kindergarten. But also, that's the fastest way to learn. You're highly motivated to learn when everyone else is speaking the language. So probably took me about 6 months, but yeah, I learned English very, very quickly. And I remember that. I remember like struggling to communicate with the teachers and you know, sometimes I look at my old kindergarten report cards. But yeah, there was a good upward trajectory.
Archie, you went to Stanford. Did you major in math?
I majored in math, and I found out pretty quickly that if you want to do theoretical physics, as I did, you spend a lot of time in the math department. So I ended up finishing as a math major, physics minor, pure math.
All right, so you did well there, and then you decided to do what?
Then I actually went to UCLA. My dream was to study with this professor, Terence Tao, who's, you know, some would say the greatest mathematician in the world. When I was in college, I had no idea that I would be an entrepreneur, much less so starting a financial services company. I wanted to be a mathematician. I wanted to make exciting discoveries and figure things out. And then what happened was 2008, I was first year in graduate school at UCLA studying pure mathematics. My co-founder, Beju, found a job at an algorithmic trading firm. And the first month that I was in graduate school, and his first month at this algorithmic trading firm, 2008 financial crisis began. So Lehman Brothers went belly up, stock market crashed, and he convinced me at the time that it would be a good time to start an algorithmic trading company. And I actually didn't understand what that was. I had no idea what algorithmic trading was. I was, you know, very much in the theoretical graduate student frame of mind, but I knew that I was a little bit stagnant and that this sounded like a really fun opportunity and I could learn a lot of stuff.
When COVID came about, a lot of people stayed at home and they didn't have a lot of other activities to do, so sometimes they were trading stocks. And it was said by some people that that really helped your company because people were trading at home. They were often next-gen people and they were younger people. Is that true that you were helped by the younger generation, people staying at home, buying stocks, or is that not really a way that your company grew?
That certainly happened. Between end of 2019 and 2020, our user base and our revenues and generally everything about the platform grew between 3x and 5x. So we were big before COVID, but the acceleration due to the pandemic and all of those tailwinds certainly accelerated the company quite a bit.
Let's talk about the company now. Today, you are a major force in the financial services world. And I guess you've got a lot of people who want to give you money and they want to invest with you and so forth. What is the greatest thrill that you're getting out of doing this?
I think my motivation is creating new things. Like if you create new things that are more useful and become the standard, that's really what gets me excited. And I think in a business context, that's innovation. You know, we talked about tokenization earlier. I think tokenization is the biggest innovation in capital markets since the central limit order book, right? I think it could change everything. And to have the opportunity to not just like attack that innovation, but bring with it the scale and the resources of Robinhood so that it could actually get the highest chance of succeeding and taking hold gets me very excited. Of course, zero commissions was an industry-changing innovation. Mobile finance and fintech in general, I think, was aided by the rise of Robinhood. But I always like to think about the new things in the future. A big tragedy is that private markets are where the bulk of the interesting appreciation and exposure is nowadays. We're obviously working to solve that.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Every weekday from 3 to 5 Eastern.
Only on Bloomberg. Context changes everything.
Welcome to the world of decentralized finance. Bloomberg is covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, Tuesdays only on Bloomberg.
What is the best investment advice anybody ever gave you? I assume it was hold on to your stock that you have because that's done so well, but anything else?
Well, the traditional investment advice is to make sure you're diversified and that you have a well-balanced, diversified portfolio. And I think that's interesting because nobody wants you to be diversified as a founder, right? So your shareholders don't want you to be diversified. They want you maximally exposed, in fact, to the one asset you're watching. So it's much more of a put all of your eggs in one basket and watch that basket very, very carefully. So for me personally, I think the rules are probably a little bit different than the conventional advice. I've been highly concentrated, and I think that's worked well.
Suppose somebody came to you and said, I have $100,000, I'm reasonably young, I'm a person who uses an account at Robinhood, but I don't really know what to do with $100,000. Where would you recommend they put $100,000 today?
I think one of the biggest opportunities, also a big tragedy, is that private markets are where the bulk of the interesting appreciation and exposure is nowadays. If you want early exposure or even medium to late stage exposure, as a retail investor, you're largely shut out. So in the days of a technology company going public at a valuation of the hundreds of millions and then giving you a 1,000 or 10,000x return in the public markets are getting increasingly more and more rare. So I think private markets are a huge opportunity. It's a shame that it's so difficult to get exposure in the US. We're obviously working to solve that, but that's where I would point to as like the greatest remaining iniquity and opportunity in our capital markets.
Obviously, when you get to be wealthy, people look at you differently. They laugh at your jokes more. They treat you with more respect. So now that you're a very wealthy man, how does your life change?
When I started the company, I was worth nothing. It went from basically like having my parents do my taxes very, very quickly to having professional accountants and things of that nature. I've gone through some swings, right? When the company went public in 2021, it was at a 32 billion valuation. So then my net worth, which mostly locked into company stock, got into the billions. Then it went down precipitously, and then recently it's gone back up again. But things haven't changed very much for me, as it might be a little bit surprising, because I was never really doing it for the money. I was doing it because I wanted to create stuff and make new things.
How do you spend your free time? Do you exercise a lot? Are you a big fitness person, or any hobbies outside of working?
My ideal model, and my wife actually really doesn't like this, is like full work-life integration, where kind of the distinction between the two falls away. And I actually think if you really enjoy what you're doing as an occupation, there can't be another way. Having like a break between your work and your personal life becomes very, very odd. The two meld into one. I think she would probably prefer a more Severance-like experience, but I think it's just unrealistic.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Watch Horizon's Middle East and Africa every trading day at midnight Eastern Time, only on Bloomberg.
Bringing you up to the minute news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Next year, you have the hallmarks of a potentially pretty exciting year.
Balanced portfolios make a lot of sense heading into 2026.
Setting this up for a year where you're going to see a lot of churning, but have moderate returns.
We see a huge amount of appreciation across the AI names. There's a question of which ones and how long can that run for.
Respect the trend, but don't ignore the risks as we go into 2026.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Happy holidays, happy new year. Good morning. Welcome to Bloomberg Surveillance on this holiday Monday, closing out another year of double-digit returns. Stocks stalling out a bit to start the final week of 2025. Gold and silver losing a bit of luster after an unprecedented run. Investors casting doubt on the depth of the debasement trade and pressure for peace between Russia and Ukraine, resulting in hopeful rhetoric, but few definitive resolutions. Good morning. John is out on paternity leave. Anne-Marie is on holiday. We are playing tag this month, but we got lucky today. And joining us is Matt Miller, co-host of Open Interest. Matt, thank you so much for being here. What a ride it's been. It seems like this is a market that is struggling to get to some sort of final finish that can push to new highs.
Yeah, absolutely. I mean, the Santa Claus rally, right? Last week felt like it was in full swing, but actually the Santa Claus rally is only officially the last 5 trading days of December. So we've only seen 2 so far, and the first 2 of January, according to Yale Hirsch from the Stock Traders Almanac. So we're up a little bit in the first 2 days of that, but I think investors still have high hopes for the next 5.
Thank you for the technical analysis of Santa Claus rally, because ultimately that is what we're going to be looking for, is some sort of culmination to a year of another double digits, the third straight one for both the S&P and the NASDAQ this morning. Just failing to really pick up steam right now. You are seeing slight declines across the board, but betting on that broadening out trade. This to me is interesting. Russell 2000 futures almost flat, even though S&P futures are down about 0.25%. 10-year yields lower 4.1%. The idea of how much we've gained, it's actually been, Matt, the best year for bonds going back to 2017. So for all the people talking about the debasement trade in U.S. Treasuries, we really haven't seen that with this bet that next year we will get a Fed that is accommodative.
Yeah, it's pretty impressive. I often look at the chart from the beginning of the cutting cycle. So we're down, I think, 175 basis points in the Fed funds rate from September of 24. And yet the 10-year yield itself is actually up about 50 basis points. So if you bring it out, obviously you can cherry pick depending on whatever dates you pick. But if you bring it out to the beginning of the Fed cutting cycle, it hasn't helped much in terms of yields.
Which really raises a question next year about what's going to matter most, the Fed or the 10-year. Meanwhile, a big question around the debasement trade, and you have seen that silver and gold issue kind of percolate after going parabolic. You suddenly saw this real removal from that froth, down about 5% on intraday trading of silver. There is a question about the debasement, and yet the dollar has pretty much traded sideways since Liberation Day. Coming up this week, what we have is not a stock plate. What we are looking at is jobless claims on Wednesday. Before that, we get Fed meeting minutes, get some housing data, but otherwise pretty light on that. Also focus very much in Washington, D.C., and we will be getting more on Ukraine and Russia and a possible peace there. Coming up this hour, Cameron Dawson of New Edge Wealth with stocks near record highs. Bloomberg's Skylar Montgomery Koenig with the dollar on course for its weakest year since 2017. Plus, our conversation with JetBlue CEO Joanna Garrity on the airline's outlook for 2026 and beyond. We begin this hour with stocks stalling out after approaching new record highs. Cameron Dawson of New Edge Wealth writing, the biggest question for 2026 is whether or not everything else else can strike back and deliver the earnings growth that is necessary to unseat the narrow Mag 7 leadership next year. Cameron, I am so pleased to say, joins us now. Cameron, thank you so much for being with us, and happy holidays. Great to see you. This broadening out trade and the real question behind it, when will we get the data and the information to understand whether it really is valid?
It really is a show me story in 2026 as to whether or not the equal weight S&P 500 can deliver on what are some pretty high expectations for earnings growth next year. If you look over the last 3 years, you've been in an environment where the largest parts of the market have driven the vast majority of the earnings growth, which is why you've had the vast majority of returns come from these Mag 7 names. But that's expected to narrow, not quite flip, but narrow in 2026. So you can see it in something like the equal weight S&P 500 having expectations for revenue growth to accelerate from 1.5% in 25 up to 5% in 2026. So a lot is riding on this idea of EPS delivering. And of course, that will be a show me story as we move through the year to see if there is upside to those numbers, or if yet again, we'll be in an environment where Mag 7 gets revised higher and equal weight gets revised lower.
So you add to this story something that happened last week. There actually was a big piece of news last week. NVIDIA had this agreement with Grok, which is a chip designer, some $20 billion valuation of this company, doubling it over the past couple of months, and raising questions about the dominance of NVIDIA, but also whether there is a shift in narrative around the AI story to one that is more efficient, more useful, and cheaper for some of the end users.
I think no better way encapsulates this idea of potentially a narrative shift is looking at some of the non-profitable AI-related names. They, of course, were leaders coming out of the April lows and saw an absolute frenzy as we moved into the fall with September and October rallies that were truly eye-watering. But what's been fascinating is that they have not participated in this latest move higher. If you look at something like the Goldman Sachs Non-Profitable Tech Index, or look at something like ARC, those indices have not made new highs, which just suggests that maybe, just maybe, there's some rationality entering into this market, which we would welcome and see as a good thing, because that kind of rally in unsustainable, unprofitable names is not something that we would see as healthy for the market.
What do you expect from M&A in, I mean, not just the Mag 7, but in AI? I was pretty stunned after seeing that Grok deal when I looked on the FA function on the Bloomberg terminal to see free cash flow at NVIDIA is just gone parabolic, right? Last year it was 27 billion. This year it's 60 billion. Next year it's expected to be 95 billion. I mean, they are just raking in cash and are able to deploy 20, 30, 40 billion dollars without even thinking about it.
Yeah, I think it's a really good question, and it raises the question of where we sit in the semiconductor cycle, because we do know that at the end of the day, semiconductors are a cyclical business. And if you go back to prior cycles, you typically do see earnings grow by 100, 120% plus in up cycles. Then, of course, you do hit an inevitable down cycle. And we're now in an environment, if you look at the overall SOX index, that earnings are up about 150% off of the late 2022 lows, which just suggests that possibly we are closer to the end of this semi-cycle than we are to the beginning. But I think it's also very arguable that this semi-cycle will go further and last longer than prior ones, simply because of the secular tailwinds of something like AI. But it's important to remember that it's always this time is different with cyclical areas. If you remember last time, it was the Internet of Things and we were putting chips in everything, and that's why we weren't going to have semi-cycles anymore. I think the real question will be is how much further can this go? And is that free cash flow that NVIDIA is generating today something that we can extrapolate into perpetuity? Possibly not.
What happened, Cameron, to the terror of Liberation Day? I mean, the economic uncertainty that we were all wringing our hands about, right? These tariffs that admittedly have been muted a bit by the drop in the dollar, almost 10% year to date. Is any of that a concern next year, or have we realized that it's actually no big deal?
I think that if we were to see the tariffs as a concern, it's really captured in this conflicting kind of headline We got a headline over the weekend saying that bankruptcies are at their highest levels since 2010. And then you pull up corporate profits in overall in the US, and they're at new highs. And so this suggests that tariffs are hitting things like smaller businesses harder. They're also hitting smaller consumers harder who have a higher propensity to spend of their overall incomes. So when you put that together, it really encapsulates this idea that tariffs exacerbate the K-shaped economy. They hurt lower income consumers, they hurt smaller businesses much more than they hurt larger businesses and higher income consumers.
I just wonder, Cameron, how long you can see this rally continue unless you get participation that does broaden out. This idea that you can see an economy that's growing at the fastest pace in 2 years on headline GDP, yes, it's noisy, but a lot of it's data centers. It's not actually the mom and pop stores that are declaring bankruptcy.
The one thing that does give us a little bit of solace in thinking about this broadening out is contrasting where we are today in breadth measures versus where we were last year. Last year at this time, you only had about 20% of names trading above their 50-day moving average. It was an incredibly narrow market, which we thought made it more fragile. If you look today, that stat is at 64%. So it doesn't necessarily mean that we are immune to everything, but it is encouraging that we are seeing broader participation in the rally, that it's not resting on just a small handful of names. So using the banks as example, if the economy was really falling off a cliff, we don't think that we would be seeing bank earnings revised higher nearly as much as they are and banks hitting new all-time highs. Some of that rally might be a little bit extended, but I think it's important to note that there are still some signs that cyclicality is being well bid in the equity market, which just give us a little bit more comfort that things aren't as extended or maybe broadening out in a better way.
Cameron Dawson, with sun pouring in from a lovely place wherever you are, we will be sticking with you. You will be sticking with us of New Edge Wealth. Matt, you talked about the Grok deal with NVIDIA, and I found this just fascinating. What we saw last week on Wednesday night, it was almost like trying to be buried, right?
Yeah.
That NVIDIA would enter into a non-exclusive licensing deal and hire most of Grok's employees. Grok is a language processing type of outfit, and this idea that they are trying to get more competitive with the likes of Google and their chips in a way that could avoid some sort of antitrust claw. It just highlights how dominant they are with the cash that you were talking about.
Yeah, I think it was a really fascinating deal. The timing was an interesting part of it because it's largely gone unnoticed, right? And yet it was a huge $20 billion deal. The thing is, they just have so much free cash flow. In fiscal 27, they're looking at estimates are for $150 billion. So you see a lot of these big AI companies, including OpenAI, doing deals quickly, reportedly without many lawyers or bankers, and spending a ton of money because they want to take advantage of the valuations and the cash they're getting right now.
And they can get the dominance of the field, given the fact that they have that endless cash and they're doing it to try to solidify some of the potential competitive threats. We'll kind of parse through this throughout the show because I do think just because they bury it doesn't mean that we have to bury it. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anna and Yahira.
Good morning, Lisa. President Donald Trump says Ukraine and Russia are, quote, closer than ever before to a peace deal, but said it might take a few weeks to get it done. Ukraine's President Volodymyr Zelensky says the peace framework is 90% agreed and that U.S.-Ukraine security guarantees are 100% agreed, but major sticking points remain, including the future of Ukraine's Donbass region. Meanwhile, Israeli Prime Minister Benjamin Netanyahu meeting with U.S. President Donald Trump at Mar-a-Lago today to discuss issues in the Middle East, including Gaza and Iran. The meeting comes as tensions between the two leaders have increased, with Trump having previously warned Israel against taking actions that could undermine his peace efforts, and Netanyahu facing political pressure at home to take a tough stance on Gaza and Hamas. And China kicking off maneuvers around Taiwan, including live fire drills near the Taiwan Strait. The move comes after the U.S. announced a major weapons package for the self-run democracy. Taiwan's presidential office called the drills a serious threat to peace and stability. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahira. Up next, closer than ever for Ukraine.
I really believe we're probably, Mr. President, by far closer than ever before with both parties.
20 2-point peace plan, 90% agreed, and U.S. Ukraine security guarantees, 100% agreed. Prosperity plan being finalized.
We've got more on that just coming up next. Bloomberg's Tyler Kendall joins with some of the details from New York. This is Bloomberg Surveillance.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Welcome back. What we are seeing this morning is stocks trying to get back to that fervor. That Santa Claus rally that Matt was just explaining does consist of now. This is the race into year end. It is not continuing with some of the fervor that usually happens at this time of year, down about 0.25% for S&P futures. But interestingly, Russell 2000 futures unchanged. And this, to me, Matt, is really the question. Can you get that broadening out that so many people are counting on to really lead the market higher in 2026? And if you can't, is it still sustainable?
Yeah, actually the small caps, though, have done really well over the last couple of months in hopes that the Fed would continue to cut, right? They're helped the most. I think 40% of the Russell 2000 is unprofitable or some giant figure like that. So they really need those rate cuts, and that's where the Fed really matters going into 26.
So let's take a look. 2s, 10s, and 30s. What you have seen is a rally. You've seen the best year for Treasuries wholesale going back to 2017, although Matt could point out that at the beginning of the cutting cycle, maybe it sort of fudges exactly where we've been. Nonetheless, you are seeing that 2-year yield pegged at 3.5% or just below 3.47%. The 30-year yield has hovered, though, around that 4.8%. To your point, Matt, there is a feeling that just cutting on the front end is not going to help the long end, especially with ongoing questions around who the buyer base is going to be next year for Treasuries.
Yeah, you know, it's interesting. Cameron Dawson mentioned that story that I think more than 700 companies have filed for bankruptcy this year. And they listed the reasons. Inflation was number one, but rates were number two before tariffs. I thought that was really interesting. So if rates continue to come down, that'll be really helpful, obviously, to the smaller businesses that have gone bankrupt in this environment.
Yeah, meanwhile, in the metal space, and this has been sort of the ongoing debasement trade and a question around whether it truly is that. You had seen prices go parabolic in silver, truly just shocking gains, particularly over the past week and a half. Suddenly you're seeing a little bit of froth coming off of that down about 5%, 4.8% now in pre-market trading. But a question here about whether this is real or whether this is speculation. And it comes in the heels of a real question that's been bleeding out in the gold market throughout the bulk of this year.
Yeah, whether or not this is the debasement trade was the subject of conversation in last week's shows that I was hosting, because you haven't seen the dollar really fall that much. I mean, it's like 8% year to date, right? From the peak, it's not even 12%. But the thing is, maybe currencies around the world are also coming down to some extent. So the question is, what's driving gold and precious metals higher? Silver obviously has industrial uses, so it's a different story. But the rally in gold has been eye-popping as well, right? 70, 80% year to date.
Yeah, and some people speculating it could continue based on central bank buying. This really has to do with the geopolitics of the moment, which seem to be in focus, certainly in Washington, D.C., under surveillance this morning, closer than ever for Ukraine.
I really believe we're probably, Mr. President, by far closer than ever before with both parties. If it went really well, you know, maybe a few weeks, and if it went poorly longer, and if it went really poorly, it's not going to happen.
20-point peace plan, 90% agreed, and U.S. Ukraine security guarantees 100% agreed. U.S. Europe Ukraine security guarantees almost agreed. Military dimension 100% agreed. Prosperity plan being finalized.
Here's the latest. President Trump and Ukraine's President Zelensky hailing major progress made over the weekend toward a potential peace deal with Russia. However, talks failing to produce a major breakthrough. Bloomberg's Tyler Kendall joins us now. Tyler, thank you so much for being with us. So do we have any sense of what the progress really was that was made over the weekend?
Hey, Lisa, good morning. Well, at this point, we saw both sides really tout that there is optimism here, right? We know what the big sticking points still remain to be. President Trump yesterday saying that the thorniest issue on the table is, of course, the future of any potential land concessions, as he's previously suggested that Ukraine is going to have to give up territory in the eastern Donbas region as part of any future deal. It is our understanding that there has been an agreement reached in the draft proposal that would include a referendum vote on what happens to that eastern region. But Ukraine needs to see some critical conditions met first, including that Russia would withdraw its troops. The other big part, of course, security guarantees. What are those going to look like? Both sides, again, hailing progress, as it is our understanding, and we reported earlier this month that the U.S. has put on the table something that could mirror NATO's Article 5 mutual defense clause. We are now learning this morning that Zelensky did ask President Trump directly yesterday at Mar-a-Lago for those guarantees to extend to 30 or 50 years. Now, this White House has repeatedly said that responsibility is really going to fall on our European allies, which is why it's important and notable that the pair of leaders did have a call with European leaders yesterday after they met face to face. But to your question, Lisa, one of the biggest questions here is, what is Russia really going to agree to? That is, of course, what we've seen when it comes to engagement on the Ukrainian side. But in his call yesterday with Vladimir Putin, President Trump said that Russia is still not interested in a ceasefire before any potential peace deal. And we've heard openly from Russian officials that there are some parts of this now 20-point plan that are non-starters, including the proposed size of Ukraine's post-war military. I will say, in one potential sign of progress, we did hear from the Kremlin that they have agreed to create 2 working groups. That was a proposal put forward by the U.S., and those are the people that are going to run point to continue negotiations between the 3 countries.
Tyler Kendall, thank you so much for that. Cameron Dawson of New Edge Wealth still with us. And Cameron, how much do you count on some of the rhetoric that we've heard over the weekend as something concrete that is, just since this is what we do, tradable in the sense that this could be the emergence from a war state in Europe?
Well, we continue to just watch one thing, which is oil prices and gasoline prices, as far as how much a war in Europe matters for U.S. markets and U.S. earnings. And we continue to be in an environment where gasoline prices are falling. It's pretty incredible. Over the last month or so, we've seen 30 cents off the daily national average gasoline price come out. We're now at $2.80. And that's such a far cry from the high of $5 that we reached in the aftermath of the initial invasion of Ukraine by Russia. So as long as you are in an environment where those energy prices remain contained, it's likely something that the overall market, at least in the U.S., continues to look the other way and not see it as a major driver of impacting returns.
And there's been no impact, even though we talk about Venezuela a lot, obviously it's important for foreign policy and potentially, human rights. There's been zero impact really on oil, right? We see Brent just creeping above $60, but not much more.
And maybe just diesel prices. That would be the one thing to watch with Venezuela, because they have heavy sour crude, which is very important for diesel production. And so that's been a market that has been a little bit tighter than what we see in just normal gasoline prices. And so as we think about the impact of energy prices, that is a major wild card for 2026. Over the last 3 years, we cannot underappreciate how important falling energy prices has been, not just for headline CPI, but also for the U.S. consumer. It's effectively been a tax cut for U.S. consumers. So each and every month, we've been in an environment where year-over-year gasoline prices have been falling. This is a boon for U.S. consumers, and if it were to turn in the other direction, that could certainly be a headwind for consumption as well as headline CPI for 2026. It's a wild card. It's not our base case because of some of these dynamics of oversupply, but it's certainly not something that we should ignore.
How much is that outweighed, Cameron, by the run-up in electricity prices that the consumer faces, sometimes 200% of what it was a year ago, the run-up in natural gas prices that the consumer faces because that's the dominant power source used for data centers? I mean, AI is pushing up energy across the spectrum other than oil.
And certainly, we're seeing it in elections as well as coming into top of mind for consumers. And so just as they're potentially getting this tax cut on the pump side of things with cars, you're seeing that pressure in overall electricity prices. And there's a great argument that this is what creates the perception of higher inflation than what we might get in overall statistics because of the dynamic of frequency bias, meaning that you go and fill up your car more frequently, you pay your energy bill at your house more frequently. So you feel those prices going up a lot more than you feel the prices going down of certain goods that you buy less frequently, which is one of the reasons why we continue to see this high levels of readings in things like University of Michigan surveys on outlooks for inflation, even though when you contrast that to what the bond market is saying, the bond market continues to be very optimistic that inflation will fall back down towards the Fed's target, with five-year forward inflation break-evens and swaps looking at just about 2.4%. So there is a contrast there into the inflation we feel as consumers and then the inflation that is perceived or expected by bond markets.
Spoken like someone who truly has traveled this season. Cameron Dawson of New Edge Wealth, thank you so much for being with us, and happy holidays and happy new year. Coming up, my conversation with JetBlue CEO Joanna Garrity on how the airline is gearing up for a key year ahead. Plus, Guy Johnson with your morning movers. Silver pulling back after that record rally. Meanwhile, copper surging to new record highs. From New York, this is Bloomberg Surveillance. Good morning.
to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop. I'll still be driving some.
Yeah. Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Some people travel to see the world. I travel to question the forces that shape entire nations.
How was it possible?
My name is Professor Hannah Fry. I want to meet the people with unexpected stories to tell and dig up the peculiar and wonderful treasures that reveal what a country is made of.
Yes.
It's supposed to be that Santa Claus rally time, and we're not feeling it, at least right now. But still, when you take a look at S&P futures, you can see pushing toward all-time highs, even though you are down about 1/4%. Matt, how far are we away from that 7,000 mark? You've been doing calculations over there.
I'm not a
on your
math
slide
whiz,
rule.
but it looks to me like 1% away from 7,000 in the cash trade, because we're at 69.30.
Yeah, this has been another double-digit year. It's been more than 20% the previous 2 years. Right now, we're up some 18, 19%. On the NASDAQ, you're up 22% year to date, with people expecting more to come next year, which is sort of the interesting aspect of this. The euro just losing a little bit of luster versus the dollar, still around that 117.63 mark, where it's been hovering for the past couple of trading sessions. A bit into treasuries, down 2 basis points ahead of the Fed meeting minutes that we get later this week, 4.11%. And copper up almost 2%. It was up 5% earlier in the session, surging ever higher. Why, I guess, is the question. Is it physical demand? Is it speculation? Is it a little bit of everything? A lot of people looking to Dr. Copper for some signals.
Yeah, to me, copper is almost more fascinating than silver, right? Precious metals make sense as a safe haven if you're worried about any number of things. But like silver, copper has industrial uses, even more, arguably. And normally you see copper surge when giant economies like China are building ghost cities. They're not doing that right now. I guess we're building data centers, but I wonder what people are using it for.
The reindustrialization of the world, are we seeing it in the price of copper, or is it speculation about the industrialization of the world? 3 hours away from the cash open, here are your morning movers with Guy Johnson. Guy.
One of the reasons why copper might be higher is because people are building a lot of data centers. And that's evidenced in the stories that we're watching this morning. Lisa, let's start with the first one. Digital Bridge Group. So this is a private equity company. Now, remember a few weeks ago, SoftBank sold out of its NVIDIA position. Apparently, there were tears. Now we're starting to see evidence maybe of how that money is going to be deployed. This is a private equity company. It's based out of Boca. It's based out of New York. It's based out of LA. It invests in data centers. And this is why SoftBank is interested in it. The stock is up by 34% pre-market. Advanced talks for SoftBank to buy this company. Now, it has bought private equity companies in the past, hasn't done so for a while. This is going to be interesting to see how this one turns out. So keep an eye on that. Tech generally is a little softer today, though. One of the reasons why some of the futures picture you were talking about, Lisa, just a moment ago, is indicating that we are going to maybe move down. Tesla's one of them. NVIDIA's one of them. NVIDIA's down by 1.26%. I can't find a decent reason for this other than the fact that, yeah, we saw a decent pre-Christmas tech rally, and maybe some of the chips are being taken off the table after Christmas, but I can't find any decent reason for it. So let's get on to the metals trade. I'm not going to do copper, but I am going to do silver. Let's talk about some of the silver stocks. First, Majestic Silver, great ticker, AG, obviously. That is for the periodic table fans. Down by 2.76% this morning. The reason for it, looks like silver's going to get choppy now. It's had this incredible run up. As you can see, we'll move it on a board and show you what's happened with silver. It's a gold story as well. You've seen it here in Europe this morning with Fresnillo, but you're starting to see silver maybe just moving off a little bit. You can see it over there, just a tick lower, but it's producing a decent response in some of these stocks. But silver's had an incredible run. Year to date, up 161%. So silver's certainly moving some of the stocks this morning. You're also seeing some of the miners moving here in Europe on the back of that copper trade as well. Lisa,
thank you.
Back over to you.
Thank you so much, Guy. Wonderfully said, and everybody's trying to bet on the physical economy heading into 2026. On our radar this morning, President Donald Trump saying Ukraine and Russia are, quote, closer than ever before to a peace deal. Ukraine's President Zelensky calling the framework 90% agreed with U.S.-Ukraine security guarantees, 100% said, but warns that clashing over the Donbass region remains a hurdle. And it comes, Matt, right after we saw Russia lobbing a slew of missiles over at Kyiv over the weekend, raising questions about how serious Russia is about some sort of truce.
Yeah, I think it's, obviously it's a horrendous war that has continued for far too long. To me, one of the most fascinating threads was Sergei Lavrov, who I thought had been on the outs, the Russian foreign minister, made a comment over the weekend that Europe is now the problem. He said, since Donald Trump has come into power, the U.S. is no longer the problem. We've fallen into line, right? But Europe still continues to confront Russia in ways that he doesn't like. And I just thought that was pretty telling.
It was telling, and yet you saw rhetoric from President Trump saying that Europe is great, Ukraine is great, Russia is great, everyone's great. And it raises this issue of where is their daylight, right? We haven't really understood what the sticking points are going to be, the 90% done. And also, if it's 100% guaranteed that they're going to have some sort of security guarantees, why not just count on NATO? A lot of questions here.
Yeah, I think the Donbass region is probably the biggest sticking point. How much land Ukraine is going to have to secede, and one of the big problems there is that it may not be legal. Even if it's agreed by Zelensky and Trump and Putin, the country may still have to vote on it, and it's very unpopular in Ukraine to cede, I should say, land.
Yeah, meanwhile, we're really focused domestically on what's going on in the AI space. NVIDIA striking a licensing deal with chip startup Grok. The deal announced just before Christmas looks to give NVIDIA an edge in the AI race, particularly with language processing units. Under the agreement, Grok CEO Jonathan Ross and other executives will join NVIDIA. However, financial details were not released, except that Grok is valued some 3 times what it was a couple of months ago at $20 billion. And it's a non-exclusive licensing deal to try maybe to avoid some of the regulatory or the antitrust concerns, while also hiring 90% of the employees from Grok. I mean, it just highlights what the playbook is for tech giants that have more cash than they know what to do with.
Exactly. That's the most important point. They have so much cash. Right? And this is an acqui-hire. I hate that portmanteau, but that's what it's being called, because they're paying essentially $20 billion to get the employees of a company that was valued at less than $7 billion just a few months ago.
Yeah, I mean, this to me is going to be an interesting playbook going forward. And how much can they get away from some sort of regulatory scrutiny and Washington, D.C. scrutiny by structuring it this way? Meanwhile, Bank of America CEO Brian Moynihan saying he expects the Trump administration to de-escalate trade tensions next year.
To go from a 10% across the board to 15% for the broad base of countries is not a huge impact, and that's where our team says it's starting to de-escalate, and that you're starting to see the resolution of the discussions into your 15% here, 17%, different numbers.
Moynihan adding that China deals are a special case due to the national security interests, rare earth minerals, and artificial intelligence. It does seem, as Matt was mentioning earlier, that we have left some of that behind in terms of trade tensions. What happened after Liberation Day? Well, we kind of just surged from there.
Yeah, exactly. And I mean, Moynihan thinks that or says that Trump is going to de-escalate from 10% to 15%. Well, he didn't mention the fact that we started out at 2%, right? So that's really not a huge de-escalation if you look at it in whole.
Well, and this really goes to the question of how much the consumers are able to absorb, which is the reason why we are watching the travel sector so closely. JetBlue's CEO saying the company expects to see the benefits in sales and cost efforts next year. I sat down with Joanna Garrity to discuss the airline's 2026 outlook. Take a listen. I want to start with just how this fits into the strategy of JetBlue right now to make the airline truly profitable for a sustainable period of time.
Yeah, thanks for the question. Great to be here and have you in Blue House, JetBlue's first foray into lounges. This is very much part of our Jet Forward strategy. We've been working very hard for the last several quarters on really turning towards premium and trying to make sure that we're offering more opportunities for customers who want to pay a little more. And the lounge is part of that. Our transition to a first-class product next year, a domestic first-class product, would be part of that. Our Premier card, our Even More as a cabin, and really excited to start seeing all of that come to life in 2026.
All of the big airlines have talked about loyalty and how important loyalty and premium offerings is to their profitability going forward. How is it different for JetBlue? Because there isn't the sort of obvious business customer that typically fuels the loyalty offering.
I mean, we're a leisure carrier. We tend to get, a nice share of business customers because they love the product. We're back at the top for Net Promoter Score, so really proud of that. But at the end of the day, this is really designed around trying to make sure that customers who travel for vacation have a reason to come back again and again, and providing with a little oasis of peace. And, really through our loyalty program, we want to reward people who choose JetBlue because they love the product, the service, and what we offer.
You have already offered Mint and other premium rollouts. How has it been going?
It's been great. Mint's been a very strong source of revenue for JetBlue for well over the last decade. And so we're not new to this. We have a brand that, definitely associates with more of a higher end leisure customer, providing more to customers at a very reasonable fare. And we want to make sure that we offer something for everybody across the full spectrum, whether you want sort of a dialed down experience, still free Wi-Fi and great leg room and great snacks and drinks, TVs. But then if you want to pay a little more, you have the opportunity for a lounge, our Mint class for transatlantic, and then when we launch domestic first later this year, that's going to be a great product offering for customers who want a little more.
So I was shuttled into here through very long security lines and lots of people with screaming children trying to get to different destinations for their warm holidays. This is the busy season. How is it looking in terms of demand, given the fact that there were some hiccups in the past couple of months, but at this point, people are getting back to what they originally had?
Yeah, 2025 has been a very tough year, whether it was the macro setback or the government shutdown or the list goes on and on. We're really looking forward to the holiday season. Bookings are coming in strong. As we go into 2026, we're optimistic that the consumer is healthy and that we're going to start really ramping up the initiatives that we have been working really hard for the last year to execute to and seeing the benefit as we move through 2026.
How long do you think it'll take before you start to actually turn profitable and sustain that?
Our goal next year is to break even from an operating margin perspective, and that's the first step back to profitability. We have a great team here. Everybody's pulling for us. We're doing all the right things, whether it's our focus on operational reliability, Net Promoter Score, all of the premium products that we're launching, our laser focus on costs, and really trying to make sure that we're delivering a great product offering for customers, because JetBlue has this wonderful brand and this sense of people want to love us and they want to see us succeed. And 2026 is going to be our year with everything we've put into place.
Because 2025 was not the year for a lot of airlines.
Tough year for airlines.
There were a lot of issues, and you talk about the government shutdown. This has been a big discussion among a lot of the airline CEOs, where they've said we just can't make up that kind of revenue. So there will be some sort of hit. Have you disclosed any kind of revenue loss as a result of some of the shutdown?
We haven't disclosed any kind of revenue loss. We've said that we remain on track for Q4, and I think we're pleased with what we're seeing in terms of bookings coming in for the balance of the month. We definitely saw some softness, obviously, during the government shutdown, but we're recovering coming out of that. I think most have shared that, but it was definitely an impact, and unfortunate that the airlines were put, right in the middle of that shutdown. All the great air traffic controllers and the TSA workers, they need to be, cast as essential workers. We really need to make sure that, if anything, this industry is so essential to our economy. Think about all the people who are traveling for weddings and funerals or doctor's appointments that were displaced because we couldn't get on the same page in Washington, D.C. So we're really hopeful that, we've turned a page there and that we can move forward, looking at that end of January date with, a little bit of nervousness, but I'm confident that D.C. will pull it together and get us in the back end of that.
Yeah, you somehow, being an airline CEO, probably wasn't in your bingo card that you'd be well focused on healthcare legislation with your fingers crossed heading into January. I'm wondering how much you're hoping to attract a new class of customers versus capitalize on the ones that you have that might be willing and able to pay a little bit more with some of the new offerings.
Yeah, it's a little bit of both. We know we have customers today that want our first class product, and so it's really really, offering that to them so that they can buy up when that opportunity presents it. But it's also making sure that we're competitive with the industry. Everybody's moved towards premium. We're going to continue to move towards premium because it is a resilient customer segment. But we're not going to forget the folks that fly in our coach product. I mean, they're just as important, and we want to make sure that JetBlue offers something to everyone.
It really does feel a little bit like the Sharks and the Jets when you speak to some of the airline industry CEOs, where they talk about, it's become a game of consolidation, and it's become a game of the big fish really dominating the fields in a lot of different ways. They say it's going to be very hard to be a more budget-focused airline. How do you fight back? How do you sort of create a viable business model at a time when you do see this consolidation of profitability and travel in the biggest airlines?
I mean, it's definitely hard. We talk about the need for a more level playing field. When 4 carriers have 80% of the domestic seats, that's a real problem. We fight very hard in D.C. to try to make sure that we're heard, that the challenges we face, whether it's cost pressures, the lack of scale, the lack of, consolidated purchasing, the, inability to get access to gates. We just bid on a gate, a Heathrow slot, and we were denied it. And so, while I maybe understand why it went to a legacy larger carrier, those are little things that add up over time. And the smaller carriers really need to be given a fair shot to win in this environment. And that's not happening right now. So we're focused on what we can control. We're focused on a whole series of initiatives under our Jet Forward program. It's getting us moving in the right direction. I'm excited about what it's going to bring. But we do need the government to kind of make that a more level playing field so smaller carriers can more effectively compete.
In the meantime, you do have this cooperation with United. You've been expanding in a host of different places. Is that the template going forward? Maybe not consolidation due to the recent issues, but in terms of the previous merger that was denied, but going forward, having some sort of partnership with major airlines to expand the routes.
Yeah, we've got 50 airline partners across the globe, and now we have the Blue Sky partnership with United. That is most certainly a part of trying to provide more utility to our loyalty program and providing a broader global network for our customers when eventually in Q1 they can book a JetBlue flight on United.com and vice versa through our interline agreement. And so we're excited about what it's going to bring. Does it solve the problem fully? No, it doesn't, but it's definitely a meaningful revenue initiative that gets us back moving in the right direction.
Do you anticipate consolidation at any point in your future, or is that sort of on the back burner still?
That's on the back burner. We're really focused on Jet Forward. I'm really excited with the progress we're making. We're seeing it. We're seeing improved operational reliability, improved customer scores. We have not let the grass grow under our feet in 2025. We've executed a whole series of revenue initiatives. We've kept our costs under control despite pulling a 1.5 capacity this year. So 2026 really is the year that we should reap the benefits of all these initiatives that we put into place in 2025.
That was JetBlue CEO Joanna Garrity speaking with me just in the past couple of weeks after opening their first lounge in JFK. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. China is vowing to expand government spending. Beijing plans to boost expenditures and strengthen the spending power of local authorities in an attempt to balance growth and contain debt risks. It plans to spend more on, quote, new productive forces like advanced manufacturing and tech innovation. Meanwhile, President Trump saying his administration knocked out a big drug facility in Venezuela last week. The strike would be the first known land attack on the country since the administration began its campaign against Venezuela. This comes as the president ramps up pressure against the country's president, Nicolas Maduro. And North Korea says it conducted a long-range strategic cruise missile launch drill over the West Sea Sunday as it continues to showcase its weapons capabilities amid regional tensions. The country's news agency says it was carried out to test counterattack readiness and combat capabilities of its long-range missile units. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahaira. Up next, the year of dollar softness.
2025 has been a year of dollar softness. The dollar has been softer, but we shouldn't overread that. The bid for U.S. assets, including the dollar, on balance continues.
Bloomberg's Skylar Montgomery Koenig joins us next as we look ahead to the possible debasement trade, or is it? This is Bloomberg Surveillance.
in case you missed it on Balance of Power.
Let's play a game. Who's your favorite recording artist?
Kiss.
No, come on. Somebody from the past,
Why can't
present,
we go
or
with
future.
that? All right, Jimi Hendrix.
Jimi Hendrix has never in his entire career or now ever gotten paid a single penny when his music is played on AM and FM radio. The stunning fact is that the Russians and some other countries actually do pay performing artists on radio, and Americans do not. And this has got to change and should change. No matter who you hear on AM and FM radio, they're getting 0 pennies for the airplay. The new artists, every penny counts. And the fact that they can be played on radio and not even make 1 penny for their performance is criminal.
Don't miss Balance of Power live every weekday.
Technology is embedded in every aspect of our lives and laying the foundation for the future. From finance to defense, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets. I'm Annabelle Drulers in Hong Kong. I'm Sherian in Tokyo. Watch Bloomberg Tech Asia, only on Bloomberg Television.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ. Mondays on Bloomberg.
Trying to get that holiday feeling, that holiday spirit into the equity market right now, not really feeling it. Seeing right now declines on futures, lower by about 0.2% on the S&P. Still, as Matt pointed out earlier, about 1% away from that 7,000 mark as we do end the year near record highs. Meanwhile, a bit of dollar strength here, although just 117.67 on the euro-dollar cross, and the 10-year yield getting a bid down almost 2 basis points to 4.11%. Copper, check it out. We have faded an almost 6% rally earlier in the session, now up just 0.6%. To Matt's question earlier, who's buying it? Well, I guess some people are asking that question and fading some of the earlier gains that we had seen. Under surveillance this morning, shifting gears to the year of dollar softness.
2025 has been a year of dollar softness, but most of that dollar softness was built into the first few months of the year. It's really been steady as she goes since the summer. That's noteworthy. It's suggestive of something else we've been saying all along, which is, yeah, the dollar has been softer, but we shouldn't overread that. The bid for U.S. assets, including the dollar, on balance continues.
Here's the latest. The U.S. dollar posting its worst week since June, with Bloomberg's dollar index showing the greenback on course for its steepest yearly drop since 2017. Lots of questions around debasement. Bloomberg Skylar Montgomery Koenig joins us now. And Skylar, thank you so much for being with us. Before we get to the dollar and the path ahead, I'm curious your view on how much you consider gold and silver when discussing whether we are seeing truly a debasement trade take hold.
Yeah, I mean, I think the one place that you can see investors really pivot away from the dollar is in COFR data. So central bank reserves have pivoted away from the US dollar, but it's not landed in one currency specifically because there is no clear alternative, which is the issue. Now, I bring this up because there's also been a pivot into gold, and I think that's increased enthusiasm for assets generally that are more out of the norm. And for the dollar, it's not a big impact because it's a small flow, but for gold, it is very much a big flow relative because it's a smaller market. So I think it's definitely symptomatic of that trade, but it doesn't necessarily mean that you're going to have big dollar downside because COFR reserves, the share for the dollar has been declining for something like 2 decades now. And you've had big cyclical dollar bull markets in that period. So it's a small flow for the US dollar, especially as it still dominates trade flows, it still dominates financial flows, but it's a big flow for gold.
How much is a weakening dollar a consensus trade heading into 2026?
I think it's more mixed than maybe the headline numbers tell you. What you tend to see actually is at the beginning of the year, if there's not a strong bias, you tend to have consensus go towards dollar weakness. And that's because you've had dollar overvaluation on a number of metrics for a very long time now. Now, I think the issue is those metrics is they don't take into account productivity gains. And so on that measure, you'd say valuations should have a structural break higher because the U.S. has been more productive than a lot of its developed market peers. So I think, when there isn't a clear bias, as we had at the beginning of last year, which was actually for dollar strength, you tend to see dollar weakness come out as the favored trade at the beginning of the year in year ahead outlooks.
I have a pretty smooth brain, so I can't think of too many factors at once. I just look at rates, right? And in terms of the terminal rate that futures are pricing in right now, it's 3%. If we don't go that low, do you maybe get a dollar with more strength than the street's expecting?
Yeah, I think certainly. So there are two factors that I'm really thinking about next year for the dollar. The first is that we had this risk premium priced in on Liberation Day. Now, that premium has compressed as some of your more world-listing policies from the U.S. administration has come off. So we no longer have the big threats to the Fed's independence that we had previously. And you've also had more positive growth drivers like fiscal stimulus. Now, I think that compression still has a room to run. And you can see in the gap that's opened up between, say, euro dollar and rate differentials that there could be some move still in that. But I think also, as you say, the Fed is kind of priced at what I would consider as a dovish extreme, which points to rate differentials also moving in the dollar's favor in 2026. The market's still looking for a terminal rate around 3%. That's in line with the Fed's estimate of neutral. So it's arguably a floor for pricing because going lower would imply a recessionary dynamic that would boost the dollar as a safe haven in any case. But a 3% terminal isn't a ceiling for the Fed, I don't think. We've already repriced terminal higher twice this year from the Fed's perspective in terms of you've had that neutral dot kind of edging upwards as the economy is held up very strongly. So I think certainly you could go higher from here, and that skews the risk to being dovish Fed expectations being disappointed, and that's supporting the dollar.
Bloomberg scholar Montgomery Koenig, thank you so much for being with us this morning. And Matt, I should start more of my questions with, I have a very smooth brain. That's fantastic. I love it.
She mentioned productivity and all these other factors, and I'm, as a male, sometimes incapable of thinking of too many things at once, right?
Don't categorize all men like that.
No,
all I can say, I'm going to stand up for the male contingent here. Now, look, there is this question of what is the main driver at any given point. And right now, it has gotten incredibly muddied because a lot of people are talking about rate differentials possibly being the main driver. Other people pointing to the question of, well, is the Fed truly independent? Something that you picked up.
Yeah, I would question the Fed's independence now and especially next year. I mean, what could happen, I think, is still in question.
What could happen is coming up next. We're going to be speaking with Deborah Cunningham of Federated Global Investment, Terry Haynes of Pangea Policy, and Savvy Sith of Raymond James as we dig deeper into the airline sector as we do all travel. This is Bloomberg Surveillance.
In case you missed it, on Bloomberg Open Interest.
Politics will drive the economy. Now the conversation is AI is driving the economy.
AI story and really the economy and inflation story will probably be front and center.
We saw the promise of ChatGPT. 35 million people are paying for it.
We have the ChatGPT versus the Google platform. Maybe there's pressure on the rest of the secondary and tertiary players in the market.
Don't miss Open Interest live every weekday.
What some of these generative AI models look like they're going to do is they're going to reduce the cost of producing content to basically zero. So that will be a multiplier effect on the things that we're already seeing, which is that there's more people producing more content and reaching more people. And there's a lot of good and bad that comes downstream from that.
I don't know if you can break down what the average person is seeing right now in terms of stuff that's AI generated versus, maybe more traditional human generated, but what's that going to look like in a year or in 5 years?
There's actually a lot of hybrid content, and too often we talk about synthetic content and organic content and never the two shall meet. But there's a lot of content where AI is part of the workflow, right? Like you might not even know it. It might be whatever app you're using to do color correction might be using models to do so. Stamp tool in Photoshop in the old days to get rid of a pimple, those types of things. But that line is going to be more and more blurred. So it's going to be a little bit less like what is organic content and what is AI synthetic content and what the percentages are. I think there's going to be actually more in the middle than pure synthetic content for a while. But you will also see experiences that are purely AI, right? You see this in the last 2 weeks with Vibes in the Meta AI app and with Sora 2 from OpenAI. So I think you're going to see both.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily. Every business day at 2 p.m. Eastern, only on Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg. In case you missed it, on The Pulse.
Distinguish between companies are here because they're running international operations, the companies that are indigenous and working with the citizens of the UK, and make sure you get the regulation strategies right. With the rule of law and the great city that London and the great country that UK is, there's plenty of upside.
What do you tell the Prime Minister?
I tell them to make sure the regulation's fair, be the best place for a non-UK based company to operate, and you'll get companies coming here.
Don't miss The Pulse, live every weekday.
Next year, you have the hallmarks of a potentially pretty exciting year.
Balanced portfolios make a lot of sense heading into 2026.
Setting this up for a year where you're going to see a lot of churning, but have moderate returns.
We see a huge amount of appreciation across the AI names. There's a question of which ones and how long can that run for.
Respect the trend, but don't ignore the risks as we go into 2026.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks marching toward new records, but taking a little bit off this morning as traders bet on stimulus and growth. Precious metals in focus with prices of gold and silver dipping a bit after a parabolic rally. Copper, meanwhile, surging on that real world demand. And President Trump closing out the year trying to tie up what has been an elusive peace deal between Ukraine and Russia. Matt Miller in the hot seat today. So glad to have you as we play tag here on Surveillance. John is out on paternity leave. Anne-Marie is off on vacation. Matt Miller, I am so pleased to spend the next couple of hours with you. I'm just wondering, given this rally is 1% away from all-time highs, what will it take to get it over the edge?
Yeah, well, I think we typically have Santa Claus rally in the last 5 days of December, first 2 in January, that averages a gain of 1.5%. Right now, we're only up 0.3% in the first 2 days of that. So we could still easily get there. And it looks like the market wants to, despite the fact that futures are off a little bit today.
It seems like the bet is on a broadening out, and you are seeing a little bit more of that this morning with the idea of losses in S&P futures and NASDAQ futures, but not necessarily in Russell 2000 futures. And this idea, you need to see that. There has been a shift in the conversation around AI, and I think it's worth mentioning that Grok NVIDIA deal that we saw last week with a question of what this signifies going forward, that NVIDIA is trying to consolidate its market share to get a non-exclusive licensing deal with a company where they're going to hire most of the people and possibly get a more efficient chip to put out there on the docket. It just highlights how things are shifting in terms of narrative.
Well, only a few months ago, industry experts would have told you nobody's even close to catching up with NVIDIA in terms of the technology. And then we got the Google TPU story, which I think changed that calculus a little bit. But look, the M&A is part of the animal spirits. The IPOs we've seen, part of the animal spirits that have essentially eliminated bears from this market. In terms of equities, everyone is a bull.
Yeah, right now, everyone's a bull heading into next year, which raises the question, how much more bullish can people get, and what do they need to CFTC to possibly shift that view. Precious metals highlighting this concern about some sort of debasement trade or haven trade, or maybe it's just the real economy. And what we're seeing there, you are seeing copper prices retreat after being up some 6% in pre-market trading, now up 0.2%, just as people look to some of the stockpiling going on and losing those gains as we speak. Silver, meanwhile, down almost 6% after a rip-roaring record run. And what we have seen in the bond space, and this is interesting, so much depends on next year, what happens with the Federal Reserve. The two-year yield started this year at 4.23%. Currently, it is 3.47%. The 10-year is down from 4.55%, currently 4.11%. The best rally right going back to 2017. The 30-year yield started this year almost in the same place that it is now, around 4.8%. Matt, it just highlights how you can move the front end, but the long end rests on something completely different.
Yeah, absolutely. And I tend to broaden out my look at rates to at least November when we had the election, right, and to September when the Fed started cutting. And if you look at it over that time frame, you've seen an even bigger rise in 10-year yields. So I know that this administration wants to get the 10-year yield down. They want to get mortgage rates down. They want to lower interest rates for companies that have driven a lot bankrupt, but they haven't been successful thus far.
Meanwhile, right now we are looking at a pretty quiet week as we head toward that New Year's celebration on Thursday. Thursday will be a closed day. I'm sure everybody is going to be traveling and enjoying their families. We are going to be getting, though, tomorrow some meeting minutes from the Federal Reserve. We're also going to be getting jobless claims later on this week on Wednesday. A real question here about any read or tell from some of the information that we're getting, given the fact that people say the GDP print from last week or the jobs report that we did get from the previous couple of months have been so messy that you have to wait until early in January to get a cleaner read. Coming up this hour, Debbie Cunningham of Federated Hermes as Wall Street pushes for year-end rally. Terry Haynes of Pangea Policy as Nancy Pelosi predicts big Democratic wins in 2026. And Savvy Sith of Raymond James as holiday flight cancellations deliver a costly blow to airlines. We begin this hour with stocks holding near record highs as we start the final trading week of 2025. The future of the Federal Reserve very much in focus. Bank of America CEO Brian Moynihan saying an independent Fed is critical for the health of the markets.
They're a lender of last resort. They're there to stabilize markets and price. But other than that, you shouldn't know they exist, quite frankly.
You don't worry about all this, hand-wringing of political interference with the Fed once that new position is.
The market will punish people if we don't have an independent Fed, and everybody knows that.
Debbie Cunningham of Federated Hermes writing, while the Trump administration attacks in the committee have intensified worry in the financial markets, we believe the Fed will prevail. This does seem to be the preeminent belief right now in markets. Debbie joins us now for more. Debbie, why do you think that the idea of Fed independence is kind of behind us and that people have sort of closed that story out in 2025 and look to a sort of more normal Fed in 2026?
Well, I think what we saw in 2025 was a surprised and then ultimately a divided Fed. We still don't know the full ending to the Lisa Cook story. We do know the ending to what the Supreme Court has thought about as Fed independence and a different type of body compared to some of the other ones. We saw President Trump go from, supporting Chair Powell to trying to fire Chair Powell to being told he can't fire Chair Powell to submitting to trying to find other replacements for him, interviewing replacement candidates for him for his expiration of his chair term in 2026. So I just feel like what we've seen so far has been a bit of a upheaval and turmoil within the Fed that now that the independence has been, solidified, I think that will not be the case going into 2026. However, what I do think will be the case is that we see less voting that is all in alignment. I think we will see more dissents. We've already started to see them in the last three meetings. And I think that will probably continue. And, what we've seen historically as hawks, centrists, and doves will become even a little bit more pronounced in their voting.
So do you think, Debbie, that people are overpricing the chance of rate cuts next year?
I think they are, at least from what the Fed is telling us with their, their dot plot, their series of economic projections. They are looking for one. Our official call right now, as we transport into 2026, is for two, one in the first half, one in the second half. But I think ultimately, although the pace of lowering rates has modified from where it was when we started 2025, the ultimate terminal rate, Lisa, seems to be the same. I mean, it's not going below 3%, and that's where I think the bond market is settling in. That's why you see, the 10-year rallying at various points. That's why you see a range trade that is really more indicative of actual technicals and market conditions, as we head into year-end, supply and demand, repo market, issues all seem to have more of a influence on rates on a day-to-day basis for this, last trading week of the year. But ultimately, when you look at the terminal rate for the Fed, over time, it's still at 3%. It's just 3% a year earlier.
I wonder how you view liquidity right now, given your position, and given that we're now have eclipsed $8 trillion in money markets. It seems like there's a lot of cash sloshing around the system. And we have pretty decent growth, right? Even though it's hard to look at these economic data points, 3.8% GDP, maybe only 2.6% inflation. What's your view on sort of the macro picture?
I think the macro picture at this point is that the worst is behind us. We really, when we went into 2025, were toying with the potential for some sort of a, substantial growth slowdown into a potential recession. That's behind us now, though, at this point. We think the worst quarter, obviously, was the first quarter of 2025, and the consumer continues to be employed, so the consumer continues to spend, and the consumer is the one driving the economy in this recovery that we have been experiencing. So I think slow growth will be the case. I know not a lot of people like that from an equity market standpoint. It doesn't get the same sort of splashy results that a faster growth economy does. But I believe that when you look at liquidity markets, when you look at broader term fixed income, slow growth is not a bad place to be, and we've seen that certainly in the gathering of assets in the liquidity market, as you said, recently passing the $8 trillion mark.
Debbie Cunningham of Federated Hermes, thank you so much for being with us, and have a wonderful New Year's celebration as we assess what's going on next year. It is sort of this contradiction, Matt, that we're talking about the potential for slow growth, and everyone's talking about how consumer sentiment is down. And then you saw the GDP print from last week come out, which was the fastest pace in 2 years. And it sort of raises this issue of, are we seeing an economy entirely powered on data centers while human beings kind of wonder what their existence is and wonder what the path is going forward and lose confidence in their futures?
I mean, I find the term K-shaped kind of annoying, but it seems to be prevalent across a range of different industries and paradigms. I mean, certainly in M&A you see it, certainly in terms of profit growth you see it, certainly in terms of the consumer you see it. So I just don't understand how 3.75% is restrictive. I mean, are we really looking at a rate that's 75 basis points too high and still growing at a 4% clip?
Okay, so this is the debate, right? For mom and pop stores, not so much. You talk about M&A. Where is the M&A happening? Yes, it's happening across the board. It's happening out of necessity, right? Because companies want to get bigger, banks in particular, also industrials. But you're also seeing the ongoing tech M&A because companies can, right? We talk about NVIDIA and Grok and the $20 billion valuation. They're just sort of minting money. But we also have another deal that could potentially be announced this morning. We're hearing that SoftBank could be announcing Digital Bridge. This question of that race really driving a lot of this activity. And without that, what happens, right? How much is left, and is it restricted for who?
Right. Without that, you only have the lower half of the K, right? And I guess that's the problem. 717 companies filed for bankruptcy through November, and obviously that's worse than we want to see it, and that's all due to interest rates and inflation. But inflation, I think, is something that you shouldn't forget, right? Because the last print looked soft, but companies still have to pass through more of this tariff costs.
I'm very much with you, and we'll be watching that coming up. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Policymakers for the Bank of Japan are signaling more interest rate hikes are ahead. A summary of the bank's December meeting shows board members raised concern over the benchmark rate, calling it the lowest level globally. Currently, the BOJ's key interest rate sits at a 30-year high. Meanwhile, Ukrainian President Volodymyr Zelensky says he asked President Trump for U.S. security guarantees lasting as long as 50 years. Zelensky spoke to reporters after the two leaders met yesterday in Florida. Current proposals outline a 15-year security term with the possibility for extension. President Donald Trump says Ukraine and Russia are, quote, closer than ever before to a peace deal. Meanwhile, silver pulling back from all-time highs as traders take profits from this year's record-breaking rally. A weaker dollar and rising geopolitical tensions boosting precious metals during the end-of-year rally. Silver is on track for its best annual performance since 1951. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahaira. Up next, winning the House.
So if the Democrats win the House back.
No. When? When the Democrats win the House back, then we will. Right now, the Republicans in the Congress have abolished the Congress. That ends as soon as we have the gavel.
Terry Haynes of Pangea Policy joins us next as we preview 2026 in Washington, D.C. From New York, this is Bloomberg Surveillance. Good morning.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Every weekday from 3 to 5 Eastern.
Only on Bloomberg. Context changes everything.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
To get that Christmas and New Year's and holiday spirit into the markets right now. The Santa rally kind of fading just a touch, down about 0.2% on S&P futures. You see a bigger move on the NASDAQ, although Russell 2000 about flat in early market trading. Meanwhile, just a touch of dollar strength after a pretty weak month. We are seeing 117.59 down by about 0.1%. The euro versus the dollar cross a stronger dollar. Meanwhile, 10-year yields down about 2 basis points to 4.11. 11. They have declined from some 4.55% at the beginning of this year. And copper coming off some of the earlier highs. We saw that up now 6% in pre-market trading. Now we're only up 0.3%. A real question of Dr. Copper, is there a tell here? Who is stockpiling copper? Is it all of us as we build out data centers? Under surveillance this morning, a focus in Washington, D.C., winning the House.
So if the Democrats win the House back.
Yeah, no. When? When the Democrats win the House back, then we will. Right now, the Republicans in the Congress have abolished the Congress. They just do what the president insists that they do. That will be over. That ends as soon as we have the gavel.
Here's the latest. Former Speaker of the House, Nancy Pelosi, predicting congressional success for Democrats in next year's midterm elections. A recent Gallup poll finding Americans' approval of the current Congress is at just 17%. Bloomberg's Tyler Kendall joins us now for more. Tyler, as we set up into next year, the midterm elections seem to already send a message to Washington, D.C. How have you seen the messaging shift from both sides ahead of the midterm elections?
Yeah, hey, Lisa, good morning. Well, that polling that you just showed is pretty brutal, but it does highlight the fact that this Congress has only passed fewer than 40 bills so far this year, which hovers near record lows. So you've really seen Democrats on one side try to highlight what they say should be other policies put forward, but that their hands are tied because they don't control both chambers of Congress and the White House. And the White House try to tout what they've already put into effect, right? We heard President Trump tell Politico on Friday that the midterms are going to be all about pricing, in his words. As we've spoken about multiple times on this program, the administration has tried to shift the messaging when it comes to the issue of affordability. And you were just discussing that GDP number from last week. President Trump coming out and touting that growth while we've seen consumers really remain downbeat. That means that we're going to see the potential for a few different policies going forward here, right? Republicans want to tout what they've already done, including many of them saying that we're going to get large refunds come tax season. Many of them also floating that we could see another reconciliation package next year. But there are also going to be those big headwinds. And that's what Democrats have been highlighting, including that we could be staring at another government shutdown come January 30th. And there still hasn't been any movement when it comes to a potential health care deal. Lisa, I'll give you the upshot here, which is that Democrats only need to net 3 seats next year in order to flip that chamber. That is how slim the margins are. We are talking about the House, but also worth mentioning in the Senate, the math's a little bit more tricky, but Republicans have seen some senators in key seats say that they're not going to run for re-election, like Tom Tillis in North Carolina and Joni Ernst in Iowa. Those were some seats that Republicans were banking on.
Tyler Kendall, thank you so much for that. Right now, Terry Haynes of Pangea Policy joins us for more. Terry, it does seem like 2025 was the year of Trump. President Trump dominated a lot of the news. We did not see a lot of congressional action. How different will 2026 be?
Well, I think people in markets feel that they're pretty well worn out from 2025 and the kind of Washington action they saw across the board. I told markets that I thought 2026 was going to look like a frenzy because you'd see Trump and Republicans doubling down on what they did and do the maximum amount of possible to make sure that they put the best case before the public that they ought to continue with a Republican trifecta in Washington.
Hey, I thought it was interesting, Terry, that Trump and the party kind of campaigned on an anti-neocon, like we're going to focus on domestic issues and get out of foreign policy disasters. And now they focused almost solely on foreign policy and are bombing different countries. And it looks like now maybe even a land strike on Venezuela. Does that continue into 2026?
Well, I think they'd dispute the premise. Certainly, the big beautiful bill is about domestic, and to the extent it's about international, it's about making sure that that what you get in American industry is reshoring and a much better and bigger defense industrial base. But I do think you see continuing that pretty muscular foreign policy because that's part and parcel of what the competition with China is all about.
So do we get in, I mean, it looks like we may agree to a 30 to 50-year commitment in Ukraine. At least those are the reports from Zelensky this morning. And do we get in a land war in Venezuela, or do we attempt regime change again in South America?
Well, I think what you're seeing on both the United States and China's part is grasping for, pushing against kind of hemispherical dominance around. Certainly, a lot of what China does in the South China Sea and beyond is about hemispherical dominance. Pushing on Russia and Europe on trade is about hemispherical dominance. China being the biggest trade partner of South America is about hemispherical dominance, and it's a big reason why Trump and the Congress both are focusing on pushing back against that. Whether you're talking about what happened in Argentina, what is happening in Venezuela, what happened in Colombia, and so on.
You heard Nancy Pelosi talking about how Democrats are going to take control of Congress come 2027, certainly the 2026 midterm elections. There is this question about what the Democratic agenda really looks like. And there's been a battle for what priorities the Democrats really want to put forward. How different are they from what President Trump is doing?
Well, they're different in a lot of ways. I think Mrs. Pelosi, of course, is in her exit interviews phase, and you're a leader of a party. You're always closing, right? You always be closing, and But I would say to you a couple of things, Lisa. One is that it's way premature to suggest that Democrats are going to take anything over. Simple math is when you've got at least 10% of the seats up for grabs through retirements and whatnot, and you need such tiny margins to hold. Right now, almost a year out, anything could happen, and that certainly wasn't the plan in 2016 that Republicans were going to hold both houses, and yet they did. That said, I think that Democrats, frankly, want status quo more. On margin, what Democrats want is going to be kind of less desirable by markets because it's just going to pile on more debt and deficit. That is what the progressives in the party want that have the energy and the money in the party. What Republicans are trying to do, not cheerleading for them, but I'm just saying, is trying to figure out ways to lessen debt and deficit to some effect, and show markets that, frankly. And Bessent has said that this is a 3 or 4 year process, but he's hoping that they can get there by the end of it.
So, Terry, you don't think that they're going to sign off on $3,000 or $2,000 checks come early next year and expand the deficit?
Oh, I think there will certainly be some deficit expanding actions taken. It'd be naive for anybody to think that politics is about some ideology, and fundamentally these days, I think it is not about ideologies. Certainly, if you accept the premise that Trump bestrides Washington, then you're seeing a fairly non-ideological president. But I think they'll cut some checks? Yeah, I think they probably will. Do I also think that they have it in their ability through a couple of different times in a couple of different ways through the winter and spring to do something about Obamacare that lowers the debt deficit? Yeah, I do that too.
Terry Haynes of Pangeo Policy, thank you so much for being with us, and have a wonderful New Year celebration. Coming up, more from our conversation with legendary investor and co-founder of Oak Tree Capital Markets, Howard Marks, plus Guy Johnson with your morning movers. SoftBank in advanced talks to acquire Digital Bridge Group. Those shares up more than 30%. From New York, this is Bloomberg Surveillance. Good morning.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Watch Horizon's Middle East and Africa every trading day at midnight Eastern Time, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
A bit of a soggy start to start the last trading week of 2025. We are seeing futures lower on both the S&P and the NASDAQ, about 0.2% loss on futures in the S&P. NASDAQ down 0.4%. Russell kind of catching up to that, or catching down, I should say, down about 0.1%. Still, we are up 18% on the S&P so far this year. Matt, what are we? 1% away from that 7,000 mark?
Yeah, on the cash trade, I think we closed at 69.29 or 69.32, around there. So about 70 points away from 7,000, which isn't meaningful in any other sense than it's a big round number. So if we hit that by the end of the year, I think markets would be pretty excited.
Yeah, they're hoping for that Santa rally to get to that big round number. Meanwhile, the big round number in 2s, 10s, and 30s is that yields have actually gone down considerably this year, at least in the 2s and 10s denominations. You are seeing on the front end of the yield curve, we started the year at 4.23% on that 2-year. Now we're seeing 3.47%, down a full basis point. 10-year yields started the year at 4.55%. We are currently below 4.11, down 2 basis points. The 30-year yield has basically been pinned at this 4.8% level. 2 hours away from the cash open. Let's head over and get your morning movers with Guy Johnson over in London. Guy, over to you.
Morning, Lisa. Metals and tech. Those are the 2 themes you need to think about first thing this morning. So let's start with the metals, then we'll do the tech in just a second. So silver, we know it's down this morning, but it's had a great run. So silver stocks have had a great run as well. AG, this is First Majestic Silver Corp, just one of a number of silver names this morning, therefore pre-market, that is giving back a little bit of ground. People are talking about a bit of choppiness in this space. Gold had a great run. The miners did well on the back of that. And you can see silver, look at that run that it's had, particularly at the back end of the year. Just beginning to give a little bit of that back now. Are we going to see some choppiness going forward from here? Are those stocks going to be reacting? 160% to the upside on silver year to date. That's a phenomenal move. Okay, so let's stay with the metals theme, but kind of go from the top to the bottom in terms of the table, right off the bottom, in fact, and deal with uranium. This is Energy Fuels Inc. This is a company that is based out of Denver. It is a company that mines in Arizona and mines in Utah. It does uranium and it also does rare earths as well. This morning it's out with news that it's doing well on the revenue and the sales front when it comes to the uranium sales story. Why is this important? Uranium stocks have had a fantastic run this year. Why have uranium stocks had a fantastic run this year? Because uranium goes into nuclear power plants, which goes into data centers via the electrons that flow out of them. So that takes us to the data center story. It's all related into this narrative. And that takes us on to our last one, which is Digital Bridge Group. Remember, we saw SoftBank selling out of NVIDIA a few weeks back. We're now starting to see maybe some distribution of that money. Advanced talks, we understand, for SoftBank to acquire Digital Bridge. What is Digital Bridge? It is a private equity company. It's based out of Boca. It's based out of New York. It's based out of LA. What does it invest in? Yeah, you guessed it. Data centers, amongst other things. And the Advanced talks story this morning driving this stock sharply to the upside. As you can see, we're up by, let's call it a third, 33%. Lisa, back to you.
Thank you so much, Guy. Great work, as always. On our radar this morning, President Trump saying he made a lot of progress in talks with Ukrainian President Volodymyr Zelensky Zelensky over a possible peace deal this weekend. Zelensky asking the United States to consider providing Kyiv with security guarantees that would last 30 to 50 years. Also, President Trump holding another high-profile meeting in Florida today, this time with Israeli Prime Minister Benjamin Netanyahu. The two aiming to boost a U.S.-brokered ceasefire in Gaza, which faces challenges as it moves into its second phase. And lastly, silver pulling back from all-time highs as traders take profit from this year's record-breaking rally. It's on track for its best annual performance since 1951, rising some 161%. Meanwhile, copper surging to a fresh record close, extending a stunning year-end rally fueled by concerns over tighter supply. Markets are capping off a year of seismic shifts, from the dominance of AI to historic trade tensions to the Fed's independence under threat. Earlier this month, they spoke with Oaktree co-founder Howard Marks about his latest memo, exploring if there's a bubble in artificial intelligence. Take a listen.
The unproductive bubbles I would describe as financial fads. Portfolio insurance was one, subprime mortgages was another. Financial activities that become fashionable, zoom into popularity, get overhyped, and then recede. But then there are bubbles which are based on technological progress, starting with the steam engine, the railroad, the radio, the automobile, computers, internet, et cetera. And these actually push society ahead and change it irreversibly. But in the process, there's a bubble surrounding their implementation, which is overly accelerated and overly financed and goes to excess and end up destroying a lot of capital, but leave society greatly changed. And I'm sure that AI is in the latter category in terms of effect on society. And the question is, will the implementation prove to have been excessive in scope and in the way it's financed?
Just because something is excessive doesn't mean that you can't invest in it.
No, but when investors hate everything and won't touch it with the 10-foot pole, chances are it's going to be on sale because nobody has pushed up the price. In fact, their disinterest has pushed down the price. But when everybody likes something, is excited about something, chances are it may be overhyped and overpriced. So you just have to be careful.
So that's where we are right now. You said you can invest and you can participate, but you just have to be careful. What does being careful look like? Does it mean focusing more on debt versus equities, more on equities versus debt, more on small companies versus big ones? What does that look like?
Well, what I say in the memo is that it's okay to lend for activities even if they're uncertain, but not if the outcomes are purely conjectural. I mean, in order to be a smart lender, you have to have good visibility on the extent to which the thing is likely to repay interest and principal. If it's just purely conjectural, it's not. You shouldn't be a lender. And in fact, I think the memo says that where that's the case, you should actually, if you want to participate, you should be in the equity, so at least you get the upside. The lender has no upside. You make a 9% loan, all you're going to get is 9%, no matter how well the thing does. You certainly shouldn't do that in activities that have a high probability of not paying off at all, because then you have unlimited downside and limited upside. That's absolutely the wrong combination.
So you think right now, in some circumstances, the equity might actually be a better option than the debt because of that potential upside?
Yes, exactly. Because the point is that if you go into some startup which has let's say a small possibility of a raging success, you wouldn't lend to it because you have a high probability of losing all your money and no probability of participating in the success. That's a bad trade.
So you always talk about this risk-reward pendulum, the risk and fear, the sort of fear and greed pendulum right now. And yesterday we saw Oracle come out and talk about having to borrow more money, having to spend more, and people are selling off the shares. Does this make you feel good? Does this make you feel like there actually is some discretion? Well,
yeah. Well, I think that you know, Buffett says, the less prudence with which others conduct their affairs, the greater the prudence with which we must conduct our own affairs. So when other people are acting imprudently and mindlessly and carefree, we should be worried. When other people are showing appropriate concern, that's a positive sign that the market is applying some discipline. Some of the greatest moments that I've seen, some of the greatest signals of danger in the markets have been when people were not applying any prudence at all, like in '06, for example. So if people are reacting harshly to aggressive, possibly risk indicating activities, yes, that's a healthy sign, and this market seems healthier than the 2000 market to me.
How concerned are you that we get a Federal Reserve that's more accommodative for a variety of reasons that leads to even more risk-taking? This idea that not only did the Fed cut rates, indicated more rate cuts, but also is adding to its balance sheet in a way that could potentially prop up demand.
Well, you know, I was thinking about this when I was waiting to see you today. Most of the people listening to this program, including me and you, are interested in the free markets, and we think free markets should set the prices of things. And the Fed manipulations are a form of price controls. You know, they control the price of money, and if the Fed puts money artificially cheap, then it induces behavior like risk-taking. It forces people into riskier activities because the returns on safe activities are so low. It tends to reinforce the view that there's a Fed put, that if there's a problem, the Fed will solve it, and that contributes to risky behavior. These are all bad things. And, you know, I believe that the Fed should be passive most of the time, and only come to the rescue if the market is, if the economy is seriously overheated and tending towards hyperinflation, or seriously underactive and not creating jobs. I don't think that's the case right now. I don't think there's and you can see in the divided Open Market Committee that there's a difference of opinion. So I don't think that action on the part of the Fed is compelling right now. And, you know, there are people who think that rates should be a lot lower than they are today. I just don't see the merit in that.
Right now, going forward, I remember back in 2015, 2016, 2017, when rates were incredibly low, you were saying people just need to lower their expectations for returns.
Right.
Because ultimately, you have to look at the risk-free rate, and you don't want to reach too much at a time where people are greedy.
Right.
Where are we right now in terms of what types of returns people ought to expect based on the current income rates?
Well, the lower base interest rates are, everything scales off that. So, you know, I mean, the Fed funds rate at 3.5 is below history. These are not high rates. They're only high relative to the last 15 years. But this is a low rate. So everything scales off that. Most things will give moderate returns. In the debt area, I think prospective returns are moderate, okay. Not lush, but not inadequate. The trouble is that the S&P, based on its PE ratio relative to history, appears to be priced to provide a very low prospective return. Historically, if you bought at this PE ratio, your return over the next 10 years averaged in the very low single digits. So I think we're in a moderate return scenario. The problem is that how do you get a high return in a moderate return scenario? And most people's resort is to take a lot more risk. And that's something I don't like to do, other than when it's compelling.
You had a personal note, an addendum at the end, and I led off with that idea of what artificial intelligence and machine learning will do to the labor market. It's something clearly on the Fed's mind, clearly on investors' mind. You're talking about concerns that there is going to be cannibalization from human jobs. How do you see this playing out? How are you kind of grappling with this when you look at investments, when you look at fiscal deficit, when you look at the backdrop for the financial system?
Well, look, Lisa, here I'm not talking about investing or economics. I'm talking about society. And it's very worrying to me. And, you know, I've gotten some very nice response from people I respect to the memo. And one of them said he thinks we've seen this in response to the internet over the last 25 years. But it has not raised unemployment because the internet eliminated white-collar jobs that were replaced by blue-collar jobs, like, you know, people who pick stuff in warehouses and send it out in e-commerce. So job count is not down, but job quality is down. And I think that this is very worrisome. And as I said in the addendum, when we lost jobs to automation and offshoring, I think that coincided with the opiate epidemic, and not only in amount, but also in location. And I think it's a natural consequence of people sitting around all day. And even if we can find a way to replace their income, I worry about purposelessness. And, you know, we get so much from our jobs other than a paycheck. And you can't replace that stuff.
Wise words from Oak Tree Capital Management co-chair Howard Marks. I could listen to him all day. Such deep thinking at a time when everybody is banking on the artificial intelligence trade and wondering what it's actually going to do going forward.
Yeah, I think first of all, I could listen to him all day as well, and he's an incredibly smart man who says some really prescient things. I think in terms of artificial intelligence, for me, when I try and link it back to the market, the most interesting thing will be how damaging it is to software companies. And, you know, venture capital tends to invest very heavily in software companies because of the model. It's much easier for them to predict out revenue streams. But a lot of those companies will have lunch eaten by AI, because why would you buy a pre-programmed package when you can program it yourself?
Yeah, meanwhile, up next, we're going to be talking about the resilient traveler.
Demand has been, you know, resilient, right? Every time there's cold water poured on the environment, it seems like, you know, travelers want to come back.
More from the conversation with American Airlines CEO Robert Isom coming up. This is Bloomberg.
Crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Some people travel to see the world. I travel to question the forces that shape entire nations.
How was it possible?
My name is Professor Hannah Fry. I want to meet the people with unexpected stories to tell and dig up the peculiar and wonderful treasures that reveal what a country is made of.
Welcome to the world of decentralized finance. Bloomberg is covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, Tuesdays only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
A bit of softness this morning that does deepen, particularly at the Russell 2000 ahead of the open. A little bit of a bid into treasuries. I guess people trying to reassess ahead of 2026. Under surveillance this morning, the resilient traveler. Airlines are in the midst of a record-breaking holiday season. Sat down with American Airlines CEO Robert Isom, and we asked him about consumer demand. Take a listen.
You'll see us open up more secondary cities in Europe. You'll just see us do more flying into the hubs of some of our partner carriers. And international probably outgrow what we do from a domestic perspective, but the two are connected. And you know, I'm really pleased with our domestic operation. We're going to always have the best domestic network. And you know, you go back a number of years, and domestic outperformed international. And we're going to be ready for domestic doing well and international doing well, premium doing well, and really pleased with where we're at.
You've been working on upgrading the entire fleet, and that's something that's been really important for you, especially as you get some of these premium offerings in place. How much have some of the slowdowns, supply chain issues at Boeing and Airbus hampered that ability to really retrofit some of the fleet?
Well, where we stand today, we have the youngest fleet in the industry. We made a tremendous investment from about 2014 to about 2020, and we brought on well over $30 billion of new aircraft. So we have the youngest fleet in the business right now. But on top of new deliveries that we're taking, we don't have any retirements planned. So we're reconfiguring our 777-300s and our 777-200s. We're putting flagship suites on those. Even domestically, we're doing work on our 320s and 319s. But we still depend on new deliveries. And from that perspective, we have a lot of dependence on Airbus to deliver the 321 XLRs, Boeing to continue to deliver the MAX 8s, and hopefully be ready to deliver the MAX 10s that we have on order in 2028. Right now, my only push to the OEMs is deliver on time, deliver a quality product, stick to it. Before you ramp up, let's make sure we can do what you're on the books to deliver now.
Just taking a step back, in the airline industry more broadly, there's been this huge focus on the supreme product, the luxury product. And I wonder what you see in terms of bookings next year, whether it really is the premium product that's continuing to lead and the robustness that you see there while other things fall off. Is it bifurcated in terms of the bookings and the demand, or do you see a wholesale sort of rejuvenation in the interest in travel and ability to spend and pay the prices that actually are there?
Well, I'll just start with this. Demand has been resilient. Right, every time there's cold water poured on the environment, it seems like travelers want to come back, as evidenced by bookings for the holiday season, and as we take a look into the first quarter of next year. I have confidence, though, that overall people want to travel. And in people wanting to travel, I also think that, whether you're more economy-focused and budget-minded or your premium services, everybody wants more. Everybody wants better control. Everybody wants more comfort. So I don't think that there is going to be any going back in terms of offering product at any level of the spectrum of offerings. But for us, as we go forward, you'll see us with our lie-flat seat offering. That's going to grow by 50% over the next few years. Premium seating, 20% over the next few years. Whether you're a business traveler who've always wanted, more of that, comfort and ease of touch, or you're a leisure traveler, there's much more of a demand to really have a better experience.
That was American Airlines CEO Robert Isom earlier this month, and joining us over the weekend has been a number of people who could not get where they wanted to do. Airlines ran into some challengers over the weekend as winter weather led to cancellation of more than 1,500 flights. Savi Sith of Raymond James was delayed. She is now on the phone. She did write, though, earlier, we estimated each canceled flight typically costs airlines $40,000 to $65,000 in lost revenue and incremental costs. Savi, who was on one of those canceled flights, joins us now by phone. Savi, is this typical of the winter season? Is this something that is surmountable given the difficulties that airlines have had so far this year?
Hey, good morning, Lisa. Yes, I was doing some deep research here in Detroit, but, this is typical. We always kind of plan for winter disruptions. The nice thing about winter, at least, is that you see it coming and you can plan a little bit ahead. But there's always disruptions. I think the good news is if you look at how the cancellations are going, most airlines are recovering fairly well. It doesn't help travelers that are stranded or get their travels delayed, but airlines are recovering fairly well, and that's good news. And you're not seeing any meltdown so far.
So how bad is it this year compared to last year and the year before? And how do you factor that into your earnings estimates?
Yeah, so this year it's interesting. There are some airlines like JetBlue that are seeing kind of fairly elevated levels of cancellations and higher than last year. Delta more recently with this weekend weather hit in the Northeast and the Midwest is starting to see a little bit of pickup, and so slightly up year over year. But there's interesting ones like American that's actually seeing fewer cancellations this year than last year. So it really does vary across airlines. And for the most part, I think investors will look past some of these kind of weather-related events, and we'll be focused on just how demand is holding up as we look into 1Q in 2026.
Are there airlines, Savi, that deal with it better than others? Are there airlines that make the consumer experience better than others, or are they all awful?
What I would say is this year we've seen everybody handle it fairly well. There are some airlines like Delta or Allegiant where, they do kind of compensate passengers better. But again, I think for passengers, it's less about compensation and more about how quickly they're able to recover. And unfortunately, during the holiday season, planes are packed. It's really hard to reaccommodate passengers very quickly. But again, going back to the fact that the recovery from these cancellations seem to be fairly quick, that's a good sign for travelers, and we're seeing it across the board for most of the U.S. airlines. So it's a good sign overall.
Savi Sith, we wish you luck getting to where you need to go. Savi Sith of Raymond James, thank you so much. It is usually a pretty miserable experience, certainly if you ever get canceled. Have you ever gotten canceled?
Yeah, but travel in general. I mean, if you're flying in luggage class, it's horrible, no matter which airline you're on.
Well, if you want to make it more fun, add some young children. That's what I've heard. Yes. I think that always makes it a lot more fun. Coming up next hour, we've got Jay Pulaski of TTPW Advisory, Dana Telsey of Telsey Advisory Group, and Veronica Clark of Citigroup as we do look ahead to Fed meeting minutes as well as jobless claims. From New York, this is Bloomberg Surveillance. Good morning.
Here is understanding. These digital assets have the ability to change the payment landscape of the world, and we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading cryptocurrencies. What we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoins?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need, because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
Technology is embedded in every aspect of our lives and laying the foundation for the future. From finance to defense, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets. I'm Annabelle Drulers in Hong Kong. I'm Sherian in Tokyo. Watch Bloomberg Tech Asia, only on Bloomberg Television.
In case you missed it on Bloomberg Insight.
From a Bank of Korea's perspective, we don't believe that monetary policy alone can control the housing prices. But on the other hand, we are mindful that ample liquidity wouldn't throw the fire to the real estate market. Our official position is that we will maintain the easing monetary cycle, but the magnitude and timing of the cut or even the change of direction will depend on the new data.
Countries around the world are pulling away from U.S. assets. Do you see debasement happening?
No, actually. I think we have discussed this quite a lot. But actually, if you look at the actual capital flows in the last 6 months, I don't see that there's a lot of talk, but there's no real movement away from dollar.
Don't miss Bloomberg Insight live weekdays.
In case you missed it, on Bloomberg Open Interest.
Politics will drive the economy. Now the conversation is AI is driving the economy.
AI story and really the economy and inflation story will probably be front and center.
We saw the promise of like ChatGPT. 35 million people are paying for it.
We have the ChatGPT versus the Google platform. Maybe there's pressure on the rest of the secondary and tertiary players in the market.
Don't miss Open Interest live every weekday.
Bringing you up to them in the news whenever and wherever it happens. I'm Sherian in Seoul, and this is Bloomberg.
Next year, you have the hallmarks of a potentially pretty exciting year.
Balanced portfolios make a lot of sense heading into 2026.
Setting this up for a year where you're going to see a lot of churning, but have moderate returns.
We see a huge amount of appreciation across the AI names. There's a question of which ones and how long can that run for.
Respect the trend, but don't ignore the risks as we go into 2026.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks marching toward new records, but stalling out just a bit. Although traders are betting on stimulus and growth in 2026. Prices of gold and silver dipping after parabolic rallies. Copper, meanwhile, surging on real-world demand and a focus on the consumer during the shopping and traveling season. With economists looking
to reset the stream. I'll be back in just 2 minutes. We're just going to reset.
In the hot seat alongside me, and Matt, it does
Be
seem
back in a
like
minute.
people are looking to get